Greetings, folks. This is a review of last week's price action. Basically, I'm going to be reviewing how I traded and what we could have done, what I could have done better. Though I closed with the 700 bucks on my paper trade, so it was a good week of learning and reading price action, despite very hard price action. It was CPI week, it was NFP week, but we came out positive. So this is a review, and in the background, we're going to be hearing to ICT teaching us how we determine bias and the frame direction of trading. So the background play is so important that you have to go back and listen and make notes about what is telling in the background. Thank you. Please enjoy.
Oh my goodness. Two Twitter spaces in the same weekend? The end is near. That's the only explanation. The end must be near. Well, good morning. Good morning, everyone. So you're probably asking yourself, how on earth did he find a way back on the airways? Well, my wife decided to go with her family members to the outlets for shopping. So that's what's given me the opportunity. I said, well, you're getting to do what you want to do. Can I get on there and ramble on ICT? So, ramblers, let's get rambling. So we're looking at a topic that many times I've been asked, either in my private mentorship or people in Twitter or people in the comment section of my videos. When I open up the comment section, they'll ask me, what's my routine? And I've shared my routine on Twitter. I said pretty much what I do, what I eat, how I eat, my meal plans, and what I do throughout the day. That has been thrown into disarray with this whole house move here. There's been things that have challenged that schedule, so I've had to augment and change things. But the painters are done, and we are waiting on the final pieces of furniture, which will be months away from now. But for the time being, we have pretty much everything that's going to be here, at least through the holidays. So it's allowing a little bit of normalcy. I have to put everything together in my trading room, which is all sitting in the middle of the room under a sheet. So once that gets put together this week, I'll give you a tour. So the routine in the morning, I think really what everyone's asking, because they really don't care about, the calories and the meals I eat and how I exercise and what stretching routines I do and all those types of things. That's the boring thing. Nobody's interested in that. But I did share it on Twitter. But I think what they're asking for is, what's my trading morning routine? Like, what do I do in the morning? Like before I sit down the charts, like what is going through my mind? What do I consider? What are things that are important to me as an analyst? What do I look for as a supportive structure? A resource? What resources do I use? Those types of things. And I kind of want to talk a little bit about that today. And I know I like to be facetious and say, I'm going to have a short one here. I don't know how long this one's going to go, so it might be brief, but I'll open up at the end. I'll take 5 questions because I know a lot of you want to have a question answered. I'd like to know what your routine is. So if you send that in a tweet reply to this, try to be brief or whatever. It'd be cool for the community, and plus, I'm being inquisitive about it as well. But when I wake up, if I'm napping in the afternoon, because I do generally try to take a nap in the afternoon before the PM session in S&P, I will again hydrate. But if I'm waking up for the morning session, the first thing I do is hydrate. I drink 20 ounces of spring water. And then that's important because you have to have, number one, you have to have liquid. You have to have it. Your brain will function better. Your muscles will be hydrated. You'll get less muscle cramps. And generally, I have a banana, and that'll give me potassium, because standing in one spot or if you sit, I don't like to sit because my back won't let me do it. But if you do that for a long period of time, you'll get crampy. And I'm not sure if you ever stood or sat in front of charts for a long period of time and you start getting that crampiness in your lower back or somewhere in your body, or you get a muscle cramp somewhere. You can't focus on the chart. You're worried about that damn cramp that's going off. So one of the best things you can do is start your day with hydration. And then I stretch. I go through a routine of stretching. And that's about all I'm going to do for this discussion here, because everything else is obviously shown in that tweet months ago. But what I do is I refer to the economic calendar again, because when you wake up from a nap, or if you slept overnight and you're getting ready to do your morning session in trading, it's very easy to lose your bearings. You ever wake up, and I'm 50 years old, and I've had episodes in the last 30 years where I woke up and literally felt like I was late for school. I haven't been in school for a long, long time, but it's just weird how our minds are so powerful when we're sleeping. And when you wake up, you are in a altered state. Like you're not really awake yet. Your eyes might be open. Someone may be talking to you and you're looking in the direction that they're talking, but you're not really there. So you have to obviously refer back to what it is that you're going to be doing, because you could remember something about an economic calendar event. And I've done this. Okay. So I thought that there was going to be a report due and it wasn't due. And I'm expecting something in the marketplace and then realize, oh, what am I doing? I'm in the marketplace trying to do something and that's not even due out today. Or if I'm waiting for an 8:30 morning news embargo to lift and there's no news coming out. So I have to make the decision. Do I hold on to this trade idea if it's in drawdown and try to get out with close to even, or if I can squeak out a win from it, or do I just cut bait and just take the small loss because I did something incorrect? These are all things I have done coming up. Okay. So if you've ever had that happen, just know that you're in good company, because I'm not ashamed to say that I did those things too coming up. So you have to definitely review the economic calendar. Now, what economic calendar do I use? Well, I used to use Econo Day, and I mentioned that when I was on Baby Pips. And when I went to teaching predominantly Forex, I grew to appreciate and like forexfactory.com's calendar. I think it's easy. It's easy to manage and filter. I don't like looking at the yellow low impact events. I only looked at the pairs that were of interest to me, but always the dollar. And when I was trading Forex, it would be the euro dollar, the pound dollar, and the US dollar, and only medium impact and high impact news drivers. And I would toggle the little gray box because it would tell you bank holidays and things like that. But other than that, that's pretty much what I would use for an economic calendar. The review of what I thought would come the previous day. So in other words, whatever I thought my analysis would see in price delivery, for instance, what did I think was going to happen in euro dollar? Okay. Or what did I expect to see in E-mini S&P before I laid down? Okay. I have to revisit that, because while I was sleeping, bombs could be dropping somewhere, a new virus gets released, some kind of boogeyman, narrative gets put in motion, or just simply, a collapse of some kind or something that I didn't expect. And I was wrong in my analysis. The market has done something that I didn't expect and I was wrong. So I have to recalibrate myself and say, okay, what did I expect before I took the nap or before I went to bed? And then when I go into the economic calendar, I have that reminded, because if I expect something to come into the marketplace in terms of volatility, that's what the high impact and medium impact news drivers are for. We want to know when it's likely to increase in volatility. Okay, it's one thing to be like in an earnings season. Like in earnings season, futures, they get wild many times after the close. Okay, and we also know that in Forex, we don't really have earnings season, but we do have economic drivers that come out and they're set to a specific day and time, much like a TV guide. Okay, I'm a child of the 70s. I was born in 1972. And when we grew up, all you young guys and gals out there are used to having the TV guide or the guide on your remote. You push your button and it tells you what's on TV right now and what channel. And you can scroll ahead in time and see what's on. We only had that luxury with a little magazine, and it was a TV guide, and it was published every week. Well, these events or not topics, but these events and or opportunities in trading are basically scheduled like TV programs. Okay, your high impact and medium impact news drivers are scheduled well in advance. Like you can see 2-3 weeks from now when these things are coming. So you're not surprised by it, or you shouldn't be. Okay. So by having that understood and what days of the week are likely to create these increases in volatility, so you know what that volatility is going to bring with it, the strong likelihood of manipulation. And that's one of the key factors or ingredients to what we're looking for smart money. We want to see some type of manipulation. And I'll get to what that manipulation should look like in a moment. But I'm referring to the economic calendar, making sure that I'm in front of the charts for the right reasons, and I'm following the right market. So if you're a Forex trader, you want to be looking for your pairs that have the currency news driver that has a high or medium impact news driver coming out around it. It'll tell you the time. And most of the time it's 8:30 in the morning, or if it's US based, it may be something like 9:30 or 10 or 10:30, like for crude oil inventories. And you can trade Canadian dollar, just on that report alone. But referring to your previous session or before you went to sleep's analysis, is that still hold true? Or does it hold true? Or has something changed while you were away from the charts? If it hasn't changed, then you go through the process of trusting it. And what type of analysis would that be? Well, number one, I start everything on Saturday. And I look at what I think that weekly chart's trying to go to. Is it going higher or is it going lower? I'm not trying to predict Friday's closing price. I don't teach my students to try to predict the Friday closing price. Okay. So many folks have listened to me, taken things out of context, and spread so much misinformation about what it is I do as a trader, how I teach as a mentor, and what my students are focusing on or should be focusing on. They have made so much more confusion. And this is another reason why I hate when people try to teach my stuff, because you don't know what you're doing. Watching a video, listening to a video series, you don't know. And just repeating what I'm saying, you don't know how to answer a question when someone gives it to you. How do I know? Because those same people that are running mentorships are asking me the questions in my forum so they can answer their customers. Yeah, I know. So if we know that the weekly chart is likely to go higher. Now, when I say if we know, how do we know? Well, we don't know with 100% surety that it's going to go up or down. Our analysis is never guaranteed. That's why I have to have stop loss. But I want you to think about how when you watch me trade these intraday movements, and I'm on a 1 minute candle. Okay, number one, I'm canceling out all the arguments from the Goldman Sachs boys that say it's just noise and there's no pattern. Okay, there's no consistency or continuity found in lower time frames. These are people that don't know what they're talking about. And you've seen now students and me do this consistently with precision. But what I'm showing you is where I think the market's going to go to, the draw. Okay, that's the first question you need to address on Saturday, or if you do your analysis on Sunday. Some of you are probably listening to this after church. That's fine. But whatever that day is on the weekend, Saturday or Sunday, that is the day you're focusing on. Where do you think that next candle, when we start trading on Sunday evening and the markets open up, is the market going to expand, not close high or low? Is it going to expand? Is the largest portion of expansion in that weekly candle? And what do I mean by that? If you were to measure the highest high and the lowest low after the week closes, okay, was there more expansion upward or downward? That's the question that I teach my students to aim for answering on the weekend. You're looking for that. Okay. That gives you the absolute strongest bias filter you'll ever fucking find. Okay. Because what you're doing is you're patterning it off of large institutional flows. Ooh, what does that mean? Well, large institutional flows are big funds, big hedge funds, big deep pocket entities. Okay. And they are not trading on 1 minute charts. Okay. They can't put their size into the marketplace on a 1 minute candle. So they require weekly and daily levels. And that order flow that comes through that time frame, that's the elephant. That's the trail of elephant footprints that we're looking for. And smart money is a big elephant. It's lumbering. Okay. It has to take a long time to work in its orders to get into a position. Not the start of a position. Obviously, any position entry that constitutes their participation, obviously, right? But they can't put all of the size that they want on just in one trade. Like you go in and put in your 10 lots or your 5 lots or whatever, and it's done in one clip. Boom, it's done. They don't even break the order up. But large entities and large hedge funds, they have to break their orders up and they scale them in. So they're requiring a longer term price swing. And we derive that from the weekly chart. So the weekly chart, the only thing we're trying to do is capitalize on focusing on the next expansion on that weekly candle, removing the importance of knowing how it's going to close. We don't care. We just know that if that 1 minute candle that I show you example after example after example of how the market moves from a order block or runs out liquidity and runs for buy side liquidity, whether it be a single high or a relative equal high, that draw on liquidity is the focus of where I think price is going to go. I'm holding that trade until I'm stopped out or it reaches that target, the draw on liquidity. So for the sake of argument and understanding, let's just say that we believe that 1 minute candle that we are trading in is bullish and there's buy side liquidity above relative equal highs. When a trade is entered, or for instance, when I have entered a trade and you watch these videos pan out where the market just keeps going up and up and up, and it might have small little retracements, but it ends up going to where I'm aiming for and my limit order gets hit. Every individual 1 minute candle, think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups. Apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. It doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. And it doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week. Because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown because I'm not opening myself up to potential losing trades with maximum leverage. Just because I'm good and nimble intraday, I'm cognizant that I can be wrong. So I build in these safeguards as best as I can and still be able to engage a short position if I'm in a buy model. But I'm not going to hold on to those shorts very long. I'm going to pick the easiest short direct run to a target and be done with it. And it might go many times farther than where I get out at. And I don't care because I'm going to go right back into looking for the next run on a buy side. You see what I'm saying? I'm filtering out the best of the best. But if I want to participate in a bullish market but sell short, I'm building in all of these ideas that would limit my exposure but still allow me participation. But also reminding myself I'm selling short in a market that I know is more likely to go higher. So I don't want to overstay my welcome. And what does that mean? Holding on to a trade too long or turning it into a swing trade. Or, oh, I was wrong about my weekly analysis. So now I'm going to hold on to this longer and look for even bigger objectives and move my limit orders down farther. And then have it turn against me and stop me out. Even if I've taken partials, I don't like that feeling. I like being out when I want to get out, and I don't mind leaving some meat on the plate. Everybody's got to eat, right? So you're referring to that weekly chart and defining whether or not you're going to be in a buy model or a sell model. And that, again, is defined by, do you believe the largest expansion from the open is going to be up or down? You're not trying to predict that weekly close. That's very liberating. When you come to terms with that, it's not complicated. All you're doing is you're subscribing to the same things that we look for in these intraday charts when the market's still drawing towards a old high or relative equal high, or if you're bearish, let's just say the weekly candle, you're expecting it to go down, the larger expansion going down, because it has recently, in recent weeks or in months, it has taken buy side and it's been dropping. And you can see clearly it's reaching for an old low, or it's about to reach into an imbalance, a buy side imbalance, sell side inefficiency. If it hasn't reached into it yet, then that means what? I'm going to side with the likelihood of the next weekly candle or the one that's about to open up tonight. And I'm not saying this is the case for this particular week. I'm just giving you the routine as what this topic is. Then in those instances, I would be in a sell model. That means I would be doing the largest position in leverage on my shorts. If I'm selling short, I'm going to be willing to use the largest leverage that's available to me. But if I go long anytime during that week, I have to be at 50% or less, whatever my largest maximum leverage would be if I was going short in a bearish week. Okay, very, very important. Very, very important. Those things helped me a lot in my 6th and 7th year. Once I figured out what I was trying to do, that kind of kept me from wrecking myself, because it would be harmful for me to just, I guess not, no, to eliminate the idea of getting drunk with the volatility of buying and selling, because I can do both just about any market condition, unless it's a one-way straight, rip rate from like a CPI type event. you're not doing both directions in that. With those instances put aside, I can buy and sell in a market condition pretty much intraday. I can do both sides. But just because I can, does it mean that I should just do it because I can? No, I want to maximize when it's on the right side, when it's in line with that weekly expansion, because I'm in line with the large flow. Large institutional order flow on the weekly chart, if it's bullish, or if I'm anticipating it to be bullish, I want all of my emphasis on being long and the leverage behind those trades to be at the maximum there. I don't want to be maximizing my risk and use the largest leverage in a time when I know in my analysis that it's likely to go higher based on the weekly analysis. I don't want to be going short with the largest leverage, because what I'm doing is I'm inviting the market to whip my ass and to do it the best way it can with the maximum effect. So I want maximum effort on my side. I don't want maximum effort on the risk side, where it could punish me, much more than I would want to suffer. So that's the reason why I do that. But when I go through the economic calendar and I remind myself of what I'm looking for and when the volatility should come into the marketplace, when does those high impact or medium impact news drivers come in? and then I'm waiting for that to occur. If my weekly analysis is aiming for or indicates to me through my own interpretation that it's bullish and I'm in a buy model, I prefer to see some kind of bearish drop at that medium or high impact news driver, preferably into some kind of buy side imbalance, sell side inefficiency, or below relative equal lows, or a single 15-minute candle low. Now, 15-minute is my bellwether. Like, I could trade everything in every model that I know. I can use just a 15-minute candlestick chart and do everything I can do. Period. I don't need to drop lower, and I don't need to go any higher. I could just simply just trade off that. That is not an invitation for you to say, okay, ICT said that, so now that's what I'm going to do. Your bellwether might be an hourly chart. It might be a 5-minute chart. It might be the daily chart. It might be a 4-hour chart. Don't let me, as your mentor, influence you and you copycat every single thing I say I do. That's the worst thing you can do as a mentee with anyone. You have to bring your own personality, your own influence, the things that are meaningful to you, your signature, your fingerprints. They have to be all over this. You can't just say, I took ICT's 100%, everything he said verbatim, and now it's mine. It might be for some of you, but I don't want that. I'm not trying to create copycats of me. I'm interested, very, very interested to see how all of you adopt this idea and formulate your own approach using the tools and concepts, because it's all going to be slightly different and you're all going to get a unique result, and you can all be positive. You can all be making money on the same day doing different things. That's the beauty of this. It sounds like it can't possibly be like that, but it's exactly how it works. And vice versa. Sometimes you'll have winning trades and other students that will be doing this very same thing you're trying to do. They'll have the opposite result because they're bringing in their problems, like I mentioned yesterday. So back to the routine. See how easily I could have went down some rabbit trails there. I actually listened. Hear that? I have a bullet list here I'm going through, so try to keep me on point. It's funny, when I have a deadline, like yesterday, my wife said, look, you got to do this. You got to be real quick. And, I just went on and went on without having anything written down. Today, I have the run of everything. She's not here, and she probably won't be home till tonight. And I made a bullet point list of things I wanted to cover. And I don't know. I should have did this yesterday probably, but whatever. So you want to review what you thought was going to happen on the weekly candle. Go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a Forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT? Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where you preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered or better than where you entered. In other words, if you were short, your stop loss is below your entry. You are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you you can learn this stuff in a couple months or a couple weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200 to 1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar for Forex traders, okay? Oh, he's talking about Forex. Oh, yeah. I've been tired of hearing about this S&P shit. Come on, ICT. Come on back home to Forex. Actually, I am home with commodities, but nonetheless. Say you're interested in pound dollar and you think that the weekly candle is going to expand higher based on your analysis on the weekend before the markets even open up. You think that there's reason for that weekly candle to go higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a CPI, or a fair value gap that's above price. Okay, I'll differentiate between CPI and BISI before I close this, because I know some of you are probably chomping at the bit to dial in an ICT on the wire here and ask me what's the difference between the fair value gap, BISI, and a CPI, and could you tell us the difference? And I will. Just give me a second, maybe longer than a second. But once you have that weekly in analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, what is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 30 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use it as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you studied my concepts with the Judah swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said it's 70%, and it's really not. I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chilling on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0-0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish Our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay. That's all bullshit. Everything, all these algorithms is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay. It's New York midnight. That's the opening. Okay. I don't give a fuck. Anybody tells you different. That's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're going to fucking be schooled. So don't talk your shit in your little private little circles, okay, your little fucking webinars, talking all your bullshit because you ain't getting the balls to come here directly. You do it right here and I will run circles around your motherfucking Mickey Mouse ass. Clown. UK boy. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. Now, here is that point of contention that every student of mine has, even private mentorship students. They want the silver bullet answer that says, okay, here we are. We're at the brass tacks. This is where the rubber meets the road. ICT, lay it on me, baby. This is it. Hear that? That's excitement in your voice. You're talking to yourself, and I'm not in the room with you. How do I know, ICT, that I can buy that fair value gap and it won't go below the low? Are you ready for this one? Ready? You get your pen and your paper? Write down this. I don't fucking know. You don't know. That's why you put a stop loss there. Are you fucking kidding me? Yeah, that's it. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. And then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. Done. How's that fucking complicated? It's liberating. You don't have to know. But if it does happen to you adversely, you know what you're going to do. And if it happens again as an adverse effect and you lose, you're done. You're fucking turning the charts off. You're done. That's your morning routine. You're done. You did your 2 trades. You've lost on both of them. You're done. Or the second one wins and you recuperate some of the drawdown, if not all of it, and maybe go into profit. That's the part that's going to separate all of you from the people that stick with this. Because if you can't accept the fact that you're probably going to lose and it won't change anything, it just takes a little bit away from you. Just like it takes away from your fucking gas tank when you drive to your fucking slave job. Okay? It costs you money to go to work, but you don't ever look at it like that. It costs you toll money to get to work, but you don't look at it like that. That's a fucking loss, okay? Your stop loss is getting hit every fucking day. As soon as you start that car up and you're driving down the fucking road, your stops are getting hit. It's costing you fucking money. You got to replace a fucking tire. You got to replace your tires. You got to change your fucking oil. Guess what? That's drawdown, baby. It's all about perception. You're running around with blinders on. You can't do this and not lose money. You're going to lose money, but you have to manage effectively how you lose it and come back from it. So you're going to do one of those two things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if if we trade down to the fair value gap in that low, if it's less than 30 pips. I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. That's it. Isn't that straight to the fucking point, folks? Okay? You young guys, get to the fucking point. You can't get any more to the fucking point than I'm doing right now. I'm literally giving you IPTA step by fucking step, and you're still gonna fucking complain. Whatever. So what you're doing is you're determining if you're bullish in a buy model, you're expanding higher on the weekly candle, you're waiting for opposing price direction at the time of the news driver being released. Okay, so whatever, like an employment number or an economic number that comes out, you're expecting the algorithm to reprice lower, and that's going to get all the retail traders wanting to go short. That's exactly what you want. That is the green light go you're looking for. You want to see something opposed to what you think the weekly candle is going to do at that time of that report. That's manipulation. That's the trick. That's the broken wing trick that the robin does to protect its little fledgling that's trying to teach how to fly. You ever seen that, a robin on the ground? And you see it, it sees you before you see it, and it starts chirping real loud, and it starts putting its wing out to the side like it's broke, and because it wants you to chase it. And once you get close to it, that fucking wing's perfect. It flies away and it's laughing at you. But you don't see the baby it's distracted you from. Well, the market does that same kind of thing. That's a Judas swing. It leads you down the primrose lane. It makes you think you're seeing something that's valid, but it's not. And it catches people that are off side because they're ignorant. They have no idea what the fuck they're doing, and they're chasing excitement. Just like a predator. They want to chase the thing that's running. Well, when the market runs, you think about what that's done. You have all these people that are neophytes. They're traders that have no idea what they're doing, and they're just anticipating doing something next, but they don't know what it is to do because they're looking at these candles forming and they have no idea. But when there's an excitement and it moves really, really fast low, real quick, sudden, what does that mean? Oh man, I'm missing it. FOMO kicks in, fear of missing out on the move. It's already dropped 20 points. Man, it could go 100 points today or 100 ticks today. And I don't care if I missed the first 30. Let me just get in there right now at down 32 ticks. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay. You're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. Remember month 1 in the core content? That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. And they're rushing into the marketplace with liquidity. What are they doing? That big drop that occurs. Let me say this. This might not occur in price. And if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things I would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? Because they want to buy it. They have to have sellers at a lower price. Oh shit, the tumblers are turning, aren't they? Woo! You're getting there, aren't you now? You're learning some shit. Never expected that on a Sunday. Some of you are listening to me in your headphones right now, and you're wondering if the person next to you at the church pew thinking, did he just hear ICT, this holler and whistle? They're probably listening too, don't worry about it. So you're looking for sell side liquidity when you're bullish in a buy model, in a Judas swing that's going lower in a high impact or a medium impact news driver. Or you're looking for a BISI, a buy side imbalance, sell side inefficiency, where it's like a fair value gap, where the candle that we'd be focusing on would be a bullish candle. Okay. So fair value gaps are the classification. Okay. That's the imbalance. And to set this record straight, it is not in any George Engel books. There's a fucking clown out there trying to say that this is taught in George Engel. In fact, I'll fucking prove it to you. I'll thumb through real quick and show you there is no fucking reference to a fair value gap in Winning in the Futures Market by George Engel. Okay. I have the book. You can look at it too. It's on fucking line. It's not in there. $500,000. Find my shit anywhere before 1996 in print or in video, anywhere. You won't fucking find it. Go fuck yourselves. So you're looking for one of two things. If you're bullish, you're looking for sell stops to be rated or engaged. Or if you're looking for a fair value gap, preferably if you're trading Forex, it's preferably less than 40 pips below the market price. In other words, the market price being right before the news event comes out, or preferably below 30 pips. Okay, so that factor further increases. Let's assume if you're bullish and say London, we'll ring in London too, because this is what makes New York better, in my opinion. You have the added benefit of knowing what London has done. Let's now say that we had a previous late session low in pound dollar the day before New York midnight for today's hypothetical trading day. And overnight in London, we traded down below that, and then we had a nice reaction higher. And we drifted back down, and say that drifting back down is inside the leg that was created from the London low to the market price prior to the news report coming out at 8:30 in our hypothetical example where we would potentially be bullish on pound dollar. These things are further amplified in terms of odds in your favor, because now you have that likelihood of the London low of the day is in place. And now you're not going to see much of a retracement lower in that leg because they don't want to get close to that low. It's already locked in. So they're going to be reaching for a higher time frame buy side liquidity pull, or where that weekly chart's reaching for. It may not reach for it and arrive at it that particular trading day. It may require another day later in the week, because we're looking at a weekly expansion. The weekly candle is generated over what? The course of the week. That doesn't mean that it can't happen where the largest expansion occurred on that one single day, whether it be Monday or Tuesday or whatever one particular day it could have been. All the movement can be done with a report day, and it could be quiet, before or after that particular event. So you have to have all that factored in, which is why it's important to only be focusing on medium or high impact news drivers, because you will be less likely to miss the moves if you do that. Now, it doesn't mean you can't trade on days without high impact or medium impact news drivers. It just means that all things being equal, and whatever's in motion will tend to be in motion until we get to the report day. Or in layman's terms, if it's been bullish and a buy side liquidity pool hasn't been reached yet, if there's an absence of a medium or high impact news driver on that particular trading day, I'll still trade long. And that's fine. I just won't push my maximum leverage. I won't pyramid a lot in that particular type of day, because it might not create a lot of movement. So why should I build my positions large? I want to do that. And once I've seen the manipulation, it showed me its hand, like a poker table. Okay. I've seen my player's hand. So now I'm going to play mine strong. I'm going to go all in. I'm going to build and build and build, because I'm on side. I'm on the right direction because of my weekly analysis. It's indicated to me that they enticed the street money to come in going short at a time when I'm looking to go long. And one of two factors I'm looking for. I'm looking for sell side to be taken. If it's too far away to reach for it reasonably, then I'm looking for a fair value gap. If it doesn't have a fair value gap, here's a third. Okay, because just like on roulette, it's not red and black. It's red, black, and green. And green can fuck the whole show up. Green is there is no fair value gap, and the low is too far away to consider. It's beyond 30 or 40 pips below the market price. So what do we do then? You wait. You wait for the market to create another run higher, short-term high. It trades back down, and once it breaks that short-term high, now we have a shift in market structure. Follow the narrative. Do everything I just outlined before. Look for a fair value gap or a run below a low and submit to it. You might have to do a secondary trade with less leverage if you get burned on a fair value gap entry. But that's my 2-trade rule on it. And if I lose on both, I'm done. I have to wait for the PM session, or I just simply stop for the day. That's it. Is that complicated, folks? Now, for someone that's new, now I'm not going to be unreasonable here. For someone that's new, the terms I'm tossing out here and some of the logic I'm saying, if you've been around me for a while, this might seem like, wow, this is really complicated. Just give me a fucking moving average, pal. Give me a moving. It just means that all things being equal and whatever's in motion will tend to be in motion until we get to the report day.
We are not sure.
Or in layman's terms, if it's been bullish and a buy-side liquidity pool hasn't been reached yet, if there's an absence of a medium or high impact news driver on that particular trading day, I'll still trade long. And that's fine. I just won't push my maximum leverage. I won't pyramid a lot in that particular type of day because it might not create a lot of movement. So why should I build my positions large? I want to do that. And once I've seen the manipulation, it showed me its hand like a poker table. Okay. I've seen my player's hand. So now I'm going to play mine strong. I'm going to go all in. I'm going to build and build and build because I'm on side. I'm on the right direction because of my weekly analysis. It's indicated to me that they enticed the street money to come in going short at a time when I'm looking to go long. And one of two factors I'm looking for. I'm looking for sell side to be taken. If it's too far away to reach for it reasonably, then I'm looking for a fair value gap. If it doesn't have a fair value gap, here's a third. Okay, because just like on roulette, it's not red and black. It's red, black, and green. And green can fuck the whole show up. Green is there is no fair value gap, and the low is too far away to consider. It's beyond 30 or 40 pips below the market price. So what do we do then? You wait. You wait for the market to create another run higher, short-term high. It trades back down, and once it breaks that short-term high, now we have a shift in market structure. Follow the narrative. Do everything I just outlined before. Look for a fair value gap or a run below a low and submit to it. You might have to do a secondary trade with less leverage if you get burned on a fair value gap entry. But that's my 2-trade rule on it. And if I lose on both, I'm done. I have to wait for the PM session, or I just simply stop for the day. That's it. Is that complicated, folks? Now, for someone that's new, now I'm not going to be unreasonable here. For someone that's new, the terms I'm tossing out here and some of the logic I'm saying, if you've been around me for a while, this might seem like, wow, this is really complicated. Just give me a fucking moving average, pal. Give me a moving average and a stochastics, man, and call it a day. This is too much PhD shit, piled higher and deeper. No, this is algorithmic principles being articulated in a straightforward manner, right to the fucking point. You asked for this shit. Now you have it. What are you going to do with it? That's what I'm interested in. And then obviously you're just going to submit to the draw on liquidity based on that weekly chart. Now, there are smaller draws on liquidity in the intraday charts, and you see me referencing them all the time. Why do I do that? And why don't I do that with the weekly chart? Because that's the work you're supposed to be doing. How many trades have you seen me share? How many things have I articulated before I even put the trade on? I say, okay, here's the direction I'm looking for because I'm looking at a particular price level. I'll say, note this on your chart. So if it's above the market price when I'm tweeting that, is that bearish? Fuck no, it's not bearish. And there's people still out there thinking, well, why'd you go long? Aren't you bearish? What the fuck would I be looking to go short for if I'm pointing to something 30 fucking handles above the market price? How is that fucking bearish? That's an unrealized objective. It's below where market price is. That means I'm fucking bullish. I'm looking for a reason to go long. It might not be there yet, but I'm looking to get up there. Vice versa. If I say, here, note this on your chart, and it's below the market price, that means what? I'm bearish. I'm going to be looking for something. Looking for what? Some of this shit I just outlined here. Not limited to, but that's predominantly what I'm trying to do. Looking for a way to on-ramp and get a ride to that, okay? Or build a bridge to it. And that's what I do in the morning. Now, it took more time for me to outline it, explain it, give you different well, instances where you might have to contend with certain things and certain factors and weigh out whether or not you want to do something. But by far and large, it cuts right to the meat. Trims all the fat off, all the bullshit. It goes right to what are you trying to do? And folks, let me explain this to you. Okay. If you doubt what I just gave you is not fucking platinum, go back and look at every fucking move in the last 6 months. And you're going to see one of those two instances. And for the assholes to say, oh, but it didn't work here, use the alternative things I've told you and you'll get it. Period. If you lose on the day, you must consider using half of what you risked in your next trading day, whatever that trading day would be. If it's the next trading session, if it's the next trading day, if in other words, if say you were trading 10 contracts in the S&P and you lost, okay, on your first trade, then you drop down to 5 contracts on the second trade. If you lose on that, you're done for the day. You cannot take another fucking trade. I don't give a fuck about 5 trade fucking Larry down in fucking Texas, okay? You stop. You don't have the control factors that is required to stay solvent right now. You're learning. So don't be doing this. I need to do this because this guy does 5 fucking trades. He's got Trump coins. He's flipping fucking quarters. Fuck that shit. You have to limit your exposure. You have to do that now in the beginning, because if you don't, you're going to develop bad habits, or you're just going to blow your fucking account, and you're going to discourage yourself before you even give yourself a real chance to do this and succeed. But if you take 2 trades and they both lose, you took one at 10 lots, you lose. You take one at 5 lots. That's half of what you leveraged on your first trade and lost. The next trade, you're taking 5 lots. If you lose on that one, you're done for the day. If you win on that second trade, regardless of what the win is, you're done for the fucking day. You do not trade in the PM session. Done. But Michael, shit, you don't fucking trade again. You won. Leave it there. There's other trading opportunities. Stop fucking thinking that one trade idea, that one particular trading session is the be all end all. That's your fucking career. You're trying to encapsulate your entire fucking lifetime career in that one trading day. The fuck is wrong with you? Stop thinking like that. That's what every neophyte retail losing fucking prick does. I'm telling you, because I did that same shit when I was 20 years old. Stop. You have to expand your expectations beyond that right now moment. How is the decision you're about to make right now going to impact your career? Is it going to fucking end you? Are you going to invite the ending of your career in that one trading session, that one trading day? Because that's what you're really fucking doing when you break these rules. So when you break them, don't fucking cry to me. Don't you dare send me a fucking tweet saying I didn't listen, because I don't want to see it. Because I've given you reasons now how to avoid it. I've given you the logic on how to avoid it. But if you take in one trade at 10 and you lose, you take another trade at 5 contracts and you lose, you stop trading. Whenever you trade again, whether it may be the next trading day or next week, say it happens to be on a Friday, okay? My best advice is if you had a winning week, don't trade on Fridays, because you'll regret it. If you lose, you're going to want to get back to what you had as an equity high for the week in such a short little period of time. And the market generally tends to get real quiet towards the end of the Friday week close. And you'll think you see shit in the charts and they won't be there. And you'll lose more. And you'll go into the weekend hating it, because either you gave back the weekly gain or a large portion of it, and you could have been feeling good about it on the weekend, saying, you know what, I didn't trade on Friday. I had a good week. Why push it? Why? Why the fuck do you need that? Because you're trying to increase your social media equity curve, and that's a fucking loser's game. Don't do that. It's about making fucking money and consistently keeping it. Fuck their opinion about you or me. Who gives a fuck? Do you think any of this shit that these people fucking say about money's changing anything? It hasn't. So don't worry about it. Don't factor any of those fucking things in. Keep your results. That's the focus. And follow the fucking rules. But whatever that next trading day is, whether it be the next trading day or the next week, on a Monday, if it's been Friday, you did this 2-day or 2 losing trades in one single day. What would you trade with if you lost 10 and 5? Well, you can't do 2.5. So just do 2 contracts. And you have to trade that 2 contracts until you make 50% of what you lost when you lost on the 5 contract losing trade. Once you get back to 50% of that, now this is the highest form of what I do. You shouldn't, in the beginning, you shouldn't do this. You should recoup the full loss that you took at the 5 contract loss. And then at that point, then you can go back to trading 5 contracts. And when can you go back to 10? When you make what that losing trade was when you lost on 10 contracts. You have to be organized. You have to be diligent about keeping records of what you did, how you lost the money, and how do you build it back systematically, soberly. You're not trying to go out there and just roll the fucking dice. It's not fucking Las Vegas, folks. You got to go in here with a principled mindset, knowing that you can lose your fucking ass. Don't take stupid risks. Don't guess. If it's not obviously in the chart and if the conditions aren't ripe where the production of a result that is favorable isn't likely and more in your favor than not, you don't fucking trade. You don't do that. You simply observe. And if you don't know when that is, you haven't been studying and backtesting and tape reading long enough, because you're going to know when it's obvious for you to get in. Right now, you're all just itching to get that feeling of winning the fucking lottery like it's a scratch off. That's dumb. That's a loser's mindset. You don't do that, folks. You don't do. Traders that make money consistently, they don't fucking guess. They don't guess. We know exactly what we're fucking looking for. We're waiting for it. If it doesn't materialize, we sit still. And we don't give a fuck about Tom, Dick, and fucking Harry on social media and what they're claiming they did. Does that make sense? Has anything I've outlined here seemed overly complicated, except for the folks that don't know my terminology? Or if you're too green and have never really looked at a chart and understood the references of the weekly chart versus an intraday chart, I understand then it would go over your head. But if you spend time with the content that I've put on my YouTube channel, you come back to this video or come back to this discussion or this recording. And everything I just outlined for you is a fucking pathway to the fucking bank. It's consistent, folks. What I just outlined here today, you'll get this at least 2 times a week. And you only need one. You only need one to have a career. One winning trading day. And if you stopped, that's a career. See, some of you see what I do against these people that talk shit about me. I'll put example out just every day. Boom, 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 boom. And you think that's what ICT wants me to do. No, it's not what I want you to do. I don't want you to do that. What I want you to do is find your unique model that fits you, that fits your risk appetite, how you are comfortable with trading, your frequency of trading. And then live there. Bloom where you're planted. See, there's a lot of things I'm never going to fucking teach you folks, okay? I'm not going to do it because what I've taught already has been abused. And there was other things that I was never going to teach you anyway because I'm not permitted to teach it to you. But you don't need to know those things, but I will absolutely showcase that shit in 2023. You got no idea what I'm about to fucking show. But you don't need to try to keep up with that. Just because you're my student, you don't need to do that. My interest, my whole fucking reason for doing this is I want to see you all succeed and see beyond your paychecks. I want you to have that feeling of knowing that you have something extra. Because that little bit of a help each month goes a long fucking way. When I was a young man, I'm gonna give you a little bit of a rant here, and then I'll open up for 5 questions. And please don't give me, I got 3 questions real quick. No, you got 1 question, and now I'm moving on. When I was a young man, and I moved out of my aunt and uncle's house, I was paying room and board with them $50 a week, and they more or less were like, "Hey, we were trying to give you a helping hand, not let you sit here and get rich." And I was like, okay, well, that wasn't the result of our conversation and where I was thinking we were going to go with this, but I felt uncomfortable. So obviously I had to move out. And I didn't know a lot about life in general. I had a very sheltered childhood. I didn't know much about many things at all, really. And when I was living by myself, The rent wasn't all that expensive. I think it was like $416 a month for a 2-bedroom apartment. And buying furniture and buying things for the house and stuff, it was awkward for me because I didn't know how to pick shit, and I was single at the time. And I was afraid if I bought the wrong furniture and if I started dating someone, they wouldn't like the furniture. And then it was because I'm obsessively compulsive. It was very, very difficult for me. And all these little decisions, these little things that I had to contend with would be a factor in my trading. Like these things, like I would be thinking, am I buying the right fucking color couch? Is that rug in the kitchen by the sink? Is that the right fucking color? Because if I meet this girl I'm trying to meet and she comes over here and she sees this fucking rug and she says anything bad about this fucking rug, I'm burning this motherfucking rug. Okay. The whole time I'm watching crude oil. Okay. The whole time I'm watching gold futures markets. Okay. I'm doing all those things and I'm worrying about this stupid shit. So I know if I had to come back up through this stuff, the climate that we have right now, where things are hard, folks, these markets right now, these are the hardest market conditions I have ever traded in. 30 years I've been around this show. In the last 3 decades, this is the hardest time to be a trader. If you are profitable and you're consistently profitable, you know what? My hats are off to you. I'm telling you right now, this is where you're separated. Like this is the division. If you can find profitability in these types of markets right now, you're a fucking amazing trader. You controlled yourself, you mastered yourself, and all of you, regardless of whatever style you use. I mean, I don't give a fuck if it's something outside of what I do. I'm not the only one that can make money, obviously. But my opinion about how you should learn how to read the market, I'm biased in that regard. And everybody has their own opinion. Everybody that has a course, everybody has a service, a program, they're all going to say they're the best. Okay. I get it. But anybody that's able to find profitability right now in the last 2 years, and you're consistently able to do so, you should be very proud of yourself. Because I'm telling you, I've never seen a market environment like this where something so trivial that can come out right at any time and the market goes to shit, unravels completely everything that you think you see in the marketplace. And you have to be very, very nimble. And one of the concerns I have going forward, and this is like one of the things I'm observing and studying, proficiently, or not proficiently, profusely. I think it's the term I'm looking for, profusely. Obsessively, let's just say it that way. I'm looking to see, do we deteriorate even more? And my obsessive compulsive disorder is flaring right now because this is where I would be putting the control M in and going back and editing out and then now saying it the way I wanted to say it. But I want to see, do we deteriorate more going forward? Does it get harder to trade? Or are we working ourselves out of those kinks in the marketplace where it's been very, very challenging, very, very difficult? Now, when I say that, obviously you can see that I can find setups and their precision is still there, but not to the degree that it was prior to 2019 and that type of climate. I want to see it come back because if I can get that in 2023, you're going to see world history. But you could still see world history with this climate too. I want to see a little bit more participation from the group that I have created in terms of students, because it's tricky. It can present opportunities in the charts that may or may not be there, and it's very difficult for as an educator. I know what it's like to see potentially a setup, but if you have ignored what I've outlined here and talked about at the beginning of the space where I referred to the weekly chart, If you look at that weekly chart and you ask yourself, okay, forget that it's a weekly chart. Where does it look like it's reaching for? It's going to keep moving up or keep moving down until it gets to a specific level. What is that level? If it's going up, it's going to go to an old high because there's buy side above that. Whose buy stops are up there? Large funds. There's a reason for it to go up there. Okay. It's not buying pressure that's leading it there. The algorithm is just drawing up to that. When it gets there, it doesn't know that traders have paired themselves with those orders. It doesn't have that understanding. It just knows that that's where they are going to be residing. The algorithm doesn't know where your stop is and doesn't know where my stop is. It knows where every pool of liquidity would be, which is common sense. It's above old highs and below old lows. And whatever has happened recently, sell side's been taken. Okay. Make it real simple, ICT. What's it going to do? It's going to go for an imbalance above market price, which would be a SIBI. And I haven't forgotten. I told you I would differentiate that. It's going to reach up into that. Or if it continues through that, that will be your first objective to get into that SIBI, but then trade to an old weekly high to tap into buy side above that weekly high. Then we sit still. We wait. Because what are we waiting for? We don't know if it's going to reverse there, and we don't need to fucking know. You just wait and see if it does. If it doesn't and it starts to continue more, fine, no problem. You continue with the buy side and you continue looking for what's the next draw on liquidity on that weekly chart. That's the number one principle for knowing what daily bias is. Why should that weekly chart be going anywhere? What's it reaching for? And reverse everything I just said for when it's bearish. If we have recently traded into a SIBI and moved lower from it, and we haven't taken out a short-term low or trade into its nearby buy side imbalance, sell side inefficiency, the fair value gap that would have a green candle or bullish candle in between the two candles that would frame a fair value gap. If it hasn't traded down into that yet, that's your draw on liquidity. So until it does that, I'm thinking I'm going to sell model until we get there. Isn't that fucking easy? Isn't that easy? You need fucking harmonic fucking patterns on your fucking chart to trade. Why can't you just do this? You need all these moving averages and fucking indicators and shit on there. No. The things I do are not complicated. Understanding the language so that way I can communicate what it is that I'm looking for in terms of myriad of opportunities. I have lots of approaches. I have lots of tools and concepts. Because guess what? There's lots of fucking opportunities out there. And they're not always cookie cutter. So you get these 20-year-olds, oh, ICT's too complicated. He's got too many concepts. He's got too many tools. He's got too many. Because I'm a fucking well-rounded trader. I've been around for a long time. I got a lot of fucking weapons in my arsenal. And the longer you do this, you'll do it too. You'll have one choice set up, one weapon of choice that you love using, your fucking bazooka. Okay. Mine's a 50 caliber Barrett. Okay. That's my one shot, one kill. I look for that each week. If I don't have it, no problem. I'll pull out my fucking 9mm and plink fucking shit. That's no problem. I can still take shit down with that. But I go in looking through my scope on my 50 caliber with what I just outlined right here. I don't need a fucking video to do this. I can explain it to you. And when you're listening to me and you're considering how you do your routine and what you've not been doing and versus something like this and how simple it is. It takes me longer to talk about it, even condensing it in the beginning, than it does to do it. And you make that a pattern, a routine that you do every single week. And in the beginning, you don't go in trying to predict it because right now you now have it. And the worst thing you can do tonight is, okay, the market's going to open up. Fuck it. I'm going in all in. I'm going to get funded, or I got a funded account. I'm risking it all. He's just told us the secrets. He spilled the fucking beans. I'm going to go out there and I'm going to get it. Well, you're going to get it. All right. You're going to get fucking creamed because you're trying to do something you don't know how to do yet. So now, since I've shared this with this community and everyone listening, I want you to go forward until February. Do no trades with this. Don't do any trades at all. I want you to use what I just outlined in this space, study it, and then you determine whether or not there's any validity to what I just taught you. Don't take my word for this. Don't believe any fucking thing I've said to you here or anytime anywhere, because everything I've said has always been an invitation for you to see what I've said is the truth. You'll see it in your own charts and your own results. You will see it. And it won't matter what anybody else says about what you're learning, because you'll know it's real. And nobody can take that away from you. And the feeling of knowing what it's likely to do, and it fucking paints in your own chart real time, and you watch it come to pass, that's a feeling like, fuck. That's like knowing the winning lottery numbers every fucking week. Speaking of that, have you noticed the Powerball? I'm not a big lottery fan, but I did like the idea of it going up to $2 billion. And I told my wife, I said, they're gonna pull some fucking shenanigans. And they fucking did. They didn't even do a drawing. They said there was an issue. Oh, there was something wrong with the fucking the counts. They had to do another count in some state or whatever. And we'll get back to you. Your tickets are stamped for that drawing that day. Okay. And then they don't even do a drawing. They said, here was the winning numbers. We did some other drawing, but it wasn't televised, and we have no record of it. And here it is. And somebody won it in California. Oh, is that what happened? Some motherfucker in California got that $2 billion. But guess what? It's been weeks since then, and the Powerball's still at 40 million. You think people are waking up to that saying, fuck you, Powerball? It's rigged. It's all fucking rigged. But the Mega Million's like 300 some million, because they're boycotting Powerball because it's all fake. But here's the thing, they're all the same. They're all fucking rigged. They're fucking fake. They're not going to fucking pay $2 billion to somebody in the fucking world, okay? Owing some Mickey Mouse fucking shit. $2 billion? Get out of here. Get the fuck out of here, man. But anyway, it's time for the 5 questions. Let's see who's on the list here. Now, I'm going by, the person that's at the top. And when I look at this stuff, it'll say here's the question or whatever, or the person asking a question. Oops, let me see. Let's see if I did it wrong here. It says I got 19 requests to speak, now 20. And I don't recall how to, because all I'm seeing is everybody. Hang on here. Give me a second. It did say 20, but now I'm on the page. It says request, and it says 0 requests to speak. And I know that's not true because of this salt. Okay. The first person here is Panache Graham, and I'm not about to pronounce that last name, so I'll do it wrong. So you got one question. Can you hear me? Can you hear me? Hello? You're on the air.
My name is Panache Gorege, and I'm from Zimbabwe. My question is concerning Forex. I've been studying your mentorship. I see 2022 and did the core content. So I want to ask, you seem to be a bit off with Forex. Is it okay for us to continue studying, the content that you're offering us on Forex? Or
So I'm going to replay the recording of the trading price action. The most important part is when ICT is describing bias, how you frame bias, how you go into a session. So this was the Twitter space recorded a few years ago, 2022, but you see it has applied to last week's trading. It's 2025. A week of 10 to 14th. Basically, let's continue listening again.
Oh my goodness. Two Twitter spaces in the same weekend? The end is near. That's the only explanation. The end must be near. Well, good morning. Good morning, everyone. So you're probably asking yourself, how on earth did he find a way back on the airways? Well, my wife decided to go with her family members to the outlets for shopping. So that's what's given me the opportunity. I said, well, you're getting to do what you want to do. Can I get on there and ramble on ICT? So, ramblers, let's get rambling. So we're looking at a topic that many times I've been asked, either in my private mentorship or people in Twitter or people in the comment section of my videos. When I open up the comment section, they'll ask me, what's my routine? And I've shared my routine on Twitter. I said pretty much what I do, what I eat, how I eat, my meal plans, and what I do throughout the day. That has been thrown into disarray with this whole house move here. There's been things that have challenged that schedule, so I've had to augment and change things. But the painters are done, and we are waiting on the final pieces of furniture, which will be months away from now. But for the time being, we have pretty much everything that's going to be here, at least through the holidays. So it's allowing a little bit of normalcy. I have to put everything together in my trading room, which is all sitting in the middle of the room under a sheet. So once that gets put together this week, I'll give you a tour. So the routine in the morning, I think really what everyone's asking, because they really don't care about, the calories and the meals I eat and how I exercise and what stretching routines I do and all those types of things. That's the boring thing. Nobody's interested in that. But I did share it on Twitter. But I think what they're asking for is, what's my trading morning routine? Like, what do I do in the morning? Like before I sit down in the charts, like what is going through my mind? What do I consider? What are things that are important to me as an analyst? What do I look for as a supportive structure, a resource? What resources do I use? Those types of things. And I kind of want to talk a little bit about that today. And I know I like to be facetious and say, I'm going to have a short one here. I don't know how long this one's going to go, so it might be brief, but I'll open up at the end. I'll take 5 questions because I know a lot of you want to have a question answered. I'd like to know what your routine is. So if you send that in a tweet reply to this, try to be brief or whatever. It'd be cool for the community, and plus, I'm being inquisitive about it as well. But when I wake up, if I'm napping in the afternoon, because I do generally try to take a nap in the afternoon before the PM session in S&P, I will again hydrate. But if I'm waking up for the morning session, the first thing I do is hydrate. I drink 20 ounces of spring water. And then that's important because you have to have, number one, you have to have liquid. You have to have it. Your brain will function better. Your muscles will be hydrated. You'll get less muscle cramps. And generally, I have a banana, and that'll give me potassium, because standing in one spot or if you sit, I don't like to sit because my back won't let me do it. But if you do that for a long period of time, you'll get crampy. And I'm not sure if you ever stood or sat in front of charts for a long period of time and you start getting that crampiness in your lower back or somewhere in your body, or you get a muscle cramp somewhere, you can't focus on the chart. You're worried about that damn cramp that's going off. So one of the best things you can do is start your day with hydration. And then I stretch. I go through a routine of stretching. And that's about all I'm going to do for this discussion here, because everything else is obviously shown in that tweet months ago. But what I do is I refer to the economic calendar again, because when you wake up from a nap, or if you slept overnight and you're getting ready to do your morning session in trading, it's very easy to lose your bearings. You ever wake up, and I'm 50 years old, I've had episodes in the last 30 years where I woke up and literally felt like I was late for school. I haven't been in school for a long, long time, but it's just weird how our minds are so powerful when we're sleeping. And when you wake up, you are in a altered state. Like you're not really awake yet. Your eyes might be open. Someone may be talking to you and you're looking in the direction that they're talking, but you're not really there. So you have to obviously refer back to what it is that you're going to be doing, because you could remember something about an economic calendar event. And I've done this. Okay. So I thought that there was going to be a report due and it wasn't due. And I'm expecting something in the marketplace and then realize, oh, what am I doing? I'm in the marketplace trying to do something and that's not even due out today. Or if I'm waiting for an 8:30 morning news embargo to lift and there's no news coming out. So I have to make the decision. Do I hold on to this trade idea if it's in drawdown and try to get out with close to even, or if I can squeak out a win from it, or do I just cut bait and just take the small loss because I did something incorrect? These are all things I have done coming up. Okay. So if you've ever had that happen, just know that you're in good company, because I'm not ashamed to say that I did those things too coming up. So you have to definitely review the economic calendar. Now, what economic calendar do I use? Well, I used to use Econo Day, and I mentioned that when I was on Baby Pips. And when I went to teaching predominantly Forex, I grew to appreciate and like forexfactory.com's calendar. I think it's easy. It's easy to manage and filter. I don't like looking at the yellow low impact events. I only looked at the pairs that were of interest to me, but always the dollar. And when I was trading Forex, it would be the euro dollar, the pound dollar, and the US dollar, and only medium impact and high impact news drivers. And I would toggle the little gray box because it would tell you bank holidays and things like that. But other than that, that's pretty much what I would use for an economic calendar. The review of what I thought would come the previous day. So in other words, whatever I thought my analysis would see in price delivery, for instance, what did I think was going to happen in euro dollar? Okay. Or what did I expect to see in E-mini S&P before I laid down? Okay. I have to revisit that, because while I was sleeping, bombs could be dropping somewhere, a new virus gets released, some kind of boogeyman, narrative gets put in motion, or just simply, a collapse of some kind or something that I didn't expect. And I was wrong in my analysis. The market has done something that I didn't expect and I was wrong. So I have to recalibrate myself and say, okay, what did I expect before I took the nap or before I went to bed? And then when I go into the economic calendar, I have that reminded, because if I expect something to come into the marketplace in terms of volatility, that's what the high impact and medium impact news drivers are for. We want to know when it's likely to increase in volatility. Okay, it's one thing to be like in an earnings season. Like in earnings season, futures, they get wild many times after the close. Okay, and we also know that in Forex, we don't really have earnings season, but we do have economic drivers that come out and they're set to a specific day and time, much like a TV guide. Okay, I'm a child of the 70s. I was born in 1972. And when we grew up, all you young guys and gals out there are used to having the TV guide or the guide on your remote. You push your button and it tells you what's on TV right now and what channel. And you can scroll ahead in time and see what's on. We only had that luxury with a little magazine, and it was a TV guide and it was published every week. Well, these events or not topics, but these events and or opportunities in trading are basically scheduled like TV programs. Okay, your high impact and medium impact news drivers are scheduled well in advance. Like you can see 2-3 weeks from now when these things are coming. So you're not surprised by it, or you shouldn't be. Okay. So by having that understood and what days of the week are likely to create these increases in volatility, so you know what that volatility is going to bring with it, the strong likelihood of manipulation. And that's one of the key factors or ingredients to what we're looking for smart money. We want to see some type of manipulation. And I'll get to what that manipulation should look like in a moment. But I'm referring to the economic calendar, making sure rather that I'm in front of the charts for the right reasons, and I'm following the right market. So if you're a Forex trader, you want to be looking for your pairs that have the currency news driver that has a high or medium impact news driver coming out around it. It'll tell you the time. And most of the time it's 8:30 in the morning, or if it's US based, it may be something like 9:30 or 10 or 10:30, like for crude oil inventories. And you can trade Canadian dollar, just on that report alone. But referring to your previous session or before you went to sleep's analysis, is that still hold true? Or does it hold true? Or has something changed while you were away from the charts? If it hasn't changed, then you go through the process of trusting it. And what type of analysis would that be? Well, number one, I start everything on Saturday. And I look at what I think that weekly chart's trying to go to. Is it going higher or is it going lower? I'm not trying to predict Friday's closing price. I don't teach my students to try to predict the Friday closing price, okay? So many folks have listened to me, taken things out of context, and spread so much misinformation about what it is I do as a trader.
To a brief pause. Now, when we look at the 1 hour closure, the 10 a.m. candle closure, we are anticipating the bullish price action for the week, but this is not a reversal signature. So immediately the 10 a.m. candle closes, we want to look at this rejection. Where could it be coming to? Then we want to label the order block, which is this high of this 9 a.m. candle, which is also it's like the high of so far of the previous. We want to know, so if we are sellers, we want to reach at least 50% of this range from this high to this low, because 1 hour has showed us rejection. If I'm to indicate that, so next time I have to be aware of these levels. It can act as a 1 hour order block. Let me call it. Order block is down here, but we see we're interested in this high, which was broken, but I'm interested in the bearish candles. Let's label this. So I have to keep alternating between it. This is 1 hour. I'll call it an OB because on the right time it will be an order block. I didn't do this during the trading, so I want to next time alternate between these levels. And this one I'll highlight it as it happens because I want to mix it with the old levels. So going back to the 1 minute candle, I know that the 10 a.m. candle, even before it closes, I want to be aware of this level that we have broken above it. Okay. Once we go above this high, like this, there is a lot of consolidation right here. This brief consolidation, we expect it to act as support for price, and we don't. These brief consolidations act as support for price when you study price action more and more. So this kind of reversal has been common. Also happened on Friday, as we are going to see. What happens is that at a key level where I anticipate a reversal, the moment price puts in a high, we want to see a sweep of liquidity. How do I mean by a sweep? This is a sweep of liquidity, like I call this a restriction endonuclease candle, because you look at DNA, the structure of DNA, to draw the DNA molecule like this. Like DNA has strands, okay? So I'm teaching you some science now. Now this is the structure of DNA with the various molecules, okay? So what happens is that on the DNS trends, so this is not science, but it helps you to understand the science between the trading, okay? On these DNS trends, we have interconnections, okay? We have this connected to this one, okay? We have this connected to this one. We have charges. DNA is, remember, like false negative and positive charges. So I like to call, or I like to see people. Okay, let me invert it like this. I wish I could rotate it. Okay, fine, it's okay. Assuming we are on a bus going like this, okay, we are all on a trail. So I want to see someone come and cut us through. I want to see a knife cut us like here. So I call this this enzyme which cuts DNA is called the restriction. There are various enzymes. They are called the restriction, spelling, restriction, endonucleases, endonuclease enzymes. Okay, so I want to see a restriction endonuclease candle. So this candle is one which cuts out all the sellers. Because these are institutional levels, and you watch ICT, he wants you to refer to these. These are decisional points for smart money, people who hedge funds who have huge money. Okay, so we want to see this candle, which is called the restriction endonuclease at this point. This one here, and now make it worse. We have immediate rebalance. What do I mean? Like we had our restriction endonuclease candle here. I want it to always be bold. Okay? Now, these are the things you need to observe at these swing points. Today I've learned something new. Whenever you reach the key level here, how do you know that we are not going to reverse? Because we've not taken out liquidity. And at this point, you have failed your stop loss to below this point, okay? Because you're comfortable that even if you're taken out here, we want to see a rip through, and we want to see the market immediately react. But these reactions are weak. These are weak reactions. I want, see, even getting like liquidity up, I want an aggressive sweep like this. And when we create immediate rebalance, at any one point we break below this level. This is what we call immediate rebalance. Okay, this level is so strong. When we break below this level, you can sell and you stop loss below here with a low risk sell. That is according to my observation. Okay, and you're shorting. This is a counter trade because we are bullish. Where is your take profit? You don't anticipate price to go below this point. Okay, now this is a high risk sell. Okay, but here you risk less. But because we are focusing on buys for this session, this is immediate rebalance. In this case, I've doubled it here. Immediate rebalance. Okay, so immediate rebalance. Once we close above, we have taken out all. We have a restriction and the nucleus enzyme. We have taken out all the buyers and the sellers. Then we can sell. We don't need extra confirmation. At this point, we can just go short. And what's the time? If you look at the time, we want to see that this happens after 10:30. 10:30, it is the time when price moves. It will not what? It will not scroll like so. Now, applying what we've learned today, we want to see liquidity sweep, and then we want to see price put in a short-term low, okay, according to ICT. So we want to see price put in a short-term low here. When price puts in a short-term low, we want to buy the next fair value gap, okay? But you follow this and see. Okay, we put in a short-term low, we wait for price to put in a fair value gap. So, but for earlier entries, you sell 3 contracts here, like sell 3 contracts off. Immediately you sell here. So let me push this so I can learn. Now, when price puts in a short-term low, okay, you want to wait for a fair value gap. The short-term low is broken. Like you see, we've taken sell side and then we put in a short-term low. Where is it? A low which has two lower lows. So this is the short-term low. Once this low is broken with momentum, this can be a sell signature. But you wait for price to put in a what? Fair value gap. So when price puts in a fair value gap, you want to mark it. You want to mark this price action. But also because we are at a previous weekly high, most times price will put in a high and then sweep this high to go lower. So that's why they sell here. You don't move your stop loss, but you keep taking partials, okay? So this is a fair value gap, and you can sell short, sell short from this point here. And your stop loss is above the candle that created the fair value gap. So you do not, when you see this sell and this one, do not chase price, okay? And you see, we even created another short-term low. Wait for price to return to the fair value gap. If there is no return, then you don't sell, okay? Because if you sell here, let's say you are selling because you have the previous weekly high immediate rebalance, you want to sell at closure of this candle. Here, it is a high risk because most times price comes at these previous weekly levels that we shall see gold. Price puts in a low and price puts in a high. If we are bearish, it sweeps the low and then comes and sweeps the high, or it can continue down. So do you see how price engineers liquidity at these levels? It will convince people that we are going low. Okay, when it convinces that everyone we are going, so many people will start panic selling because they see this. They panic sell and their stop loss is just above this high. Okay, so once it more people keep selling now, when it breaks this low, now this happens at these weekly levels. When it breaks this high, this low, now many people will start to sell more, knowing that okay, it's time to go up, go down. We're inducing sellers. Remember, we have been bullish for the session. So now more people will keep selling. Price will do now, since we've taken out, like people who have trailed their stop loss up to here have been taken out, who didn't take profits up here. Because for us, we took profits when we saw this immediate rebalance with break below. Our stop loss is just below here, actually below this level. So now these people who are still in, after the stop loss here, they are taken out. Now price will come and take out the sellers also before it can drop. So if we have not sold up immediate rebalance, do not sell. It takes a lot of conviction to sell or buy from a previous weekly high. Now look at this principle. It is the same. If we are bullish and price reaches this high, wait for price to put in a high and wait for price to put in a low. If we are bullish, okay, price will take out what? It will take out the highs. So many people will start buying. When they buy, it takes out the lows before it continues. You see that? If we are bearish, price takes out the lows and then takes out the highs. You see? If we are bullish, you first take out the highs. Now, if at this level we take out the high, then no, the low is the next. Once we take out the low, we can buy. At this level, when we take out the low, then we know that high is the next. After taking out the high, we can sell. Okay? I want you to study these things on this time frame, on these weekly levels. Now, the monthly level is a different story. We'll encounter it with them. So if we didn't be sellers here, we don't try to what? To add more here. Okay? As we shall see. So ICT says wait for price to put in a short-term low. Even this one matches our narrative because we said when price is dropping, it will first put in a low and put in a high. If it is bearish, takes out the low first. Okay? When it puts in a low, then we anticipate that okay, it's coming for our limit order. So immediately we can be sellers here. We didn't sell here, we will be sellers here. And our stop loss is just above the candle that created what? immediately balance. Now, if our objective is not reached, or you have to keep taking partials like here, take pictures, okay? If you were a seller here, because many people have studied us across below here. This partial is at 2.65 hour, and this one is at this candle is always set just above here. This is at 3 hour. So what happens next is that price is going to come, because we observe what happens, to come and take out the what? When you see this, so now we're inducing more people to buy. Okay? Like we have broken above the fair value gap. Okay? There are those people who trade inversions. They say inversion, then they will buy. They will long here. They want to take out this high, but price will literally just stop around here, as we will see. Like this is class key induction of sellers and buyers. Let us see. Oh, sorry. Supposed to be people who have bought here and they have put their stop loss here. They are targeting this high. So for us, we are sellers because we want to reach midpoint of the range. If we didn't reach, and then we don't move our stop loss. I told you. We can wait for price to sweep this low, take out all the early buyers, then we can go long because it's a bullish part. But we put in a low which will be swept. So that's what happens. See that? So I want you to notice where the reactions start. We want you to see how we've taken out the early sellers. This one, our stop loss is just above this candle here. We put it here. That's why I say if you have not sold early, you don't want to be sell. So if we are bearish, we want to see now. Remember, we say we move from premium to discount and we take out liquidity, which has been swept. So these people who have not taken profits here, they will keep holding. They should have taken off profits here, but they are holding for this. So they hold, the price gives them direction, and then you just see what happens next. Now we are at OTE of the range. Notice where it sold from. You see this candle here. This is the smart money manipulation at the highest point. So smart money sold here. You see here? Now, when you see this momentum, okay, and it is breaking below the previous weekly low, we are in OTE of the range from this high to this low. And you can also now go short at the closure of this candle. We can wait for if it comes up. If it doesn't, we just go short. Because I told you that you wait in OTE, you wait for price, put in a high, and see a reaction. Do we react from it? Yes. Now, price puts in a short-term low. Once we break the short-term low, wait for a fair value gap. The same process. We can wait for a fair value gap. We can be sellers at that high, and our take profit is to take out this high. Also, like we shall around here. Let us see what price did. Price came, we tested. Now, if you are on the charts, you just wait for it to retest. Once it turns bearish, you open bullish. When it turns bearish, you just say sell, and we will immediately go to take profit. Or you wait for a fair value gap to be put in. Let us see. We put in a fair value gap, and the first fair value gap, ICT wants us to sell this first fair value gap. Okay, you can add it, because why are we selling? We have targets. People who have bought and they are still holding their positions. Why we reach here? Because we want to give them a chance to think that we are still going up, like we are manipulating them to think that we are still what? Going lower. But in the actual sense, so our stop loss is set below the candle that put in the fair value gap. Our target is to take out these sellers and at least a few pips down. So this is counter trading as the algo is generating liquidity. Okay. I will put at the consequent encroachment of this week so we can have a higher risk reward. Let us see what happens to price. So now price returns. The tip, see this. So now that's why you put your limit order. I think here you wouldn't have been filled with spread. Now what happens now? We take them out, we immediately reverse. See that? We see a reaction after taking out liquidity. What did I see to say? Wait for price to put in a short-term high if you want to buy. We do have a short-term high. That's it. See this? Oh, that is classic manipulation. That's how we trade it. So this one was for inducing people to buy, and this is not a good trade. This is how we hit take profit here, take profit here, take profit here, take profit. For high frequency trading algorithm, you have to be knowing price signal. And at 11, the algo will start what? Sprawling. You want to buy, if you are bullish, you want to buy below here or at this point. You can buy the stops, but if you forecast price, let's see what happened. We wait for price to put in a short-term high after taking in liquidity. Do we have a short-term high? Not yet. Now we have a short-term high. Do we break above the short-term high? No. Even when we have sweep liquidity, okay? You go below. So we see this reaction. Wait for a fair value gap to be put in. Yeah, now we break a short-term high. Yeah, that is step one. We use this placement. Now we want to buy. We wait for a fair value gap to be put in. We put in a fair value gap. Perfect. Now, once a fair value gap is put in, we want to be buyers now. Okay? We want to be buyers below. Now stop loss. Now we can buy here, and this is going to take time because the time is wrong. This trade will take its time. Our target can be here. And let's see what happens. So it's actually better to wait for PM session because this is the end of AM, this is lunch AM. So price comes, taps us. So you see that? You don't move your stop loss to break even because if you move, you're gonna be taken out. And I told you want to be a buyer below this level. So any return below here with a short-term high, fair value gap, wait for a bearish candle. Okay? No bearish candle. If there is no bearish candle, what do? You do not engage because here you're chasing. When you buy here, the price will still come and take you out. That is what happens. When you buy it expensively, the price will come and take you out. So you see why we wait for it to return to the fair value gap? Your stop loss is always below the candle that created the fair value gap. Like if we had our limit order here, and we expect if it is bullish, we do not expect it to go below this low. Okay? But we can be taken out. This can be liquidity to induce higher because the timing is wrong. Okay? See that? You don't want to be a buyer above here, and the timing was wrong. So now at 12, now this is PM trading session. You wait for any liquidity sweep. Okay? Now this is at 12 p.m. The timing is correct. Liquidity sweep, break above a short-term high. You buy any bearish candle. We have one. That's it. This is our buy. Because we have a short-term high, we have a fair value gap, can buy any bearish candle. This one will be buyers at this point. Be buyers. Why? Because we have everything has been made. It's always good. It's actually something I'm missing. After we break above a short-term high, we want to see a fair value gap put in. Now we wait price to react. Does it come? Put in a low. Does it sweep that low? Once it sweeps that low, now we can look for bullish price action. We've not yet confirmed, not yet confirmed. Now, if we start to have displacement high like that, then we know we're in the right trade. There we can try and continue to hold our trade. When the time is wrong, that is what happens. So I think on that time, on Monday, I was not watching these reactions. Otherwise, we induced sellers. Remember that I told you? Put in a high, take the low, then continue up. That was Monday's trading. So Monday, ideally, I got this move, and this move, and a sign out of the charts without getting into the AM session. This was a good trade for PM session. But this trade is something I've made a mistake here. I don't know what. This trade, I said, it is similar to this one. So we need to follow this protocol. We want to see a drop below equilibrium of the range, which is below here, take sell side. Okay, fine. We want to see a reaction below, and we want to see a fair value gap. We want to see a reaction below. Price with a fair value gap. There is no FVG. This is the short-term low. This is our short-term low. If you want to see a reaction and price after, so this is not the reaction here. We want to see a reaction from the level we put in a short-term high. Because here we reacted, we didn't put in a high. So we want to see a short-term high. It is also okay, but this is better. We want to see a short-term high here. Now we want to be buyers when price like breaks above the short-term high like this. Break above the short-term high. Any retracement, any bearish candle, now we can buy, because now this is confirmation that price is going where? Up. Any bullish candle here, our stop loss will always be just below these levels here. So we can buy this bearish candle, and the stop loss is gonna put it just here. The logic is we want to see a reaction after taking out liquidity. We want to see a reaction above, and price puts in a fair value gap. Okay, once price puts in a fair value gap, we want to buy the low. You don't buy here, you wait for price to sweep these lows. Once price sweeps these lows, then you can't be buy. Here it is protected. You see, even here we come, we react. I told you that if you are bullish, you always just buy the stops. Every time we take out this high, we buy. Take this low, we buy. Take this, we buy. This you will see it all the time. If you're bullish, wait for this reaction. Actually, the logic I had in mind is that wait for price to confirm that we have put in a market structure shift, return to the key level, buy. And I return to the key level, take out this high, buy. Stop loss should just be below the key level. And that's a confirmation that first confirmation is this one. Wait for it to return. Oh, that was Monday's trading. That's so nice. I taking a trade in PM session. PM session, let me see. Monday. Oh yeah. So we have expanded like that. What happened on Monday is that failed to go higher to take out this high. We're watching people take out that high. That's why you keep trailing your stop loss. Immediately we go above this key level like that. So now what happened is that in PM, if I need to write something, these same things here apply. Here the buy was here. Or at this time you want to buy the key level. So I'm going to make this bold. In PM session, if we have fish and we want to be involved in, but here you just log off the charts between 11, okay? You don't want to be involved between here because you can easily get chopped and you can lose your money in this period. If you've had successful trades up to 11:30, just exit and come back like at 12 or come back at after PM session. In most cases, the trend which starts at 12 after sweeping liquidity will always continue up to 1:30, then it can change the trend. That will be our take profit. See here, you held this trade and it almost took you off, so which is not good. So next time, you want to buy at the key level. So this is what I'm gonna jump. You want to buy the stops and return to the level. So if you are confident, so you wait for this reaction to occur and wait for it to return. So you want to buy here. Stop loss is just below here. So you put in one order here as you wait for 12 to reach. If this comes again, now here is when you reaction, wait for it to reach OT. Notice how we confirm, which here, and after taking out the sell side here, we come to OB and take out the sell side. This level acts as support, this previous sell side taken out. So you notice how we immediately bought. Talking out this one, we immediately bought from this level. So at 12, that's what we want to be conscious of. This was chasing price. This is what I'm gonna channel. That's where ICT says at the key level we want to buy stops. Always out of stop count at these key levels. This was the sell. Some sell happened in Asia session. So if you didn't sell here, or if you sold here and you didn't take profits here, you just wait for it to return to OTE of the range and give you confirmation. That is after this. was a sell but high risk. So you see, this is your best sell, take profits here, and you hold with the stop loss above here. That's it's trading. If you want to continue trading, or if you missed trades after AM, and even when you see that that is the trading order. Back ICT, listening in.
How I teach as a mentor, and what my students are focusing on or should be focusing on, they have made so much more confusion. And this is why another reason why I hate when people try to teach my stuff, because you don't know what you're doing. Watching a video, listen to a video series, you don't know. And just repeating what I'm saying, you don't know how to answer a question when someone gives it to you. How do I know? Because those same people that are running mentorships are asking me the questions in my forum so they can answer their customers. Yeah, I know. So if we know that the weekly chart is likely to go higher, now when I say if we know, how do we know? Well, we don't know with 100% surety that it's going to go up or down. Our analysis is never guaranteed. That's why we have to have stop loss. But I want you to think about how when you watch me trade these intraday movements, and I'm on a 1 minute candle. Okay, number one, I'm canceling out all the arguments from the Goldman Sachs boys that say it's just noise and there's no pattern. Okay, there's no consistency or continuity found in lower time frames. These are people that don't know what they're talking about. And you've seen now students and me do this consistently with precision. But what I'm showing you is where I think the market's going to go to, the draw. Okay, that's the first question you need to address on Saturday, or if you do your analysis on Sunday. Some of you are probably listening to this after church. That's fine. But whatever that day is on the weekend, Saturday or Sunday, that is the day you're focusing on. Where do you think that next candle, when we start trading on Sunday evening and the markets open up, is the market going to expand, not close high or low? Is it going to expand? Is the largest portion of expansion in that weekly candle? And what do I mean by that? If you were to measure the highest high and the lowest low after the week closes, okay, was there more expansion upward or downward? That's the question that I teach my students to aim for answering on the weekend. You're looking for that. Okay. That gives you the absolute strongest bias filter you'll ever fucking find. Okay. Because what you're doing is you're patterning it off of large institutional flows. Ooh, what does that mean? Well, large institutional flows are big funds, big hedge funds, big deep pocket entities. Okay. And they are not trading on 1 minute charts. Okay. They can't put their size into the marketplace on a 1 minute candle. So they require weekly and daily levels. And that order flow that comes through that time frame, that's the elephant. That's the trail of elephant footprints that we're looking for. And smart money is a big elephant. It's lumbering. Okay. It has to take a long time to work in its orders to get into a position. Not the start of a position. Obviously, any position entry that constitutes their participation, obviously, right? But they can't put all of the size that they want on just in one trade. Like you go in and put in your 10 lots or your 5 lots or whatever, and it's done in one clip. Boom, it's done. They don't even break the order up. But large entities and large hedge funds, they have to break their orders up and they scale them in. So they're requiring a longer term price swing. And we derive that from the weekly chart. So the weekly chart The only thing we're trying to do is capitalize on focusing on the next expansion on that weekly candle, removing the importance of knowing how it's going to close. We don't care. We just know that if that 1 minute candle that I show you example after example after example of how the market moves from a order block or runs out liquidity and runs for buy side liquidity, whether it be a single high or a relative equal high, that draw on liquidity is the focus of where I think price is going to go. I'm holding that trade until I'm stopped out or it reaches that target, the draw on liquidity. So for the sake of argument and understanding, let's just say that we believe that that 1 minute candle that we are trading in is bullish and there's buy side liquidity above relative equal highs. When a trade is entered, or for instance, when I have entered a trade and you watch these videos pan out where the market just keeps going up and up and up, and it might have small little retracements, but it ends up going to where I'm aiming for, and my limit order gets hit. Every individual 1 minute candle, think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups, apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. That doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. It doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week. Because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown because I'm not opening myself up to potential losing trades with maximum leverage. Just because I'm good and nimble intraday, I'm cognizant that I can be wrong. So I build in these safeguards as best as I can and still be able to engage a short position if I'm in a buy model. But I'm not going to hold on to those shorts very long. I'm going to pick the easiest short direct run to a target and be done with it. And it might go many times farther than where I get out at. And I don't care because I'm going to go right back into looking for the next run on the buy side. You see what I'm saying? I'm filtering out the best of the best. But if I want to participate in a bullish market but sell short, I'm building in all of these ideas that would limit my exposure but still allow me participation. But also reminding myself I'm selling short in a market that I know is more likely to go higher. So I don't want to overstay my welcome. And what does that mean? Holding on to a trade too long or turning it into a swing trade. Or, oh, I was wrong about my weekly analysis. So now I'm going to hold on to this longer and look for even bigger objectives and move my limit orders down farther. And then have it turn against me and stop me out. Even if I've taken partials, I don't like that feeling. I like being out when I want to get out, and I don't mind leaving some meat on the plate. Everybody's got to eat, right? So you're referring to that weekly chart and defining whether or not you're going to be in a buy model or a sell model. And that, again, is defined by, do you believe the largest expansion from the open is going to be up or down? You're not trying to predict that weekly close. That's very liberating. When you come to terms with that, it's not complicated. All you're doing is you're subscribing to the same things that we look for in these intraday charts when the market's still drawing towards a old high or relative equal high, or if you're bearish. Let's just say the weekly candle, you're expecting it to go down, the larger expansion going down, because it has recently, in recent weeks or in months, it has taken buy side and it's been dropping, and you can see clearly it's reaching for an old low, or it's about to reach into an imbalance, a buy side imbalance, sell side inefficiency. If it hasn't reached into it yet, then that means what? I'm going to side with the likelihood of the next weekly candle, or the one that's about to open up tonight. And I'm not saying this is the case for this particular week. I'm just giving you the routine as what this topic is. Then in those instances, I would be in a sell model. That means I would be doing the largest position in leverage on my shorts. If I'm selling short, I'm going to be willing to use the largest leverage that's available to me. But if I go long anytime during that week, I have to be at 50% or less, whatever my largest maximum leverage would be if I was going short in a bearish week. Okay, very, very important. Very, very important. Those things helped me a lot in my 6th and 7th year. Once I figured out what I was trying to do, that kind of kept me from wrecking myself, because it would be harmful for me to just, I guess, not, to eliminate the idea of getting drunk with the volatility of buying and selling, because I can do both just about any market condition, unless it's a one-way straight, rip rate from like a CPI type of event. you're not doing both directions in that. With those instances put aside, I can buy and sell in a market condition pretty much intraday. I can do both sides. But just because I can, does it mean that I should just do it because I can? No, I want to maximize when it's on the right side, when it's in line with that weekly expansion, because I'm in line with the large flow. Large institutional order flow on the weekly chart, if it's bullish, or if I'm anticipating it to be bullish, I want all of my emphasis on being long and the leverage behind those trades to be at the maximum there. I don't want to be maximizing my risk and use the largest leverage in a time when I know in my analysis that it's likely to go higher based on the weekly analysis. I don't want to be going short with the largest leverage, because what I'm doing is I'm inviting the market to whip my ass and to do it the best way it can with the maximum effect. So I want maximum effort on my side. I don't want maximum effort on the risk side, where it could punish me, much more than I would want to suffer. So that's the reason why I do that. But when I go through the economic calendar and I remind myself of what I'm looking for and when the volatility should come into the marketplace, when does those high impact or medium impact news drivers come in? And then I'm waiting for that to occur. If my weekly analysis is aiming for, or indicates to me through my own interpretation, that it's bullish and I'm in a buy model, I prefer to see some kind of bearish drop at that medium or high impact news driver, preferably into some kind of buy side imbalance, sell side inefficiency, or below relative equal lows, or a single 15-minute candle low. Now, 15-minute is my bellwether. Like, I could trade everything in every model that I know. I can use just a 15-minute candlestick chart and do everything I can do. Period. I don't need to drop lower, and I don't need to go any higher. I could just simply trade off that. That is not an invitation for you to say, okay, ICT said that, so now that's what I'm going to do. Your bellwether might be an hourly chart. It might be a 5-minute chart. It might be the daily chart. It might be a 4-hour chart. Don't let me, as your mentor, influence you and you copycat every single thing I say I do. That's the worst thing you can do as a mentee with anyone. You have to bring your own personality, your own influence, the things that are meaningful to you, your signature, your fingerprints. They have to be all over this. You can't just say, I took ICT's 100%, everything he said verbatim, and now it's mine. It might be for some of you, but I don't want that. I'm not trying to create copycats of me. I'm interested, very, very interested to see how all of you adopt this idea and formulate your own approach using the tools and concepts, because it's all going to be slightly different and you're all going to get a unique result, and you can all be positive. You can all be making money on the same day doing different things. That's the beauty of this. It sounds like it can't possibly be like that, but it's exactly how it works. And vice versa. Sometimes you'll have winning trades and other students that'll be doing this very same thing you're trying to do. They'll have the opposite result because they're bringing in their problems, like I mentioned yesterday. So back to the routine. See how easily I could have went down some rabbit trails there. I actually listened. Hear that? I have a bullet list here I'm going through, so try to keep me on point. It's funny, when I have a deadline, like yesterday, my wife said, look, you got to do this. You got to be real quick. And, I just went on and went on without having anything written down. Today, I have the run of everything. She's not here, and she probably won't be home till tonight. And I made a bullet point list of things I wanted to cover. And I don't know. I should have did this yesterday probably, but whatever. So you want to review what you thought was going to happen on the weekly candle. Go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a Forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT? Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where you preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered, or better than where you entered, in other words, if you were short, your stop loss is below your entry, you are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you can learn this stuff in a couple months or a couple weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200-to-1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar for Forex traders, okay? Oh, he's talking about Forex. Oh, yeah. I've been tired of hearing about this S&P shit. Come on, ICT. Come on back home to Forex. Actually, I am home with commodities, but nonetheless, say you're interested in pound dollar and you think that the weekly candle is going to expand higher based on your analysis on the weekend before the markets even open up. You think that there's reason for that weekly candle to go higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a CPI, or a fair value gap that's above price. Okay, I'll differentiate between CPI and BISI before I close this. Because I know some of you are probably chomping at the bit to dial in an ICT on the wire here and ask me, what's the difference between the fair value gap, BISI, and a CPI? And could you tell us the difference? And I will. Just give me a second. Maybe longer than a second. But once you have that weekly in analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, what is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 30 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use that as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you studied my concepts with the Judas swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said it's 70%, and it's really not. I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chewing on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0-0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay. That's all bullshit. Everything, all these algorithms is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay. It's New York midnight. That's the opening. Okay. I don't give a fuck. Anybody tells you different. That's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're going to fucking be schooled. So don't talk your shit in your little private little circles. Okay. Your little fucking webinars. talking all your bullshit. You ain't getting the balls to come here directly. You do it right here, and I will run circles around your motherfucking Mickey Mouse ass, clown. UK boy. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. Now, here is that point of contention that every student of mine has, even private mentorship students. They want the silver bullet answer that says, okay, here we are. We're at the brass tacks. This is where the rubber meets the road. ICT, lay it on me, baby. This is it. Hear that? That's excitement in your voice. You're talking to yourself, and I'm not in the room with you. How do I know, ICT, that I can buy that fair value gap and it won't go below the low? Are you ready for this one? Ready? You get your pen and your paper? Write down this. I don't fucking know. You don't know. That's why you put a stop loss there. Are you fucking kidding me? Yeah, that's it. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. Then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. Done. How's that fucking complicated? It's liberating. You don't have to know. But if it does happen to you adversely, you know what you're going to do. And if it happens again as an adverse effect and you lose, you're done. You're fucking turning the charts off. You're done. That's your morning routine. You're done. You did your 2 trades. You've lost on both of them. You're done. Or the second one wins and you recuperate some of the drawdown, if not all of it, and maybe go into profit. That's the part that's going to separate all of you from the people that stick with this. Because if you can't accept the fact that you're probably going to lose and it won't change anything, it just takes a little bit away from you. Just like it takes away from your fucking gas tank when you drive to your fucking slave job. Okay? It costs you money to go to work, but you don't ever look at it like that. It costs you toll money to get to work, but you don't look at it like that. That's a fucking loss, okay? Your stop loss is getting hit every fucking day. As soon as you start that car up and you're driving down the fucking road, your stops are getting hit. It's costing you fucking money. You got to replace a fucking tire. You got to replace your tires. You got to change your fucking oil. Guess what? That's drawdown, baby. It's all about perception. You're running around with blinders on. You can't do this and not lose money. You're going to lose money, but you have to manage effectively how you lose it and come back from it. So you're going to do one of those 2 things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if we trade down to the fair value gap in that low, if it's less than 30 pips, I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. That's it. Isn't that straight to the fucking point, folks? Okay? You young guys, get to the fucking point. You can't get any more to the fucking point than I'm doing right now. I'm literally giving you IPTA step by fucking step, and you're still going to fucking complain. Whatever. So what you're doing is you're determining if you're bullish in a buy model, you're expanding higher on the weekly candle, you're waiting for opposing price direction at the time of the news driver being released. Okay, so whatever, like an employment number or an economic number that comes out, you're expecting the algorithm to reprice lower, and that's going to get all the retail traders wanting to go short. That's exactly what you want. That is the green light go you're looking for. You want to see something opposed to what you think the weekly candle is going to do at that time of that report. That's manipulation. That's the trick. That's the broken wing trick that the robin does to protect its little fledgling that's trying to teach how to fly. You ever seen that, a robin on the ground? And you see it, it sees you before you see it, and it starts chirping real loud, and it starts putting its wing out to the side like it's broke, and because it wants you to chase it. And once you get close to it, that fucking wing's perfect. It flies away and it's laughing at you. But you don't see the baby it's distracted you from. Well, the market does that same kind of thing. That's a Judas swing. It leads you down the primrose lane. It makes you think you're seeing something that's valid, but it's not. And it catches people that are offside because they're ignorant. They have no idea what the fuck they're doing, and they're chasing excitement. Just like a predator. They want to chase the thing that's running. Well, when the market runs, you think about what that's done. You have all these people that are neophytes. They're traders that have no idea what they're doing, and they're just anticipating doing something next, but they don't know what it is to do because they're looking at these candles forming and they have no idea. But when there's an excitement and it moves really, really fast, low, real quick, sudden, what does that mean? Oh man, I'm missing it. FOMO kicks in, fear of missing out on the move. It's already dropped 20 points. Man, it could go 100 points today or 100 ticks today. And I don't care if I missed the first 30. Let me just get in there right now at down 32 ticks. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay. You're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. Remember month 1 in the core content? That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. And they're rushing into the marketplace with liquidity. What are they doing? That big drop that occurs, let me say this. This might not occur in price. And if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things I would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? Because they want to buy it. They have to have sellers at a lower price. Oh shit, the tumblers are turning, aren't they? Woo! You're getting there, aren't you now? You're learning some shit. Never expected that on a Sunday. Some of you are listening to me in your headphones right now, and you're wondering if the person next to you at the church pew thinking, did he just hear ICT this holler and whistle? They're probably listening too, don't worry about it. So you're looking for sell side liquidity when you're bullish in a buy model, in a Judas swing that's going lower in a high impact or a medium impact news driver, or you're looking for a BISI, a buy side imbalance, sell side inefficiency, where it's like a fair value gap, where the candle that we'd be focusing on would be a bullish candle. Okay. So fair value gaps are the classification. Okay. That's the imbalance. And to set this record straight, it is not in any George Engel books. There's a fucking clown out there trying to say that this is taught in George Engel. In fact, I'll fucking prove it to you. I'll thumb through real quick and show you there is no fucking reference to a fair value gap in Winning in the Futures Market by George Engel. Okay. I have the book. You can look at it too. It's on fucking line. It's not in there. $500,000. Find my shit anywhere before 1996 in print or in video, anywhere. You won't fucking find it. Go fuck yourselves. So you're looking for one of two things. If you're bullish, you're looking for sell stocks to be rated or engaged. Or if you're looking for a fair value gap, preferably if you're trading Forex, it's preferably less than 40 pips below the market price. In other words, the market price being right before the news event comes out, or preferably below 30 pips. Okay, so that factor further increases. Let's assume if you're bullish and say London, we'll ring in London too, because this is what makes New York better, in my opinion. You have the added benefit of knowing what London has done. Let's now say that we had a previous late session low in pound dollar the day before New York midnight for today's hypothetical trading day. And overnight in London, we traded down below that, and then we had a nice reaction higher. And we drifted back down, and say that drifting back down is inside the leg that was created from the London low to the market price prior to the news report coming out at 8:30 in our hypothetical example where we would potentially be bullish on pound dollar. These things are further amplified in terms of odds in your favor, because now you have that likelihood of the London low of the day is in place. And now you're not going to see much of a retracement lower in that leg because they don't want to get close to that low. It's already locked in. So they're going to be reaching for a higher time frame buy side liquidity pool, or where that weekly chart's reaching for. It may not reach for it and arrive at it that particular trading day. It may require your routine and what you've not been doing and versus something like this, and how simple it is. It takes me longer to talk about it, even condensing it in the beginning, than it does to do it. And you make that a pattern, a routine that you do every single week. And in the beginning, you don't go in trying to predict it, because right now you now have it. And the worst thing you can do tonight is, okay, the market's going to open up. Fuck it. I'm going in all in. I'm going to get funded, or I got a funded account. I'm risking it all. He's just told us the secrets. He spilled the fucking beans. I'm going to go out there and I'm going to get it. Well, you're going to get it. All right. You're going to get fucking creamed because you're trying to do something you don't know how to do yet. So now, since I've shared this with this community and everyone listening, I want you to go forward until February. Do no trades with this. Don't do any trades at all. I want you to use what I just outlined in this space, study it, and then you determine whether or not there's any validity to what I just taught you. Don't take my word for this. Don't believe any fucking thing I've said to you here or anytime anywhere, because everything I've said has always been an invitation for you to see what I've said is the truth. You'll see it in your own charts and your own results. You will see it. And it won't matter what anybody else says about what you're learning, because you'll know it's real. And nobody can take that away from you. And the feeling of knowing what it's likely to do, and it fucking paints in your own chart real time, and you watch it come to pass, that's a feeling like, fuck. That's like knowing the winning lottery numbers every fucking week. Speaking of that, have you noticed the Powerball? I'm not a big lottery fan, but I did like the idea of it going up to $2 billion. And I told my wife, I said, they're going to pull some fucking shenanigans. And they fucking did. They didn't even do a drawing. They said there was an issue. Oh, there was something wrong with the fucking, the counts. They had to do another count in some state or whatever. And we'll get back to you. Your tickets are stamped for that drawing that day. Okay. And then they don't even do a drawing. They said, here was the winning numbers. We did some other drawing, but it wasn't televised, and we have no record of it. And here it is. And somebody won it in California. Oh, is that what happened? Some motherfucker in California got that $2 billion. But guess what? It's been weeks since then, and the Powerball is still at 40 million. You think people are waking up to that saying, fuck you, Powerball. It's rigged. It's all fucking rigged. But the Mega Millions like 300 and some million, because they're boycotting Powerball because it's all fake. But here's the thing. They're all the same. They're all fucking rigged. They're fucking fake. They're not going to fucking pay $2 billion to somebody in the fucking world, okay? On some Mickey Mouse fucking shit. $2 billion? Get out of here. Get the fuck out of here, man. But anyway, it's time for 5 questions. Let's see who's on the list here. Now I'm going by the person that's at the top. And when I look at this stuff, it'll say here's the question or whatever, or the person asking the question. Oops, let me see. Let's see if I did it wrong here. It says I got 19 requests to speak, now 20. And I don't recall how to, because all I'm seeing is everybody. Hang on here. Give me a second. It did say 20, but now I'm on the page. It says request, and it says 0 requests to speak. And I know that's not true because of this all. Okay. The first person here is Panache Graham, and I'm not about to pronounce that last name, so I'll do it wrong. So you got one question. Can you hear me? Can you hear me? Hello? You're on the air.
My name is Panache Gorege, and I'm from Zimbabwe. My question is concerning Forex. I've been studying your mentorship ICT 2022 and did the core content. So I want to ask, you seem to be a bit off with Forex. Is it okay for us to continue studying, studying the content that you're offering us on Forex, or we should continue, or we should study future indices?
Okay, so if I understand your question correctly, you want to know, because I'm not trading Forex anymore and I have no active interest in returning to it. Should you, as my students,
yes,
should you not be doing Forex and only trade index futures? That's your question?
No, should we study using index futures or Forex?
Well, I'll say this.
Mm-hmm.
If you are interested in Forex still, you can do that. But you should be studying index futures, because the things that I'm teaching in real-time market conditions and the things I'm teaching with my examples and such, you're able to see and study it live right now with me. Like, for instance, if you go back and try to look at a 1 minute or 5 minute chart on TradingView, like 6 months from now or in the past, you can't really pull that data up. So it's important for you to study what I'm showing you in E-mini S&P or NASDAQ futures, because the same thing applies in Forex. The only thing that's different between Forex and index futures is there's a slight beginning time difference. Forex can start earlier, and index futures is 8:30. They both can be used at 8:30, but I can take a trade in both. But using the model, using index futures, if you study that and just simply apply those ideas to the time windows for Forex, they still work the same. But for real-time trading and real-time learning, you should be studying the US 500 and the ES, or the NQ, or the US 100 if you're going to be using like Forex brokerage firms. Studying that actively, you will learn, you'll grow. And I'm not trying to funnel everybody into futures, because it's all going to be a personal choice. And my convictions that are personal about Forex, they're mine. I'm not trying to make anybody not want to trade Forex. I just disclosed why I'm not willing to do it. Does that answer your question?
But so you mean the patterns are the same? If you are trading Forex, you continue studying with Forex and everything?
Yes, they're the same mechanics, the same entry strategy, the same trailing of the stop loss, the same partial. The model itself works in every asset class. Every asset class, whether it be Forex, whether it be commodities, bonds, currency futures, index futures, and I have a lot of students that swear by it in crypto. I don't co-sign that myself, but they say it works there too.
Okay. Thank you very much.
You're
I
welcome.
think
Thank
I'm
you very much.
answered now.
Thank
Okay.
you, sir. Have a good day.
Thank you.
Okay. I don't see another person asking, but I'll wait a second or two. This is very cumbersome. You got a question? Request. If you have a request, are you open to talk? I guess toggle it off and toggle it again. It might be a way for me to see because that other guy just popped up. Yeah, I'm not sure why it's not showing. Okay, now see on one screen it says I have 107 people requesting to talk. But when I click on that, it just shows me everybody that's here. And I don't know how to differentiate from the first person in the list. Or even, there isn't in the list, really. It just shows everybody that's listening. So I'm unfortunately not doing well here in this. Okay. Yeah, see, I don't know why it won't let me. Yeah. I don't know how that last person requested because it popped up on the screen where I says, I have guests open on Twitter Space. And it says that I'm the host. It says co-host 0 with 2 spots open and speakers 0 with 10 open spots. And then below that says requests to speak, 0 requests. And I don't know how to get all of you that are asking me a question. I don't know how to get that to happen because it says I have 129 requests to speak. This is frustrating me. All right, let me do it this way. The first 4 people that tweet to me, I'll try to find you and I'll invite you to ask your question. I just don't know how to do it otherwise. Pro charge move bar, watch a video. Oh man. All right, so here, alter ego trader. How am I going to get that to happen for you? Oh, I see a request. So I'm not sure how you guys how you're doing it. I don't know how to pronounce this name. I apologize. Kashala, you're on the air. Can you hear me? Hello, can you hear me?
Yes, I can hear you. Hello?
Hello.
Yeah, hello. I hear you. Hello.
Go ahead with your question.
Okay, I'm from Tanzania. My name is Kachala, and I have a question to ask about monetary issue concerning with my account and something which I want to trade. I wanted to trade imminent S&P 500 futures, but I only have like $30 account, and I wish I would trade S&P. So, as you, my mentor, I would like to ask if it would be good to.
Okay. Do you think it's good to be a high frequency trader? Oops. I'm sorry. I skipped over one. Grace a. Oh, there's. Oops. I hit the more reply button here. If we work in a job with a 30-day buy and hold restrictions, what is the best way to trade quarterly shifts in today's markets? The way I taught it, and that's the best way. I mean, there's this. I haven't amplified any of my teachings. They are as they are. They haven't fallen out of style, and they haven't fallen into a state of inefficiency. Sir, how to trade indices which are not open full day and always open gap up and gap down? My understanding is you're probably asking about the Indian markets, and I get asked a lot about this. Do I trade the Nifty? Do I trade the Indian markets at all? Does my concepts work in the Indian markets? I personally have no experience, much like I don't have experience trading the synthetic something. I don't know. I'm always asked about it. If an instrument has something synthetic in the name, no, I don't know anything about it. No, I've never traded it. No, I don't know if my concepts work in them. Okay, so I don't know. I don't know how to answer any questions about the Indian markets because I know, yes, they gap a lot, and to me, I have no experience trading it. I wouldn't be able to trade it, and I just don't have an answer for you. So I've always answered the same response to those individuals that are in India if they would supply their intel about whether or not the things I teach work in their market, because I don't personally have any experience with it. I made my funded challenge, and I'm working in a normal job. When is the best time to leave my job? Well, I've always stated that if you have 2 years living expenses, whatever your living expenses are for one full year, you should have at least 2 of that and a minimum of $100,000 equity to trade. And you've been consistently profitable for 2 years. So there's your definitive, in my opinion, that's when you should even consider. Prior to any of that, you shouldn't consider it because you need to have at least 2 years cushion behind you. So that way you're not feeling pressured to take a trade to live off of. That's the conundrum. Most people think they can go out and get a funded account, and you may be funded up to $500,000 or even $1 million in multiple accounts and think I'm padded out. You're not, because if you do things wrong, you could lose the access to those funded accounts, and funded accounts could just stop being a thing. And you don't really have $500,000 or $1 million. You have to have money to live on in the times when you don't take trades or when you are in drawdown. You don't want to be in a position where you're trying to make money in the marketplace because you need to pay bills. So if you are behind that 8 ball, if you will, proverbially speaking, that creates a tendency for traders to be impulsive about doing things in the marketplace when there really isn't an opportunity that's low risk. So 2 years living expense, $100,000 equity, and you have 2 years behind you in consistent profitability. That's it. If you do anything beyond that or less, in my opinion, you're really trying to make it harder than it has to be. And yes, it takes some time, and yes, it's going to take time to get up there. But if you are trading right now while you're working your job, and you can get to the point where you're using a funded account, or if you're trading your own money and you build it up while you're working, number one, you have that ends being met with your job. So you're not having to tap into your profits. You're letting your profits grow, building that nest egg up of $100,000. Okay. And then building up 2 years living expenses. You probably don't have an expense, and I'm taking great deal of liberty by saying this, and please don't be offended if it's not true, but you probably don't live on a $100,000 income. So what is your 2-year living expense? If you're living on, I don't know, maybe 50,000, 55,000, the average median income in the US, that's about $110,000, $125,000. So that's 2 years living expense that you can tap into if you need to pay bills and not have to have a trade to pay them. And then you have your $100,000 equity. But you have to have that 2 years behind you in experience, because if you're doing it before that, you have no idea what you're doing. And you're going to be swayed by all the pressures and the anxiety created by doing it like that. I am based outside US in Asia, and I trade CFDs. It's near impossible to trade FX without burning my account until recently. I switched to trading DAX and US 30. Do you have any current view on these two indices? I don't have a bias on the US equity markets right now. I think we've pulled back inside the range that we recently just had on the daily chart, that long run down low. What we do from here, it might be static choppiness that just keeps us in a narrow consolidation into the close of the year until proven otherwise. That's what I'm expecting. DAX, I never really have an opinion on. Do you think it's good to be a high frequency trader? I don't think it's a advantage to being a high frequency trader. Just for me, because I know what I'm looking for, and I'm short attention span, and I can make decisions on it's shaken out really easy. And if that's the case for you, then you're too small of a time frame. And that's how you evaluate it. If you're anxious at the time frame that you're looking at when you're paper trading and studying price, that time frame is too fast for you. You got to go up to a higher time frame until you find the one that works for you. It might be an hourly chart. It might be the daily chart for you, okay, or anyone else listening. So don't let that be a hindrance, because it's about making money, and you can make money, lots of it, with just a daily chart. It just takes a lot more time for those things to develop. This is the last one. Grant me to speak. I said one question, you give me two. Question one, can you make example on Forex? I have already outlined one in our discussion today, and you can go back through the old data and you'll see many times what I just outlined. That's the part you're supposed to do. That's the work. And can you share those failed setup example and how to avoid them? Again, you'll see that also in backtesting. That's the benefit of you doing the work. Number one, it removes laziness. And I've done more than a typical mentor would do. I'm showing you where to go to find the answers. I'm showing you what it would look like, or explaining what it would look like, and how you would navigate it should it fail. What procedures and protocols would you follow? And you study it and you see, is there any validity to what I just said in this Twitter space? Is there anything valid that constitutes a reason for you to mine or study it further, and or to study it going forward as a forward walk forward test? And that approach is what every student is required to do. I don't make little, let me go on the charts and find one for you. In the beginning, I tried to do that. And that, to me, it wore me out, because if you have just a dozen students and they're always asking you, hey, can you show me an example of this? And can you show me, how about you show me an example where you're having a problem with understanding about it? Okay. That's the problem I have with today's society and my student base, because there's a lot of laziness in that. And I think if you look at every medium of education. There's always going to be this group of students that just simply, they want it easy. They want it right now. And I'm not beating up on you. I'm just telling you, this is how you learn it. Okay. So you go through the process like everybody else does, and you submit to it. And you will find the answers to the questions you're asking, or removing the doubts and the concern about whether things are valid or not. And it's beneficial for you to see when you think you might see it in a chart and it doesn't pan out. How does that make you react? Does it make you come unglued? Do you lose your mind about it all and feel like you're saying, I'm going to quit? Because if that's the case, I'm going to tell you right now, then you are not going to be a trader, because you want it black and white. You want it win, win, win. Don't ever lose. And as much as you're going to probably, if we were talking live and or we were in a room together, you would probably shake your head and say, no, that's not what I'm saying. I'm telling you, yes, that's what you're saying, but you're trying to deny it. You want to avoid the pain of doing it wrong when everybody does it wrong. Every mentor, every profitable student, every profitable mentor, every profitable trader does it eventually wrong, and it will incur a loss. You will lose money. Money will be debited from your account when you do those things. That is the reality of this industry. There's absolutely nothing I have that will absolutely 100% remove the likelihood of that occurrence. It will happen. You can guarantee it's going to happen. You can bank on the fact that you're going to have a losing trade, and it should not deter you. That's the difference. The difference is knowing that these things repeat more favorably over time than they will fail you. You will fail yourself more frequently than these concepts will fail in general, because you're going to interpret it wrong. You're going to see things in the charts because you're manifesting it. You're seeing something because you want to do something to distract yourself. So there's plenty of examples where if you simply pick any market and go back over the last 6 months, and you'll see where there was potentially a setup there and it would have failed, and what you would have done. And if it doesn't pan out again, the procedures and protocols I outlined here. It's trade management, it's mitigation of drawdown, and how do you restore the drawdown? I covered all of that in this space here. So there's no reason for you to ask me or anyone else to show you examples of this, that failing. You can see them, they already happened. And you can see many of them where they panned out. And using the logic, the weekly charts are already there. You can look at what, lasts whole year of each individual weekly candle. Was there more expansion than the upside or the downside? Well, that go into those back studies. Okay. And for instance, let's look at it this way. Let's say the NQ is your study. And I'm going to say this, and I'm going to close the space because I need to get off here. Been doing it too long. Let's just say you want to use the NQ, okay, NASDAQ futures, and you pull up your weekly chart and you look at, say, I'm going to just randomly pull a number out. Let's look at the weekly candle. I'm not doing it. I'm saying you do it. 7 weeks ago. Okay, 7's just a number just jumped in my head. There's no reason why. I have no idea what 7 weeks ago, what price did in net and Q. I don't recall. I don't remember. It's too far back for me to remember key levels from that time frame. If it was last week, I would. But 7 weeks ago, I don't know. But what was the week prior to 7 weeks ago? In other words, right now, we have not opened up on this particular trading week. And today's date is November 27th. It's 10:20 a.m. New York local time on a Sunday. So the markets are closed right now. If you go back 7 weeks ago, or 7 candles on the weekly chart ago, the 8th week from today, you would be looking at that particular week, expecting or anticipating what the following week would look like, which would be 7 weeks from today, looking back. Whatever that weekly candle did on the 7th week, you should pretend right now, this is what your pseudo experience does for you. You pretend that you had it right in your bias. In other words, if it was an up candle that expanded higher, or if it was a down candle that expanded lower, you're assuming that you had that part determined beforehand. Then what you do is you go into those particular days of that week and you look at it from a hourly standpoint. You break it down from hourly, from Monday to Friday. Put your daily dividers on, outline the times when the session starts that we like to trade, like 8:30 in the morning till 11 o'clock in the morning. What setups formed? How did they form? Did it reach for liquidity, or did it go back into an imbalance before it created the setup that was in line with that weekly expansion, whether it be bullish or bearish? And then you do that individual day on a 15-minute candle, and you do the same markups in more detail. And you do the same thing with the 5-minute chart, the 4-minute chart, the 3-minute chart, the 2-minute chart, and the 1-minute chart. Oh, fuck, ICT, that's just too much. Well, get up the road if that's the way you think about it. Because you want to learn how to make fucking money. Money making ain't fucking easy. You got to learn how to do this shit. And it means you're going to roll your sleeves up and do this stuff. If you don't want to do that, you will not learn this. You will not learn it any other way. That's what separates the men from the boys, the soldiers from the cannon fodder. You have to do these things. And you have to be diligent about doing it. And you continuously do it. And you study and you study and you study. And you go through all the time frames. Just like that. And you collect every new week of data, even if you had losing trades. You record it in your journal as if you knew that was going to happen, and you record it in your annotations. And what happens is you're retaining the pattern recognition aspects of seeing the examples seen over and over and over again. And you're recording your own annotations. Now, in truth, you're lying in the annotations about having seen it, but you're rewarding yourself visually and through annotation, so your subconscious retains it as this is a good experience. I saw this coming, and I'm happy that I saw this pattern fulfill as I learned it. Now, that's not the same as lying and saying, I took this trade, like you see everybody on Twitter. I took this trade. I took the same trade as you did at ICT, and they don't have their executions. That's why I don't like those kind of posts. You need to go through your annotation, say, I'm thankful that I see the model unfolding in this example exactly how it should have. So your brain sees that, you remember it because you wrote it. So it's tricking your brain and providing pseudo experience. It's self-talk. Okay. It's a way of replacing anxiety and nervousness about not ever learning how to do this with positive reinforcement. And you're collecting examples that you're going to refer to continuously in your study journal. You're going to keep go back, looking. Okay, this is what that week looked like, and it's a wonderful resource because after, there's going to be times when you look back at old moves and you think, man, I wish I had looked at a 1-minute chart on that day. You'll have it, and that's why it's important for you to be a specialist. You see these guys out there. Yeah, I follow 27 pairs. That makes me professional. No, that makes you a fucking junkie, and you're not a professional. You need to specialize on one market, maybe two, but one market. And here's how you know there's a professional. If they can tell you what the 15-minute highs and lows and the 5-minute highs and lows in the New York session and the London session, they're a professional. Ask yourself right now, could you say what the 15-minute high and low was and the 5-minute high and low was in any particular market? You probably can't. And these same people on Twitter and YouTube and Discord and Instagram and Facebook, they're all full of shit. Okay, I know what I'm looking for. I know what levels I'm working, but I can't remember it 7 weeks ago. Okay, and I just reached 7 because that's the number that just jumped on my head. Mathematically, that's the number everybody's going to reach for, between 10 and 1 anyway. But I covered a lot of stuff today. I went through something that would have otherwise only been taught if you were one-on-one with me, like it was in the 90s. Okay, I covered a lot of things that were black and white, binary. Do this, don't do that. Do this if this happens. Okay, I walked through something that would have otherwise been given to charter members in my private mentorship. You have something now that's real, it's tangible, it's something that you can work with and go forward and study back testing. And also, once you back tested and burnt enough hours in logging examples, how many is that? How long do I have to do this before I should know I know how to do this? You'll know when you're bored about what you're about to anticipate in the marketplace, and it happens. When I say you need to be bored, you need to be fucking bored. That is the surest sign. Okay, if you're looking for that, that sign or that way of knowing that this is what you should do, when you can call the marketplace and know that you can push it in a demo or a paper trading account, You don't care what the end result's going to be, but it's always the same thing. It's going to target more times than it's not. And you don't care. You don't care if it's money made in real terms or if it's demo. You've gotten so comfortable with the outcome being not necessarily known beforehand, but you know that you've been doing it long enough that this is the reasonable expectation as an outcome. When you feel that way about your trades in demo or in paper, that is the surest sign that you are psychologically equipped to then consider, not I'm giving you the, hey, go and do it, but that's right about the time when you can start entertaining the idea of maybe doing it with live funds or a funded account. And I know I just broke a lot of hearts by saying that, but don't you want to learn the right way? Don't you want to be equipped to do it the right way? And I know it feels like the world's crumbling all around all of us, okay? But you can't speed this stuff up. You can't make it faster. You can't skip it. You can't cut corners. You can't have it your way mentorship results and get blue ribbon results. You can't do it that way. I promise you it doesn't work like that. I've seen so many people, hundreds of thousands of students come through, and predominantly every single one of them that rushed it fell right on their fucking face. And then when they slowed down and they removed all of the Olympic expectations they were trying to place on themselves and stopped worrying about social media influence and acceptance, then it worked. It worked for them because it took all the pressure off of it. It took all the anxiety, the performance anxiety, the need to do well in other people's eyes. That's all something that will be a stumbling block for you. Trading competitions, if you're developing and you're all rushing to get good so you can go into trading competitions, the quiet people that talk shit, you're doing it wrong. You're doing it wrong. So you want to be bored. You want to be like your job. You hate your fucking job. You can't stand your fucking job. You can't stand the commute. You can't stand coming home. You're tired, but you know your fucking job. You don't get aroused because you're at work. You don't get excited because you're going to work. You're like, I got to do this again. Okay, it's what you got to do. That's what you have to do about your trading model. This is what you got to do. You got to do these things. And you know that, hey, getting up tomorrow morning to go to work, you don't know if you're going to get a flat tire. You don't know if you're going to get sacked. You don't know if you're still employed. You might get sacked. You may be made redundant and removed. And you're going to see a lot of that coming forward in the next 6 months. A lot of people are going to be losing their jobs. And that's going to also make you feel like you got to rush. Don't. You'll undermine months of development if you invite fear and anxiety. Don't do that. Keep the focus on the right direction and be consistent. Doing these things and back testing and collecting all these experiences and logging them, and learn to love doing that. I see, I watched Hannah's video the other day. She goes, I hate back testing. Girl, you better straighten your shit up. You better fall in love with that part because that's what's going to make you better. You have to love that. You have to fall in love with that. If you can't find a way to enjoy, it's almost like meditation for me. And I'm good. I still like doing it because I'm so impressed with the level of precision that the algorithm is consistently delivering. It's not randomness. And it's so beautiful to see how it does what I teach you, it does. And it's almost like poetry. Like, I mean, obviously I'm biased. I mean, my fingerprints are all over this fucking thing. But the point is I literally love seeing it perform. And you have to admire it. Even if you can't take that trade. Even when you lose in a trade. When I take a losing trade, I look at it and I'm still like, I still see what I did wrong. I see what I did wrong. And it's still doing what it's supposed to do. And you can't be mad about having to do the work. That's reasonable. You want a fit body, you want a beach body. Well, you're not going to get eating fucking donuts. You got to lift some weights, you got to cut some calories, you got to exercise, right? Well, that's effort. Nobody fucking likes to go to the gym in the beginning. They hate it. They got to get through that first growth spurt of pain and soreness. But when you get rid of the sugar, you find out you don't have that much pain anymore. And you're going to be sore and stiff, but not to the same degree that you were in the first 3 months, the first 6 weeks, the first 2 weeks, where you're getting rid of all that shit in your blood, all that sugary stuff, all that extra sugar in your coffees that you shouldn't be fucking drinking anyway. But anyway, I've had fun today. I've enjoyed spending time with you, and hopefully you got something out of this one. I'm going to have to find something to get into while my wife's not here. She's out there spending probably more money than she should. These outlets, they say, hey, you can save so much money. She could save more money by not going. How's that work for you? She'll find an excuse. Look at this. I got this for 50% off. Yeah. And all of our fucking kids have closets stuffed. Okay. You can't put another fucking thing in there. Not another fucking hanger can fit in our closets. Literally. But she'll be out there buying shit. I don't get it. But I guess it's a woman thing. But nonetheless, I believe I've given you some useful insight today. I've given you some tangible rules and procedures and processes and logic and how you go into a morning routine. This is my morning routine. It's been this way for decades. Like, I haven't changed it. I haven't made any kind of adjustments. I've never felt the inclination to make an adjustment. The only thing I didn't mention, and now I'm looking at my notes, I skipped over the point number 4, and I don't know why I did that, but I go on social media and I go on to YouTube channels, people that do live streams. I love watching people live stream, because that is the greatest feedback for market sentiment than you could ever have, because they are in a position of raw attention span on what they believe at the time. And if they push a button, number one, I have every bit of respect for anyone that does that, whether it's somebody that hates me or doesn't know me, or they're a fan or a supporter of what I do. Anybody that has the fucking balls to get out there in front of the world and either fall on their face or shine, that is, to me, that's something personally, I that's a limitation. I can't do it. I cannot be in a position where I can have 100 people or so, or even more, a dozen really. If someone's constantly asking questions, my mind's going to say, okay, I got to at least see what they're asking. And that's going to distract me. And I can't focus. My attention span is you can just listen to me in these Twitter spaces. I'm not even looking at a fucking chart. I'm all over the place. And then you're going to add to it, I got to watch 1-minute charts and make a decision and decide whether I'm doing the right thing at the time. And I guarantee if I do live streams in February, you're going to see it's not going to be 200 people there. There's going to be a lot of people there. And they're all going to want to have a question answered. They're all going to have some point that they want to make. And I have to ignore all that. I can't look at that. Otherwise, I'm going to be distracted. But for people that get out there and trade and push a button, whether they're doing it in a funded account, whether they're doing challenges like Trades by Matt, I got respect for that guy. I know he catches a lot of shit from trolls and such, but he's out there doing it. And when he falls on his face, he owns it. What to do? They don't know how to be disciplined. And if you have something that's automated and it's consistently calling turning points in the marketplace, that is a foundation that they'll dogpile on that. And that's an easy selling thing. I said, it'll sell itself. Like, literally, it would sell itself. Think about it. Forget me for a moment. Take me out of the equation. Forget what you're learning with me. Put all that aside for a second. If you did not know how to find daily bias or set up timing, wouldn't you fucking like to see something like that? And if it was consistently able to find setups like that, wouldn't that be something that you would entertain at least looking into? If you say no, you're a fucking liar. Because I've been doing this for 30 years and I'm still interested. I'm watching what he's doing. And I think by him taking all that stuff off his chart, he's finally fucking listened. And he'll see, if he just focuses on selling his product and not drama, he will get what he's trying to get. And he'll do it the right way. He'll polish his image up. He'll clean his up. His trademark, his algo box will grow with reputation, not all this muddy shit. because there was nobody threatening his fucking family. I never did that. I never did any of that stuff. And I knew he knew how to trade back on Twitter. And I knew if Adam Webb got into a real competition with him, he'd mop the floor with him. And Adam Webb faked all this bullshit. Didn't even try to fucking trade. He's a fucking clown. He's even blocked me on fucking Twitter. And I haven't said anything about him until, I guess, recently. But he blocked me as soon as I got on Twitter. Fucking douche. But if you haven't been watching what Vinny's been doing, he's got a channel. It's Algo Box Trading. You know, I know he's got his drama bullshit channel where he likes to fucking troll me and talk shit about me on his other one. But he has Algo Box Trading, and he's got my logo up there, and I know why, because it's drawing attention. I don't give a fuck that he's using it. I don't care. Okay, but what he's doing with his Enigma, okay, he's trying to create this marketing thing around what he's doing with his Enigma automated algorithm thing. And I told him, I said, if you work out the kinks, okay, first of all, I told him, I said, if you are going to hit me with a lawsuit for fucking horseshit, you'll find out in court everything you said is wrong. Okay. 2, once you find that out and you know that you've been wrong about it, I will gladly send people to you if you work out the kinks. And when you say your shit's final, because he's out there testing it live, I would have never done that live. I would have waited for it to be up to spec. Then I would have said, take a look at this. But he's chomping at the bit to get ahead of everything. And I get it. I understand. But I've watched what he's been doing in the few live streams. I haven't been able to sit there the whole time because they go for hours and hours and hours, and I have things I got to do, and we've been moving around, whatever. But I did watch where he drew down that morning. It was one day last week, and he thought I was in there to troll him. I said, "Oh, I'm not here to troll you, dude. I mean, I had difficulty waiting for my setups too." But he climbed up out of that. Now, the average trader would not be able to do that. So I believe he knows how to use his tools. I know how people like to throw shit at each other, but I've never said he couldn't trade. But I think what he's doing right now, he's finally coming into what I've really suggested to him back, in the early Twitter days when he was reaching out to me. If we were going to do the live stream like we were going to do, I told him, I said, listen, I'm going to bring my audience to your live stream. Okay. You talk through what you do with your algorithm, because I'm interested in anybody. Anybody that's trading and pushing buttons, I'll sit and watch. I'm in the audience. I'm watching. There's a lot of people that are smaller that I still sit and listen to because I love the fact that they're willing to do it. And to me, I envy that. I envy that because I can't focus doing that. And I wish I could, but I can't. So when you see me doing my live streams, I'm not going to be answering questions. I'm not going to give a fuck what anybody's saying in that comment section. It'll be Izzy over there, but I'm going to be doing my own thing in the chart. So, but when I was talking to Vinny on Twitter years ago, way back, I told him, I said, I'll bring my audience. And I had about 38,000 people follow me then. I said, I'm going to say, I'm going to your live stream and I'm going to watch what you do and just outline it. Just talk about what it is you're doing, why you're doing what you're doing. And there it is. And I don't want any kickback. And if he's honest, for once, he'll tell you that was the truth. I did not want anything for it. I did not want any kind of kickback. I don't want any kind of partnerships. I don't want any kind of royalties. None of that bullshit. I don't need it. I don't give a fuck. Do your own thing. I don't care. I'm not losing anything. But the very next day, this guy went out there and started fucking blasting Adam Webb, and it got dirty. And I was like, what the fuck? How can I, like even now, I'm doing something that I have avoided on Twitter before. Like he says some terrible, sick shit about me. Okay. And I know he knows that none of that shit's true. He knows, but he wants that cancel culture to come down on me because it'll draw attention to him. Vinny, you don't need that. I will bring them to your channel right now with all the drama still, with all the bullshit and all the lies. All I'm asking you to do is do a live session and walk through and outline, talk about what it is that it should be doing and why it should be doing it. Keep the focus on that. I would love to sit there and watch that. I would love it. And I think anybody that is a trader would respect that as well. So all you have to do is, I don't care if it's someday next week or the following week or even the next year. I don't care. I said, I'm a man of my word. I would sit in the audience just like I was the other day. I was respectful. I wasn't there to troll. And I listened and read all kinds of horse shit that you said, and then people in the room said. I rebutted with none of it. I'm there for that. I'm not trying to harm you. I didn't want to harm you. I didn't fucking threaten your family. I didn't threaten your children. I didn't pay anybody to do those things. And I didn't do any of this shit that you say. And I'm not worried about what you say. But I know if you are bent up and you think this shit, maybe you do think that I had something to do with somebody, threatening you. I heard the person threatening you, but that wasn't me. That wasn't a result of me. Look at me. Do I seem like I'm worried? I'm still talking about you. That's proof. I've had no ill will towards you. I'm still, with all your horse shit, I'm still right now telling everybody that listens to me, I will sit in your algo box trading live streams and watch you outline what you're doing. And I've already seen enough to know you're going in the right direction. And you've admitted honestly, openly, that, hey, you got some kinks to work out. And I told you in a personal tweet, no, not tweet, text. I said, I like what you're doing right now. What you did before, I wasn't a fan of. I'm not a fan of the algo bars. I don't even know what the fucking algo bar is, to be honest with you. Maybe you can explain that. But there are people, even in my group, that if you streamline something, because they can't do what I'm doing, they've struggled. They couldn't do it. It doesn't mean that the people and myself that use it effectively and it works and it's precise for us, it doesn't mean it doesn't work. It just means that they can't do it. And they need something else. They may need something that's completely outside of me or whatever I teach. And I'm completely aware of that. There's people that go to other disciplines and they come back and they say, okay, I added this and it helped me understand this better. I still know that there are people in my groups that still are struggling because they can't be discretionary. They just don't have it in them. They can't do it. And they would probably do well with something automated. And it might not be something that is based on whatever I do. That's fine. There's lots of ways to make money. And I'm completely open to allowing my own audience to go over there, and I'll even direct them, go right over there and see what you're doing. Because I personally saw what you did recently. And when you took all those harmonic pattern, like the triangles and shit, all that, man, that's just too much stuff on a chart for me. I can't, I'm too distracted by that. Now, I might be alone in that opinion, but I know there's a lot of people that like to have a naked chart. What you're doing right now, man, if you work that shit out and you clean up all the kinks and the things that you're saying that there's confliction between different time frames and such and why it's doing this and doing that. And I'm not asking for the logic. I don't think you should divulge the logic either. Like, I think you should just say, this is what it's doing. It should be reading this until it gets to this and that. And what's the advantage? What's the advantage of not having all those overlays on the chart and how you can trust it on what you're doing now with your Enigma? That to me would be interesting. I would like to sit in and listen to that. I think viewers would listen to that and it would be helpful. And it would probably do more for selling your product, or at least building the audience. That way they can track your development with it. And once you get to the point where this is it, I'm confident now, it's doing what I aimed for, all the building plans for it, all the expectations for it. These are the things that I had hoped for, and it's able to deliver it. And this is where it's at. And now it's ready for public consumption. That would be cool, because it's kind of like a Kickstarter without having the money being poured into it. Like, you're building it and you're just going to keep the public up to date with what it is you're doing with it and where you are in the progress. Because I see major potential, way more than AlgoBox in its original formats. I have never been a subscriber to the things that you do, but I know that you know how to use your own tools. But what you're now working on is exactly what I was trying to tell you to work in terms of, if you're going to give something to the public, you need to make it very easy to understand and short and sweet. And the direction you're going now is perfect. That's perfect. That's exactly what those individuals that are looking for help with determining when to buy and sell. If you have something that's consistent, and it's obviously it's not going to be perfect. Nothing's fucking perfect. But when I asked you if there was a filter for daily bias, okay, I have no opposition to you even considering what I just outlined in here. And you don't have to ever say you did it, okay? But something like I was outlining here for like the weekly bias, like if you factor something like that in, and I don't know what makes your bias for when you, like I know you said that there's a setting where you can choose buys and sells or both directions. I'm not a fan of have a new student or a new trader doing both directions. Okay, and we might disagree in that regard, but I think that it's better for a student to understand one side of the marketplace predominantly over another based on the current climate. So if that's the case, and if you can either build that in, or if it's already built in and I just haven't watched enough of it to know what you've done, I think that would be advantageous for your product and for those that might use it. And if you did that, I think it would increase the level of the results that you would probably get out of it. But that's just my opinion, and you can discount it or whatever the fuck you want to do with it. I don't really care, but I'm just thinking out loud because I wish you would have did that approach with your algo box back then on Twitter, because that would have been much more appealing to the Twitter base, and you wouldn't have had to really rely or hope to rely on a larger public figure like me or other people that you try to tap the shoulder of. I am in the worst place for someone to expect someone to send somebody to for an audience. Like you talk shit about me all the time. I'm not affected by it. It didn't slow me down. But I've told you, like I told you back then, this is who I am. My character is who I am. And if I said I would send people to look at you and watch your product and bring an audience, I said I meant it. And I wasn't trying to be involved in all the drama that you and Adam Webb going on. Adam Webb was trying to dox me. He did not want to do a trading competition with me. That's all that shit was. Him and Dante were back and forth, and I gave each one of them pieces of information to see if they would talk, and they both knew what the other person knew. That means they were in cahoots. I don't give a fuck about Tom Dante. He's a piece of shit. You have said things, I don't agree with it, and they aren't true. With that said, if you believe the nonsense that you say, I'm here to help you cancel all that stuff. I'm not the person you make me out to be. I've never been like that. I've never been like that at all. And if you're joining the Robbins Cup in 2023, I swear to God Almighty, I'm going to be in there with you. And I will do my utmost best to make sure you don't beat me. But if you join it, you know what that means? That means that you did something that no other fucking clown talker ever did. You actually joined it. Now, do I sound like I'm afraid? Do I sound like I'm scared? Do I feel like I'm going to fall victim to anything that you're... No, I don't fucking feel any of that stuff. I'm proving I'm exactly who I've always been. And everything that you've painted me as is not true. If I was afraid of any of the shit you say, I certainly wouldn't be inviting people to go to your fucking YouTube channel. But I think what you're doing right now, that's the right direction. For your product and for people that need something automated, man, that is it. That's the ticket. That's the thing. That's the very thing that would help people that cannot trade discretionary. And it's hard. It's hard to trade discretionary because there's so many things that you have to filter out. And if you have something that's objective, where it's only a buy now, it's only a sell now, okay, that means they're going to subscribe to that, but they have to still subscribe. They have to commit to it. And I'm sure you'll work out the kinks. I mean, you seem diligent about things. But when you're ready and you know that it's met all your specs, like I told you in that text, when you say that, when you know it's ready, I'll draw attention to it. Say, hey, look, I watched this. I saw him do it. And there it is. I don't need anything back for it. And I ain't worried about no fucking lawsuits. I ain't trying to talk you out of it. If you think you want to go to a court session with me, come. I'm ready. I got all the fucking receipts. I'm ready. But I'm not that person you're making me out to be. I'm not. So, anyway, I checked off all the boxes on my list here. And I apologize for those individuals that were maybe trying to get on here with me to ask a question, but I'm not sure how to do it. And then the few people that popped up, how they did it, I don't know. But I did see there was like 127 of you requesting to talk, but I couldn't, for whatever reason, I couldn't get you to pop up on a list where I can toggle you. So hopefully you guys can help me in that regard if I did something incorrectly. I think that's going to be it. I'm going to grab me something to drink, grab me an apple, and I'm going to get busy into something else. Enjoy the rest of your weekend. Going forward this week, be careful. I have no bias. I have no directional bias, and extremely slow. So if you bear with me, I'm opening up charts all fresh. I haven't done anything in advance, so that way it's kind of like on the fly. If you would be so kind as to let me know you can hear me, I'm going to check my Twitter feed on my laptop that's sitting in front of me here. If you can give me a 5x5, that way I can move on. Begin my boring jawboning session. Thank you, Patrick. And Peyton, thank you. All right, so I'm going to talk about what I'm doing. So that way you're doing it on your own charts. Now, some of you, is the volume okay? Because I have it sitting on an ottoman in front of me, and the phone's sitting in front of me. Is the volume loud enough for you? Awesome. Thank you, Chris. All right, so kind of like walk you through what I'm doing here. And you're probably, maybe some of you are pissing and moaning, thinking, why don't you just go on YouTube and do a live stream? I don't want to do that. And my charts are not necessarily going to be in agreement with yours. So what do I mean by that? I don't look at US 500. I don't look at US 30. I don't look at US 100 CFDs. But I know there's a lot of you that look at those markets, and you may or may not have access to E-mini S&P live data, which in my opinion is an inexpensive cost. If you're going to be even considering doing it, you should be doing it, paying for it. I guess it's a tuition cost to learn how to do this. And to me, I think that, it's a good market. It's really it's strong. It's technically sound, has lots of volatility in it and such. But I know some of you are looking at the US 500, US 100, US 30 CFDs, and I'm going to try to kind of give my observations about that in concert with the ES. So what I'm doing is, I'm on my trading view, I'm creating a split screen. So on the left-hand side, it's going to be US 500. And the currency COM option. So if you go up to your trading view, this is going to be free real time for anyone that pulls this up. But on the symbol search window, upper left-hand corner trading view, you're going to put in US 500. And when you pull that up, it's going to give you two options, currency.com and capital COM. My chart's going to be on currency.com. Okay, so that way we're looking at the same thing. And it is set presently, I'm looking at the hourly chart. Okay, so That's done for now. And on the right-hand side, for those that have the ability to have both ES real time and want to watch US 500 CPI numbers hit the market real time, you're welcome to do that. On the right-hand side chart, I'm pulling up ES, letter Z for zipper, 2022. That pulls up the December contract for ES. And I'm going to, again, plot that on an hourly chart. I'll get into why I'm using that time frame in a moment. So there's somebody like, why are you looking at that? All right, and let's see here. Let's do all my annotations going. Naked chart. Skinny dipping with ICT on CPI. All right, and then I will not be looking at NASDAQ, and I'm not looking at gold or anything like that. Why not ICT? Because you only need to watch one market today to understand the dangers of not knowing what you're doing and how you can get hurt really bad. All right, so now if you look at the hourly chart on ES on the right-hand side, for those that are able to split the screen, you may not have that ability because I think it's a feature you have to pay for. I don't hold me to that. I don't know for certain if that's true or not because I can't remember. But the trading view option, if you can split your screen, that's fine. If not, I think maybe you can open up two windows and put them side by side. But either way, on my right-hand chart, I have an hourly ES. And if you look at where we're at the moment, the market price for ES is 37.65.5. And on the left-hand side, my chart for US 500, that's basically tracking the equivalent through a CFD, which we can't trade in the US legally. We have to trade the futures market. And then there's offshore brokers. I don't deal with any of that stuff, but I know some of you are outside the States and this is what you're reduced to. You have to do simply this. That price for the hourly US 500, again, using currency COM feed on TradingView, its price right now is 3756.4, 0.7, 0.9, so that way you can get a feel for where we're at. So the difference is between ES live futures markets, ES 3764.5 versus 3757 or thereabouts. So there's a little bit of discrepancy. So they're never really marked to market live immediately. Same for, both markets at the same time, which, that might be a sticking point. And in the past where I've talked about markets like this, I made reference to a price level on one of the markets when I was referring to the other. So I got disoriented doing it. So if you're going to be doing anything with this, trading the index futures or trading US 500, there really isn't any advantage of having both of them up. You're going to trade one, pick one, and that's the way you're going to deal with it. There is no need for the daily chart today because everything we're going to be utilizing for our study and liquidity. And before I get into this, okay, this is the part where you have to be really paying attention because it's easy to think, okay, ICT is giving out signals today. No, okay, this is not what this is. This is really just to illustrate why you have to understand the economic calendar and the effects of liquidity and how the markets will abruptly reprice to a specific liquidity area. If you look at your hourly chart, we're going to do the US 500 first because I want to get that out of the way, and then my focus is going to be on ES. Okay, so that way we can look at the reference points as closely as we can in terms of agreement, so that we know the liquidity points I'm looking at, what I think might unfold today, and I might be wrong. Okay, but here's what I want you to do. I want you to be in a paper trading account. I want you to push a button, okay, on a paper trading account. That means it's not a live account. I want you to feel what it feels like to be in there trying to push the button, and TradingView probably isn't going to let you enter, not even on a demo, okay? And your live broker would be equivalent. They always mess with the ability to get in on a market move like this. It's so aggressive and highly manipulated. If you go into these types of days thinking, unless you're going in minutes, right before the report's released, and you're gambling, and that is reckless, it's not advised, that's really stupid to do that. If you push a button in this market move this morning with a live account, I'm telling you, you're going to regret it. So don't do it, okay? What we're doing is we're doing an interactive study looking at how prices right now, where the liquidity pools are, I'm going to go over in a moment, and then what they go for and how fast it gets there, and then what it does once it goes to them, okay? I do not have an interest in pushing a button in my live accounts. I have no interest in doing that. I will not be doing it. So if I'm not doing it, please listen to me. Do not use this as an invitation to go in and push a live account button and hurt yourself. Okay. If what we outlined today pans out and it's precise or whatever, it's just an experience for you to log in your journal and you observed it live. That's experience that you want to be doing this every time there's a high impact or a medium impact news driver. You want to do what I'm going to do today. Okay. And if you do it every single day, studying how the market does these types of things, that experience is going to build over time. And you'll start seeing things that my lessons and my videos won't fully put you into a style of trading that you can't really understand yet. And what I mean by that is you're not going to know what it is you're doing as a trader until you discover seeing it over and over again in the charts. And you're probably thinking, well, why don't we all see the same thing? You're all looking at different time frames, different markets, and your opinion and your personality is going to vary across all different cultures and demographics. You're all going to be wanting to do something different. And that's the wonderful thing about the tools I've given you. You can carve out your own niche and be unique and still use my concepts and feel good that it's yours. It's your model. You built it yourself. That way you can feel confident about going forward and not leaning on me through codependence. You don't want to do that. You don't want to do it with any mentor. You don't want to have any chain to their product. You don't want to have any chain to their signal service. You don't want to have any kind of tethering at all for their advice or their opinion. You want to be an independent mind, going in, making your own decisions. And if they're good, you take all the glory for that. If it's bad, you eat that. That's the way it is, okay? If you don't have that mindset, or if you can't cultivate that, trading is not going to work out for you. So with all that risk disclaimer such out of the way, and I apologize if I bored the socks off of you, but I have to make sure that the folks that are coming in here aren't going to think that, hey, this is casino time. Let's get in there and risk it all. No, please don't do that. Okay. All right. So now US 500 on the hourly chart. If you have as much as, let's see, what's the date on that? If you go back and look at the 28th of October, okay, you'll see about the 1600. Now my time is UTC -5. Okay, so that way you know what I'm looking at time-wise. And the candle I'm looking at for US 500 on the hourly chart at the 1600 hour on Friday, October 28th, 2022. That high, and then just to the right of it, a few candles over on November 1st at, what is that, 8 o'clock in the morning. That high is slightly higher than that one prior to it. Okay, so we have relative equal highs there. We broke down, took out the low on the 10 o'clock hour on October 31st. Now, if you're complaining about this and saying, I wish you would just show a chart, this is how you're going to do it. If you can't navigate based on what I'm talking about, well, it's time, the time frame, you're not going to do well trading anyway. So this helps you feel confident that you're doing it with your own charts, your own scheme of colors, your layout, everything. But it should be a naked chart. I want you to notice how that rally up on Wednesday, November 2nd of 2022 at 1400 candle, rally all the way up to trade into that small little fair value gap that made that higher high on November 1st. We created an optimal trade entry and then broke down aggressively, took out the low formed on October 22nd, that Thursday at 1600 hours. We traded down on November 3rd, made that low, and then we failed to go any lower than that. So we tried 1, 2, 3 times to make a lower low, and there's lots of sell side liquidity resting right below that November 3rd low. So I want you to take a horizontal line and drop that on that low. So that way we know going forward, what am I expecting this morning? I'm of the opinion that we're going below that low. Now, I'm not pushing a button. I'm not risking money. I'm not taking a trade. I'm sharing my opinion as to why in a moment, but that's where I usually put that little eyeball icon that TradingView offers. I'm placing it right now, right underneath my chart, those lows. Okay, so I believe that we're likely to see a trade down there. In the same hourly chart, from that low that was formed on November 3rd, we traded up to the high formed on November 8th of 2022, the 10 o'clock in the morning hour, made that high there, and then we've had a shift in market structure that took out the low on November 8th of 2022 at 3 o'clock in the morning. That low was taken out on the candle of November 8th at the 1400 hour. Then we traded back up into that CPI I talked about yesterday, and we broke down. Now we have a small little bear flag. Okay, this is what retail is seeing right now. There's a bear flag where the market has dropped and went below the lows I talked about yesterday, and the low specifically is November 7th at 3 o'clock in the morning, that low. We swept below that, and we've consolidated. Now, if you look at the 3780, and again, we're looking at the US 500 hourly chart. If you look at the low on the candle of 1100 on November 9th, Wednesday's trading, okay? That low and the high of the candle at 1400, you'll see that there's a fair value gap right there. I want you to note that. Okay, so there's going to be a small little fair value gap that's approximately, and I'll share my chart after we've done this. This is kind of like a test for you. Your chart should look real close to mine. Do not share them. Don't post them. Don't try to be the first one. Just let me say this right now. It's irritating to me when people in the comment section or they reply first. Yeah, that's annoying to me. Don't try to be the first to share your charts. Okay, right now it's interactive. We haven't even completely covered everything yet, but when we're done and I close the session, share your chart because I'm going to share mine at noon. That way you can compare and contrast what you've done listening to me and observing price. That way, if you're wrong, you'll learn from it. If you're right, it just feels good doing it. It feels good to do it. So we have a small little fair value gap. And look at that low on the 9th of November at 10 o'clock in the morning. Okay, see that low? That's essentially just about midpoint of that fair value gap. So it might want to revisit that if it spikes up there. I'm thinking this is what I'm expecting. I'm expecting price to jump up into that fair value gap, touch the very minimum of 3775.3. That should be your candle high on November 9th at 1400. And as much as but it could color outside the lines here. This is why I don't like to trade this before it happens. But the low of 37.86 on the candle at noon, November 9th. Okay, so that's your fair value gap. I'm thinking that we could run up into that. Then it drops down for the sell side liquidity below 36.94 or 36.94.7. Okay, so that's what I'm expecting. That's what I'm anticipating. I think that is a probable profile for today for the CPI number. The problem with this is, and you probably have been seeing this if you've been studying the CPI number this year, the CPI number just comes out and it's just like a straight line. It's like, okay, we were here and now we're way down here. Okay, that's how fast it can happen. That's why it's very, very dangerous. So let's play devil's advocate for a moment. Okay, let's just say I'm right. And I'm not suggesting I'm going to be, because I don't believe that anybody should be taking this advice. We're studying this, okay? If I firmly believed that I was going to make money doing this and I could enter it, I'd be doing the trade. I'm not. I'm not even pushing a demo. I'm not doing that. I want you to do that, okay? I want you to feel what it feels like to be in this. And then after you push the button, I want you to think about it being real. Think about what it would feel like, the anxiety or the exhilaration of whatever happens in the marketplace, okay? I want you to feel that. But also, as soon as the number comes out and you see your market chart move around, I want you to try to press a button and see how long it takes before you ever get a confirmed fill on your paper trading account. Because you see all these folks out there, they'll show you that they got in on the very 1 minute candle near the high right before the CPI number drops. That's bullshit. Okay, that's not happening. It ain't happening. Okay, you're not getting filled. So in a perfect world, say it wasn't a number that comes to market like CPI, I would take this trade on any other medium or high impact news driver. I would wait for it to trade up in that fair value gap. I'd use that as a shorting opportunity, and then I would look for it to run down to 36.94.50. And that's what I would look for. Okay. If I'm wrong and it completely blows out that fair value gap, then I'm wrong, and there you go. Then you know why I don't want to trade these markets. But if I'm right, it's not me patting myself on the back. I'm not going to champion it. I'm not going to be doing any kind of peacocking. But I want you to understand how fast this market will move. And I only got like 6 minutes to get the rest of this out. But I'm showing you where I think it's going to go. I'm co-signed. There's no side B to this. There's no scribbled line that's going to give me a bullish scenario. I think it only goes up to get in that fair value gap, if at all. It may not even do that. But if it does, I would think that it would aggressively reprice down below that 36.94.50 level. Okay. And now the easy part for ES, the only thing you're going to be doing is looking at the US 500, everything I just outlined, your chart, while the prices don't agree exactly, the relative equal lows that were formed on the 3rd of November and the, what is that? This 4th of November, 8 o'clock in the morning, those relative equal lows. So that liquidity pool is the same on ES, and the fair value gap exists the same on the ES 1 hour chart. Okay, so I'm thinking slightly higher, and if it can run up into that fair value gap and then crash down for the sell side. Once it gets to that sell side, I'm interested in seeing what it does that at that moment. So I'm not suggesting that I know what it's going to do beyond that. The only thing we're observing, and this is how I frame a trade, I'm not trying to go in and try to do, like with my examples, you'll see me do a session where I'll say, okay, this is where I think the market's going to go, and I'll point to, I'll say, note this level. What I'm saying is that's my bias, because if it's above the market price, that means I'm bullish for that session. Okay, that New York session or a PM session, whatever it is that I'm referring to, the next session that we're in or about to begin, that's the next one I'm looking for. Right now, I just did it real time with you, telling you where I believe the market's going to draw to. But also prefacing it by saying, do not push it with a live account, because I might be wrong. And these numbers are dangerous. Like, they will manipulate the market incredibly, and it can hurt you very, very bad quickly. So don't do that. The only thing we're doing is studying how we see a trade set up. Is it likely to pan out? If it's good, just use it as experience. If it's wrong, Open does too. Then at that point at 9:45 on CPI number days, then you can go in and trade the normal market conditions. But until like 8:30 to 9:45, man, you're in dangerous waters, especially if you don't know what you're talking about or what you're doing in the marketplace. And there's a lot of you that are like that, and that's who I'm talking to. I know there's a lot of people out here have experience and they take offense to what I'm saying, like I'm talking to them. If you're profitable and you know what you've been doing, you've been around the block for a while, I'm not talking to you. Okay, I'm making sure people that don't know what they're doing aren't going to hurt themselves. Okay, so that's what we're looking for. We're going to sit here and watch in less than 2 minutes or so. The fireworks will happen, and if it runs up in the fair value gap, we're going to observe. If it rolls right through it and doesn't respect it and goes higher, which whatever, but if it goes in the fair value gap and then sells off, then you'll have something to observe, study, log it. And if you have the ability to record, and I use TechSmith's Camtasia Studio, it costs a little bit of money, but for study purposes, man, it's nice to be able to record live data, even if you're not in front of the charts. If you have a business, or if you're working, or if you're in school and you can't be in front of the charts real time, just set it to record, a 1 and 5 and 15-minute chart layout. And you can come back and watch. It's totally different from watching like a market replay on TradingView. Market replay is kind of like stilted. It's not as fluid as you would expect to see real-time data. So to me, I think that's one of the best resources in addition to a journal. All right, so I think that is enough talking. We're going to see what pans out now. All the clicking is me just adding the things I added in commentary to my ES chart, because the only thing I marked up really was on the US 500 chart. So now what we have is we have an outline of my opinion, what I think the market will likely do, and why should it do it. I believe that imbalance around on ES between what is that, 37.82.50 or thereabouts. If it goes up into there, that's fair value. And if they want to sink it lower, they can take it to that point and then down below 37.04, or just a straight dump right to 37.04. There's the two outcomes I see. Otherwise, I'm dead in the water, wrong, and it just blows right through the fair value gap, and that'll be the end of it. All right, less than 15 seconds. Showtime. And that is why you don't want to do it. ES has ripped all the way up to 38.60 right now, and the US 500 chart's not doing anything for me over here. I'm gonna check on Twitter real quick. Can you see do you have anything moving on your US 500 chart? There it is. It just finally updated, and it's just one big jump up there. So US 500 just ripped all the way up into 38.40 or above. There you go. All right, so now there's no one entering on that candle. with any measure of precision or nimbleness. Okay, there's no, anytime you see anybody sharing a chart, like always after the fact, here's my entry, and here it is, here's what I got in it, that's fake. Okay, because you can't even do it with the demo. Like, it's not going to fill you. So it's nonsensical for these folks to come out here on a day like these market reports. It's no way, absolutely not going to happen. Now, if you look at the lows right on the hourly, now I'm specifically looking at ES because I'm not concerned about US 500 now. I'm not sure why there was such a big delay there, but it has very close movement to the ES. I'll maximize this so I'm not looking at the other one. All right, so now we have relative equal lows on this morning. Buy sides resting right at, on your hourly chart. I have not changed my time frame. The high of 38.67. There's buy side resting just above that. Now, if we can run above that, that would be a candidate to see if they want to take that and then reject it and then come back for the sell side resting below 37.50. I don't personally see them coming all the way up to 39.25. Is that what that is? No, 39.28. If you look at the high on the 1st of November, I'm not interested in seeing that. But I would like to see it go above the high at November 8th at 11 o'clock in the morning. They can bump that. And then if it rejects, then it can come back and clean up the sell side below 37.50. And if they can accelerate below that, then back into that 37.05, 37.04 area. That's a scenario that I'd like to see pan out after, like the 9:45 a.m. I was referring to earlier. Let the equities market open up. This here is this absolute gambling. And it looks incredible. Like, it feels like, man, if I could have just been in that 100 handle move that happened like that. If you're wrong, folks, I'm telling you, if you're wrong, it ends you. So it's not a matter of, oh, well, you should know better. No, I know that this is going to hurt you. It could hurt me. Like, I gave you my honest opinion about what I felt is a likely scenario this morning. Why don't you trade at ICT? Because this is what can happen. If I pushed it with a live account, this would have crushed it. Like, it would have been bad. So again, this gets back to what I was referring to, I think it was last week or the weekend. I'm not sure when I was doing the last stream or space where I was saying social media equity curves, being popular based on, showing stuff with like a MyFX book or whatever, that puts you in a position where you have to constantly perform. Like, you have to do it. And I'm not trying to teach that in any of my students. And I don't do that. I want to be in a market where it's really easy to see what it's likely to do. Where's it likely to go? Why should it go there? And if I don't have that one-sidedness, now I don't have the one-sidedness today because CPI numbers, rocket fuel. Whatever they're going to do with the marketplace, they're going to do it, regardless of what my opinion is, what your opinion is, whatever. It's just going to just take off. And you can see it's moved a lot in just a short span of time. If you drop down now, go into a 15-minute time frame, you can follow along on your US 500 chart too. You want to have a horizontal line on the high. Give me a second. I'm drawing mine as I'm going. We just ran through that high of 38.67. So now you want to watch what it does here. Because everyone that was short, their stop would be all above those relative equal highs on your 15-minute time frame ES chart for those that are following along. Make sure it looks like that one. Yeah, you have relative equal highs here too. Now, that bear flag idea, remember I was talking about earlier? Retail would follow along with that and go short. What I look for is it has to go up into at least a short-term premium, which is why the fair value gap was even mentioned in the first place, because it has to come up out of that to be even considered. Before we even began seeing the CPI number come out, I outlined why you shouldn't be pushing it with a live account. Don't even try to make it with real money, because it's going to hurt you. You wouldn't be able to get filled. That's the characteristic with this market report. Okay, you're not getting filled. If you're going to get a fill, you're going to be filled so far away, if they even allow it to be filled, it'll be so slipped. And slippage is where you're trying to get in at and where you're actually filled. On a day like today, you don't want to be slipped 50 handles. Okay, that's not fun, because then you're going to be stuck trying to decide, is it something you want to hold on to still if you made the mistake of getting in. And I'm anxious to see if any of you were able to get your demo account or paper trading account to fill you on TradingView. Go down into a 5-minute chart. Okay, and again, that is over 100 handles in less than 10 minutes. Can you afford to be wrong on a day like this? That's what I'm trying to, make you understand. Seeing big moves like this, it's intoxicating after you see them move. Like if you aren't watching it live, or you're so brand new to this industry and you think that you can actually get in here and push the button and get in on these moves right as they happen, it's not happening. That doesn't happen. Okay. So knowing that that is what this market report does, it's important for you to know what the economic calendar says. And when these numbers like this come out, FOMC, rate announcements, and CPI numbers, they are dangerous. Like you can have your clock cleaned expediently. Gone. Thanks for playing. ICT included. I did not do this to be incorrect, on purpose. I genuinely gave you what I felt is a likely scenario, what I would like to see pan out. And if I would have done it with a live account, this would have hurt me. So knowing when not to do something and why you're not doing it, okay, that gives you peace of mind. It's never going to bring me a fear of missing out. Like I don't look at this move and say, oh, but I wish I would have done. I don't do that. I don't think that way. We've already swept that 38.67 level on ES, the relative equal highs, if you're following on the US 500. We've swept that. So now we want to watch and see, does it give us a shorter time frame post 930 is what you're looking for. Now it could just tear off and keep going higher. But we have a really huge imbalance now from the CPI number to where we are right now. So I think that we have a little bit of range to explore. Note that 38.50 on ES down into 38.15. Okay, so 38.50 to 38.15. That might be something we explore going into the equities open at 9:30. I'm just highlighting that range because I set it here. I'm gonna make sure it shows up in my chart later on. And I didn't see this, but I'm certain if I go through my tweets, someone's going to ask, what's the data? How do you read the data? I don't ever care to know what the data is. I just anticipate a lot of volatility on certain market events like this. And then I study it. I'm never going in and trading CPI. I've never, ever, ever told any of my students to go in there and say, all right, you're going to trade a CPI number. You're going to get in there ahead of the CPI number, and then there it is. No, we treat it just like FOMC. We want to see it hit the market, watch and observe what liquidity they take, where they aim for. And if you look at the 5-minute chart right now, looking back as far as yesterday, candles at low, 1545 on November 9th, Wednesday, November 9th of November. Look at the 1545 candle, that low. If you're following along on US 500, it should be basically the same thing. So it's walked sideways ahead of this report coming out. I outlined how retail would see that as a bear flag. And I wanted to see it go up into some short-term premium. It did so. Now, if I was wrong, then it would go up and obviously run out that previous high. We've done so. Now it's just hanging around. We have some time. It's only 8:42. So we're really an hour away before any trade would be taken by me. I'm not against taking trades on CPI number days. I just don't want you thinking that it's advised or smart to be taking a trade ahead of CPI number. I don't care how long you've been doing it or what you think your tools are doing. I got it wrong right in front of you. And that was a genuine opinion about what I felt was likely to happen. And that's what these reports will do. They will crush you. And you need to do this a dozen times in a year to realize, hey, this is probably not something smart or safe for me to do. Let me wait and see what the market does after that explosion of volatility comes in the marketplace. Because there's trades that will be taken later on in the day. That's fine. But I don't want you feeling like you have to know what this is going to do, because I don't know what it's going to do. CPI number is a highly manipulated data release. Just like FOMC, you don't know what the Fed's going to do. You don't know what they're going to do in repricing the currencies, because they can come out dovish or hawkish, and that might mean something to somebody else in the analysis. But the market reprices and starts going the opposite direction. You've been in that situation before. It's supposed to be good for the currency, or good for the market, but it goes the other way aggressively. And then they'll say, well, it was the market discounted that. It was already priced in. Why didn't you say that before the news came out? Because it's all bullshit. We have to wait for this explosion to happen. And then once the dust settles, then we can go in and pick our shots and see what happens after. Like right now, everybody that went in this today or was short just got taken out. Imagine you were short yesterday, holding on, thinking that bear flag that I outlined was going to continue going lower, breaking lower and keep going lower. Oh, they just got removed from the game quickly. Now, what I like to see is things like that, and then look to see if that narrative can be utilized later in the day. They use, in my opinion, the CPI number as a vehicle to justify in the public's eye why the market went up to this level where we're at now, above 38.67. There was liquidity there. So that liquidity now has been engaged. Do we go higher and start working towards a higher close on the day, or do we work back lower into that range that was just created with that big 2 or 3 up candles on the 5-minute chart, and then work towards that sell side below 37.50? That's what I'm looking for. I don't have a setup right now, but now, because we were so quick to get up there and take out yesterday's buy side liquidity, they did it on this high impact news driver. They did it where people are going to see that going into the 9:30 in the morning equities open. So it's going to create what? If you sat down in your charts, you woke up now, you look at this looks extremely bullish, does it not? I mean, if you just looked at this 5-minute chart and you don't have anything else considered at all, this communicates a fevered pitch for markets to want to go higher. That's a basic perception that anybody would come away with looking at that. The contrarian in me is thinking, okay, they use this to go up to that buy side. Can I use that and turn it on its head and then look for something that would justify why we can go back down into that range, what I outlined, which if you look at the low of the candle, and this is on ES, so if you're looking at a 5-minute chart, you're going to go back, not counting the candle we're in right now, you're going to go back 2 candles. So that low on ES is at 38.53.5. I have that noted down to 38.15. So I'm looking for something in that range post 9:30 opening. Now, the worst case scenario would be is it just keeps on going higher and I have no setup. Okay, that's the worst because I'm not trying to get in anything. It can trade down into that range and then resume going higher, and then I'm wrong there. But I would be wrong, and if I can take a trade. So it's a different kind of being wrong. Wrong like this, I'm fine with, because I'm illustrating why I don't trade these market reports and why it's dangerous for you to try to do it, because you don't know. No one knows what they're going to do. Okay. And because there's manual intervention, you're opening yourself up to unlimited damage. Like it's unlimited how far and fast it can take these markets and reprice them. Look at how much it's moved already. So I'm thinking that range is too exposed. It's all one-sided. It happened too fast. And go down into a 1-minute chart on ES. Now, if you highlighted a range that I mentioned moments ago, that range being at the low of 38.53.5 ES, 38.53.5, down to 38.15. Now, on a 1-minute chart, you should see a fair value gap right at 1-minute chart. You should see a fair value gap right at, on a 1-minute chart on ES, at 38.50 even, and the low on 38.53.5. So there's a smaller fair value gap with a down close candle at the 8:32 minute marker on ES. So if we drop down into that, say it drops down to that, and then it takes out the high again, whatever high would form prior to it dropping down there, that to me, I'd have to concede and say, okay, this is probably going to go into a firmer close for today. But I'd like to see, here's what is important. That fair value gap that I just outlined, if we can get below that, and then it can act as resistance and a failure to, in other words, engage price and send it higher. If there is no accumulation that takes place at that down close candle on the 1-minute chart with that fair value gap, and it goes below it and comes back up and starts acting as resistance, I'll take every fair value gap that forms after that with the anticipation that we're likely to trade down into that 38.15 level. But as a time filter applied to it, because I want to see the equities open, and we still have, 40 minutes before 9:30. And a safe time for you as a developing student would be waiting till 9:45. You're going to probably miss trades. That's okay. If you're learning how to do something, it's important for you to be comfortable with missing moves and not knowing why you missed it, because it's harmless, versus getting into something, not knowing what you're doing, being harmed by it, and not understanding why it hurt you. It'll become toxic to you. Trading will feel toxic. You'll develop fear and anxiety, which is the hardest thing to get over. Fear of missing out, that's easily fixed, because once you have a model, you don't sweat these types of moves. You know that there's other moves that you're going to be able to capture, and it'll make sense for you to be engaging it. But fear and anxiety of losing money, that's a really hard one to fix, because it's easy to talk yourself into thinking, wow, I just had a losing trade, or I had a series of losing trades. What happens if I take the next 10 trades and they're losers too? Your mind gets overactive. So all those things come into the equation when you start looking at real-time data and considering pushing the button. If you've done the exercise this morning, let me take a look at Twitter real quick. If you push the button, I have so many people tweeting to me. Not tweeting to me, texting me. Please don't do that, because it's a distraction. A lot of my students know my cell phone number and they abuse it. I don't rarely ever reply to all of them, but if you push the button and you can show me your execution arrows, do that. Tweet that to me now. If you couldn't get a fill, or if it rejected your order, say so. There you go. Armando, order rejected. Welcome to the real world. See that? But you'll never see that. And that was on demo, Armando says. So that's what I'm trying to explain to you. There's people out there that are going to pretend that they did something stellar. And you'll probably see it. They probably will show they bought the low. Okay, or they'll use the arrow on a candle like that one that formed at 8:30. And because it doesn't show you the actual price, I think it would be better for TradingView to actually have the arrow populate the chart at the price you got filled at. You'd see a whole lot less tomfoolery in terms of what was being shared by people online. Because if they show you the chart and it has the arrow at the low of the candle, at first glance, it was like, wow, you bought the very low, when you could be near the high of the candle as an entry, if the trades are closed. That's why it's important. That's why I go through and show you my entries, show you my execution, actual price points. If I'm not recording it live when I'm getting in there, I go and I show you where the actual fills were. All right, so looking at the ES right now, again, we're on the same 1 minute time frame. We have had one drive fall short of that 38.67 level, traded down a little bit, and then we went above the 38.67, back down below 38.67 a little bit, into a fair value gap that was formed on the this is the 1 minute chart on ES at 38.59 and a quarter to the low of 38.66 and 3/4. That fair value gap was engaged at the 8:39 candle on ES. Then we ran at the short-term high that was formed. The only interest I have, because you don't know if it's going to keep tearing off higher, and it can do that, I want to see that fair value gap I outlined earlier, just below 38.53 and a half. Again, on 1 minute chart, you should see it trades down into a order block if it does that. As long as it keeps going higher, there's nothing to do. You don't want to keep buying it. You don't want to chase it. You don't want to do anything with this right now. What I'm looking for is I want to see that fair value gap that would otherwise be something I would go long on if we didn't have this big run up like this. In other words, I'm not looking for that fair value gap to go down into it to buy long. I don't want to do that. What I want to see it do is I want to see it trade down into it. Initially, it might want to give the impression it wants to go higher, but I want to see that fail. That's the setup I'm looking for. I want to see that fail, go below the fair value gap. Once price goes below the fair, and it may not do this, but if it does, this is what I'm looking for to actually push a button today. I want to see that fail. And why would I want that? Because the buy side liquidity at 38.67 has been taken. It's been engaged now. And it was done so on the CPI number when there's nothing constructive about the consumer right now. Like it's bad. So I don't need to know what the report says. Like all of this here is I'm utilizing it for liquidity only. I knew and expected, and you know now also, that there's a lot of volatility on the CPI number. We observed how it went above buy side from yesterday. And now, is it running higher still? No, it's just hanging around. There is no setup for a long in here that I would take. I would not want to take a long at that fair value gap that I outlined, framed on the only down close candle that you see right at 832. That down close candle on a 1 minute chart, yes. That's a bullish order block. And it's coupled with a fair value gap that's formed immediately after that down close candle. If that does not send price higher, if it trades down to it, that's my broken little wing. That's like, hey, this should have sent price higher. If it goes down there and starts to rally, that's good. Because then if it does go below that fair value gap, I'll feel confident that I can take a trade down into 38.15 and maybe even retest that 37.95. Would that be that price? 92, 37.92. But that's the only thing I would do. Like, I would let this market do, if it just tears off and goes all the way up to 3,900, I don't care. I don't fear missing it. I don't have any anxiety about, not having been in it, because I know what I'm looking for. You might have something else in mind that you want to do. What I just outlined is something that I would be willing to engage. And if that fair value gap fails, that to me would indicate that we're likely to revisit and reprice to, at the very minimum, that 38.15 level. Now, you're probably asking yourself, why that 38.15 level? 38.15, let's go back up to the hourly chart. I just realized there's a lot of folks in here following on the US 500 chart, and it's probably getting very frustrating for you. I apologize. All right, so 38.15. If you look at all the wicks on, and we're on an hourly chart for ES, the candle at 9 o'clock on Wednesday, at 10 o'clock, and at 11 o'clock. There was multiple times it traded up into that area and moved away. Because it has done that, what was actually occurring on those 3 hours, the market has traded up and then back down, traded up, then back down, traded back up, and then back down. That creates a balanced price range. So it can trade down into that area. Now I use 38.15 because it's about near the low end. Because of a big report day like this, there's a lot of animation in price. It can color outside the lines basically and do a little bit more than you would reasonably expect. That's why I chose the 38.15. Do you use 38.15 for yourself if it starts to outline what I mentioned earlier? That's up for you to determine. You can use 38.20. That's a nice number as well. For it to want to trade back down in, if it's going to do any of that at all. But that all stems on the willingness or likelihood that that fair value gap that I outlined earlier is even ever engaged, because this could just keep grinding higher and that trade never forms. Do I regret not buying it if it does that? No. Because buying it right now after it's done what it's done here makes absolutely no sense to me. I'm buying it an extremely, huge premium with a correction that would take us into even a small move to like 38.40 or 38.36. That's too much of a range for me to concede with, being wrong in. I need to know what I'm looking for. I need to know what shots I'm trying to go after. And right now we got relatively speaking, we have the 3 drives high pattern, 3 drives higher pattern. I just don't like how smooth the one we're in there right now is. I'd really like to see the candle we just closed actually come lower. Might want to pop it up one more time. If you look at your 1 minute chart, ES, we just dropped down into that fair value gap that was formed on the 856 candle to the 858 candle. So there's 3 candles that fair value gap. We drop down into it. I'd like to see that one fail to send price higher. I'd like to see that and see if we can get below the low formed at the 850 minute marker. That would be interesting to see that happen. Then we can start to see if it wants to gravitate towards that fair value gap I mentioned earlier around that 3850 level. But there's no buttons being pushed right now. This is tape reading. This is tape reading as I teach it. You see other people say, oh, this isn't tape reading. You need a DOM, depth of market. No, you don't. You don't need that. You need to know what you're looking for. And then once you understand what it is you're looking for, you wait. And if it doesn't form, what does that mean? Nothing. You didn't push a button. You didn't risk anything. And yes, you placed time in front of a chart. And that was an investment. It's experience. Most of your time is going to be doing nothing between trades. That's the part that wears people down. And that's the time when you discover what it is you're trying to do as a trader. Because if you don't have a model, if you don't have a method or an approach to want to push a button, if you're just in here trying to impulsively react to, oh, it looks like it's going to keep moving up or it's going to keep moving down, that's gambling. And then you shouldn't be surprised when you're wrecking yourself. I'm sure there's about 50 people out there right now saying, ICT got it wrong. But they didn't buy it. That's the difference, okay? There's a difference here. All right, so we're at the low end of that fair value gap. It would have to go up here or it fails. I like to see it trade back down below that 38.67. If my son Caleb was here, he could provide me a means of a sounding board. I can bounce some things off of him, ask him, what do you see here? What would you anticipate here? So right now I'm at the point where I'm trying to anticipate what some of you are thinking, what you're probably asking. Like, why didn't he talk about this? Why didn't he talk about that? If I didn't talk about it, it's not important to me. Which gets back to, your model is going to be your model. And the things that I'm trading off of, you may not be considering. It may not even be a factor at all for your trade. Maybe a market you're not going to touch or a time frame. Okay, so now notice how we have moved up into the range between 38.60 to 38.80 after taking out the high from yesterday at 38.67. Has there been a lot of animation to the upside after taking it? We had one shallow run above it. We dropped down below it, made a higher high again, consolidated, made a higher high, and now we're about to trade below 38.67, looks like. There's relative equal lows sitting right around, you look at your 1 minute chart, the 850 to 853, small little pool of liquidity in there. I wish he would just show his charts. You can't trade off my charts. You got to trade off your charts. All right, so we're trading back into that fair value gap. The gap is formed from the high on candle 856. I'm talking about time, to the low on candle 858. So we went below it. Now we're trading back up into it. We're seeing, does it have reason to repel price and keep it from going any higher? So if you're looking at it from a 1 minute chart, if you have the, we'll just say 38.36 level, from 38.36, drop a horizontal line there and drop one at the high of 3770.75. Okay, that range, that is a buy side imbalance, sell side inefficiency. That means that the imbalance is to the buy side. It's all delivery on the upside. It is not buying pressure. Okay, because you saw how fast that candle traded. All those prices between those two levels, as I told you, did not get traded. So there's a buy side imbalance, and it's inefficient in sell side. No one had an opportunity to sell as counterparty to anybody that would see this candle. It looks like, oh, all these prices in here were traded. No, they weren't. That is a huge gap. And I know most of you don't have the way of seeing it, but if I pull up a 5-second chart, on a 5-second chart, now you want to put this in your chart with a different kind of color. You want to note the low on the 8:30 candle, okay, but at 15 seconds after 8:30, the low is at 38.15 and a quarter. So you know why I'm talking about 38.15 now. The for range, make it bigger. Color is, I'll use orange. And then you want to have another horizontal line at the high of 37.70 and 3/4. So what I just gave you was a real, honest to God, liquidity void. That is a liquidity void. It is not what you think of as an imbalance. That's not a liquidity void. A liquidity void was where there's absolutely no trading taking place at all. That gap where it moved from 37.70 and 3/4 up to 38.15 and a quarter, that was 2 transaction times. 1, 2. That's it. Well, what about the trading that took place between 38.15 and a quarter to 37.70 and 3/4? There was no trading there. So we have a big old open chasm of price action where neither buy side or sell side was offered. Now, I just recently taught this about a month ago, or at least in the last month. I told you what a real liquidity void is. That's what we're going to study going forward. That area down there, that will be revisited. And what I'm trying to see is, do we have reason to expect that in today's trading session today? It might not provide it. Let me go back up to a 1-minute chart. So it's a matter of looking for something to justify why the market should move, well, to a draw on liquidity. I like the idea of trading back down into that range I gave you earlier, but the one that has my most interest is the one I identified at 37.70 and 3/4 to 38.15 and a quarter, because that is a absolute liquidity void. The market will want to go down there. Now, will it go down there to just about halfway and then create some kind of buying opportunity? It could, but gravitating towards that, that's what I'm looking for the rest of today. I'm not interested in going long. I would not consider buying this at all. I don't care. Even in the PM session, I would not buy it, would not be trying to buy it, because we've already built in a huge premium. It's one-sided, and it might take until next week before that 37.70 level is repriced to. It doesn't have to happen today, but I'm going in looking for that today. So now if I have that expectation, and that's my trade model I'm going to be implementing and employing for this market for this particular trading day. If I don't have the setup pan out, or if I have no framework that would logically provide a movement to trade down into those areas, I'm not going to feel anxious about missing anything. I'm not going to be impatient about pushing the buttons, because I need to have things in proper context before I go in and do anything. So hopefully, understanding what it is that I look for, I've mapped it out. You saw firsthand experience why I do not trade ahead of CPI, because I can get it wrong. And if you're wrong on these types of days, it is like a tractor trailer running you over. The first set of wheels hit you. Yeah, that hurts. But you got 16 more that's going to run right back over top of you still. It just keeps running over top of you, running over top of you. So you don't want to be wrong on a day like this. So just giving yourself the opportunity to observe, study, see what it's likely to do, and then revisit it at 9:45. Does it give us any reason to anticipate market wanting to trade down into those levels I outlined? If it doesn't, then do nothing. Don't buy it and chase it. Don't do that. There's plenty other days out there where you can be a buyer and it makes sense. Whereas right now it's so overly built in as a premium. The public's going to want to buy this at 9:30. They're going to want to buy it, and that's also going to build in more premium. And in my opinion, more likely to trade down into the ranges I outlined. There's no reason to chase it. But to hopefully demystify that whole, how do you get past fear of missing out, or how do you engage beyond getting something wrong? How do you know when to avoid a trade? I did all that today with you. Number one, I'm respecting the risk, because these types of moves are unforgiving. Like, you don't get a second chance to fix it. Like, you can't look at this and say, oh, I took a small loss, let me reverse and go the other way. No, you don't have that luxury. It moves 80 to 100 handles and real quick. So it provides no opportunity for nimbleness at all. Either you're dead right before the report comes out, or you're dead wrong. Okay. And since it's so 50-50 like that, and there's no room for me to mitigate a loss, like if I see that 100 handle pan out over the course of the AM and PM session, I could get one or two trades wrong legitimately and navigate and fix that, mitigate it. In a move like that in the morning on a CPI number, or FOMC in the afternoon when they usually come out 2 o'clock, 2:30, doing those types of trades, like, you have to be absolutely perfect. You have to know exactly how far it would move against you to know that it's something you can weather by entering before the report comes out, which is stupid. Like, that's the epitome of gambling. And I don't teach that. I don't do that. I don't teach it. But by having the understanding of what it is that I'm looking for, and understanding the elevated risk involved, I don't fear missing these moves. I don't feel like I missed anything. And I don't feel like I'm bleeding out in front of you, because I already explained to you that this is a market move that I'm prone to be incorrect about. So I fear nothing. I don't feel like I've missed something. I don't feel like I've failed. I don't feel like I've hurt myself. I didn't take a losing trade. I didn't lose any money. I had no negative engagement whatsoever. None. That's how you have to study. You have to keep your trading studying like that, no emotion. I've outlined what I would like to see for the rest of today and or going forward. I want to see that liquidity void. That's a draw now. And we have to look for the market to indicate that it's done so. In other words, done so. I didn't say what I was supposed to say, right? It's got to have a shift in market structure where it looks like, okay, we've done enough pressing higher. So wait for a shift in market structure, but time first. What element is that? It's going to be the 9:30 opening. They're holding this into a premium. So at 9:30, average Joe and G.I. Jane, she just got her trading terminal opened up. She's ready to go out there and start shooting things. They're going to see this as a premium, not in the sense that we see it. They see it as, I didn't say that right, actually. They see this as a indication that it wants to go higher. Whereas we see it as a premium, it's too expensive right now. So it's better for us to anticipate a correction lower into a discount versus buying at these elevated prices when it's likely to reprice to a discount. And then anybody that would be going in and buying it right on the opening at 9:30, they suffer, drawdown, or maybe you can get stopped out or caught offside. I'm gonna try to hang around here until 9:45. We'll see what we get. If I can find a way to push a button, folks, I'm gonna do it. ICT's gambling. High roller. But I took you through the process of knowing why don't trade on these days, study them, and hopefully it's convinced you that it's a day that you really can't trade it. I mean, let's be honest, you can't. This is not a trading day. You can observe it, and it's really good study, and it gives you a lot of feedback in terms of what you think the market's likely to do and where it's going to go. And I'm only interested in seeing it, trade into these areas that I mentioned thus far. So I'm going to take that first fair value gap off my chart, and I'm going to take the fair value gap, not the fair value gap, the range I gave you from 38.53.5 to 38.15. I'm going to take that off. So the only levels I have now is yesterday's buy side liquidity pull high at 38.67 even, and I have now 38.15 and a quarter and 37.70.75. Okay, those three levels, that's the only levels I have on my chart. There's nothing else on it at all. And I'm watching to see what we get in regards to the opening at 9:30. This thing could just keep grinding like a little higher each time, then sideways, small little correction, grind slowly higher. That's the worst case scenario. And when I was a younger man, I got hurt a lot trying to do that with bonds. I had less than 6 months experience, and I always saw like bearish divergences on the stochastic, and I was using an hourly chart to do it. And every time I saw a bearish divergence, I was trying to sell short because I was like, okay, it went up to give me a bearish divergence. That's what I was viewing it as, not realizing that the profile could potentially just keep grinding higher, and buying it didn't make any sense, and trying to short it made better sense. But I ended up getting smashed because I would do 15, 20 different trades going short, and each one being worse than the previous one. So that's always a problem on a day like this. So that's why I outlined that liquidity void and outlined it, mapped it out for you, so that way you know what you're looking for. Even if you don't have the 15-second chart, I can tweet that when we're done, and you can actually see the liquidity what I'm referring to. But those pockets in price action, those porous wakes, okay, where there's no trading at all, they are some of the best draws on liquidity. But you unfortunately have to sit and you have to wait for the market to keep putting enough people in as counterparty. Like every single one of these highs on your 1 minute chart, someone has tried to fade that and go short. Now, I'm telling you, I'm interested in being short, but there's been no setup. Every framework that I've given to say, okay, let's see if it does this, it just keeps grinding higher. But it's not grinding a lot higher. Notice that? It's just a nuisance, going higher. So there's nothing that excites me about buying it. And as much as I want to see something to gravitate towards that 38.15 and a quarter level, nothing is in play yet. There's no setup. So I can see how when I was a 20-year-old, how I would have really hurt myself multiple times in here trying to do something with an indicator versus just waiting for price to show its hand. It's not done that yet. So we're above 38.67 still. We've had 1, 2, 3, 4 times we've moved into a higher high, but very shallow. And it hasn't even been 20 handles above yesterday's 38.67 buy side liquidity pool. Not to say it can't go higher. I'm just saying it hasn't done so yet. So take a gander at the daily chart real quick. All right, so let's take a look at the daily. See my levels drawn here now. Tell you what I'm doing here. Hold on 1 second. All right, so if you go up to your daily chart on ES, if you're following on US 500, I'm not sure if it's going to line up the same way. The candle on September 15th, 2022 is a Thursday. The closing price at 39.19 and a quarter to the opening price of candle September 16th, 2022 is a Friday. That opening price at 39.04. So again, the closing price on candle September 15th, 2022, that is 39.19 and a quarter. And the opening price at 39.04 on candle September 16th. That is a fair value gap. And while I don't subscribe to the idea of it going above 39.28 high on November 1st, they could still push this into that retest of the fair value gap that I just outlined. So you want to have that on your chart too. So that might be just a little bit more of a flex going into the open, and then maybe you can see some kind of an attempt to get down into yesterday's highs, 38.48 and 3/4. If you look at the candle, and I'm still on a daily time frame, by the way. If you look at the November 1st high and compare that with the high on October 28th, November 1st is slightly higher. That's the reason why I'm not a fan. Even though if you go all the way back over to the 20th of September, you could argue and say that's relative equal highs. Yeah, I guess you could. I mean, it can do that, and I'd be wrong. But I don't subscribe to that at this moment. Actually, if we go above that, I don't see that as going above those relative equal highs and then fading and going lower. I would think that if it was going to go there, it's going to go above 39.81. So that's why I'm saying I don't like the idea or subscribe to the idea that the 1st of November's high is the draw. But I could be wrong. I'm dropping back down to a 15-minute time frame. Now with that fair value gap on the chart, and you can see how it looks like it wants to reach up into the low of that one. Just above 3,900, so like 39.02. If I was booking and making the market for ES, I would hit 39.02 and then sink it below 38.67, right at the opening on 9:30. Like I would run it there and then collapse it to go back below 38.67. So 39.02, hit it, maybe 39.05, flex into that fair value gap one more time, and then reject that, send it down to 38.67. That's how I would make the market for ES if I was doing it. Because everybody's they're going to want to buy this rate at the open. Can you guys hear me still? I'm not sure if it disconnected me because I was checking my texts from my wife. And I put my phone screen to sleep. I'm not sure if you can still hear me. Can you hear me? Can you hear me? I'm waiting for a tweet. Dreaming of electric. Thank you. You may hear the painters upstairs stomping around. I apologize if that's the case. I promise you I'm not conducting line dancing instructions. I don't know where it comes from, folks. Right off the cuff. All right, about a minute and a half to be open at 9:30. I promise in 2023, we'll have days where you'll see me calling the markets and moving. Right now, today is an opportunity for you to see why we do not do CPI number and treat this the same way. I don't need to do this again for FOMC. I've already done that in the past too, but these two types of reports, hands off. Wait until they hit the market, wait for the market to open up, and let that opening range happen. That first 15 to 30 minutes, let that happen. Then you can trust your technicals. Right now, it's all about making it attractive. They're putting lipstick on a pig. Nothing against pigs. Every time they drop something upstairs, or if I'm in another room, I'm freaking out. We had Canadian hardwood floors in this house. It was purchased. The builders, they had it done custom here, and it's a really, really nice hardwood floor, and I just don't want them to mess it up. All right, 9:30 opening. Here we go. Watch that fair value gap. Run at 39.02, 39.05 level. See if we get any kind of reaction off of that. I'm on a 5-minute chart right now. All one-sided, just pushed right from the CPI number at 8:30. 3,900. They call that a psychological level. That's a level where there's a lot of liquidity sitting there. A lot of large funds and such have their stops above that, thinking it's safe. And that's another reason why I put your attention on that fair value gap again. But we've already traded their ICT. Yeah. And I don't teach supply and demand where it's one and done, or we demand fresh zones. We don't trade in zones. There's always going to be 3 levels if it's a range of like a fair value gap. It's going to be the low, the midpoint, or the high. Okay, and based on where you are in the grand scheme of market structure and their market profile, not market profile in the sense that like that uses those horizontal volume bars. I don't have any faith in that. but profile is like a roadmap, if you will, of the day or week. See, like that crashing sound like that, it makes me want to go up there and start spraying. like don't mess my house up, man. Well, if you will, from that candle's high and the low of 50 and the candle at 853. There's a sell side below there. And you have the gap down at, what is it? 3852, not 3852, 3850, and those are prices. 3850 even to a low of 3853 and a half. So that fair value gap. That's a discount array. I know there's going to be complaints about this. This would have been so much better if you would just let us see your charts. But this is, to me, much more engaging because it's allowing you to do the work on your part. But it's harder. Yes, it's supposed to be. It's supposed to be. If it was easy, everybody would be doing it. The candle at 935 should be an up close candle. I don't want to see it go above the midpoint of that body. I want to see it, stay heavy. Like, man alive, I'm ready to go up there and start swinging shit. I've had to leave, several times in the last week or so because it's just too much for me to take. Like I did. I understand they're working and all that, but good grief. Okay, so if you take that candle I mentioned at the 935, good grief. At 935, if you put a Fibonacci on that one, and you're measuring, what you're doing is you're measuring that candle's high to low in that 50% level, that's midpoint, okay? That's called mean threshold. That's the halfway point of that candle. We don't want to see it go above that. Now it's just momentarily went just like a half a point or something above that. And now we're reacting nicely off that. That's what we want to see now. We want to see that continue and heaviness remain into 3867 and maybe accelerate down into 3852. Nothing else would make sense. Going back above the mean threshold, we'll just call it 3885. Anything above 3885 is a no touch, and it would be no interest at all for me. And I'd have to wait until probably 10:30. Actually feels weird without Caleb not being here. Usually I'm talking to him. He's asking, what about this? And what about that? And then I'm usually asking him, don't say nothing right now. I'm thinking. Growing up under ICT, it's not easy. I think these painters are pissed off. They're up there stomping around. They're getting paid good money. They need to calm down. Okay, same thing I just outlined moments ago with the candle on 9:35, 1 minute candle. We want to see the candle at 9:39. We don't want to see the half of that candle give up its ghost either. In other words, we don't want to see it just roll way over top of that, because then it would mean that we're going to go up into that fair value gap at 38.91 ish or thereabouts. This is not a good technical deck. So if you're looking at technically, there isn't a lot of cleanness to it. It's a lot of just pushing higher, pushing higher, pushing higher, and just really sloppy, static price delivery. Now look at the range between the high formed at, again, everything's on a 1 minute chart right now. Look at your high on 9:30 to the low formed at 9:42. The only imbalance that exists in that range is between the high on 9:32's candle and the low at 9:30's candle. So that little tiny little fair value gap right there. And it's relatively smooth if you look at the candles at 9:32 to 9:36. So that might be traded up too. That's what I was saying. If we go through the midpoint of the candle at 9:39, that would send the algo up into that area there and revisit that. Now, do we trade to that level? Roll over top of it, make a higher high? Good, because that fair value. No, I want to call it a fair value gap. The volume imbalance up at that 39.02. I would have favored that being hit first at the 9:30 opening, but we dropped down. So that may have been what they've done. They dropped it down, getting people want to chase it, put their stop above the high at 9:30, and then they run into that volume imbalance at 9:30. Highs. Take out 39.02, 39.03, maybe 39.05. Look at your candle right now in 1 minute, how it's coming back down into the candle at 9:44. That right there, I like to see that. And then I like to see it, move continuously higher up into that fair value gap and maybe even into that 39.02. And volume balance, give it to us, give it to us. There you go. Oh my goodness, look at that. On better days, trust me, we're gonna have a lot of fun. The highs at November 1st. If we go into 3903s, then I would expect it to try to at least run the high on midpoint 3910 to 3919. Okay, down close candle at 951, potential bullish order block, fair value gap that would be repriced on candle 955. So if it starts to rally up here, look for 3911, then 3919. Failure to go higher and going below 38.97 and a quarter, I'm sorry, 3/4 would nullify that idea. It's a whole lot more involved when the market's not clean, isn't it? Which is the reason why I teach low resistance liquidity runs. If it isn't obvious, if it isn't one-sided, you're going to have to contend with this back and forth. Constant reading, constant reading. And if you don't have the experience, obviously you can see how quickly you could hurt yourself because so many people are in a hurry to get to that live account. Give me a funded account so I can get real money. And then when you find out that you can't do it well because you're impulsive or you don't really understand the concepts just because you watch the videos, it's very frustrating. So you have to give yourself permission. There we go. Something to pay the bills with. All right. So if you paper traded that fair value gap I just outlined and using the order block, you should already be partialed out, leaving something to see if you can get it at 39.19. If you don't have that volume imbalance that I had on the daily chart I mentioned at the beginning of the, well, I guess that really wasn't at the beginning, but it was near the beginning of this, you won't fully appreciate where you're at right now in the context of where price is and why it's gravitating. Thank you, Mike, the Destroyer. He says super helpful. If you do YouTube, I think I'd prefer no chart, much more engaging. Yeah, that was my thought process. Kind of like a squawk box. It makes you think and see it, find it on your own chart. You know, holding your hand and walking you through a chart, it's not the same as really learning. And it forces you to understand what I'm saying in the chart. I'm saying it, like I can't edit this. You're all, making copies of it. So it either pans out or it doesn't. Somebody's mad. Let's see, one more off here. Here's your 19. See if we can get the 20 print. You should be partialed here. Don't see that in supply and demand. Elliot's still looking for a wave. So I think that's going to be it for this morning. We've done enough for government work. So let me recap this so you kind of make a little bit of sense out of it, because I know some of you are going to be lost. Everyone here live, that you were here live, you heard me outline everything, everything in proper context, everything you pointed to before the fact, explaining why in the best way I can and still follow price action, obviously. The idea of knowing when to avoid a trade, what market drivers to avoid, and then wait for the market to give you clues as to what it wants to do. Using higher time frame PD arrays, nothing that's in retail. Okay, I've seen a couple guys, I've already blocked them, and I'm telling you the reason why I blocked them, because they're going to tell you I blocked them because they're calling me a fraud and I'm hiding from them. No, I'm tired of seeing people say the stuff that I teach is renamed retail logic. They're liars. Okay, and I have a $500,000 bounty out there for someone to break down in detail where my stuff is before 1996 in writing, in video, anywhere. It's not. So walking you through live price action like this, okay, essentially, this is the best way of mentoring, because if the person you're learning from can identify where there's problems, where precision will be muddled, well, not muddled, less likely to be obtained. That means that they have clarity, they have the vision to see, okay, there's potential for problems, okay, for things to be obvious. So as a developing student, you want to have a educator, a mentor, someone that's going to be able to know what that's like. And you have to be around the block for a long time, lose lots of money and make lots of money, knowing this is what I did when I lost money, and this is what I did when I made money. And this is where I found the greatest increases in my understanding. Having that prowess, that experience, that is such a short commodity in this industry, because there are people out there that are extremely profitable, but they're not in the business of giving you their time like this. They're not interested. They don't care. It doesn't make them a bad person. It just means that they just don't care enough to sit down and give their time, because their time's too valuable. They don't have that mindset to want to be able to share. They go in here, they kill it, and they do their thing. They run their life, and there it is. It doesn't make them a bad person because they don't share it with you. Okay. I am a person that I have a promise I got to keep. So I do this. I love doing it. But it's important for you to contrast what it is that I do versus what everybody says I do or don't do. If I can't see it, if I can't outline it before it happens real time, then these concepts don't work. I think everybody can agree with that, right? If I can outline where it's going to go and why it's likely to go there, when it should happen, then that means what? That means there's an algorithm. That means I've had my fingerprints all over it. Okay. Knowing why price should go to these levels that are not in retail books is an advantage. It's an unfair advantage against retail traders. And yes, the Goldman Sachs alumni, they have no idea about this stuff. They have no idea that those things that I've shown in previous discussions and lectures and live sessions, you're not looking at my chart. But I walked you through this morning, showed you where the problem areas are, where the difficulties would be, what it should do, what it shouldn't do. And honestly, this is a difficult trading day today. So if you had a hard time looking at it and understanding, number one, it's good. That means you're going to dig into your chart. You're going to listen to this recording again and look and observe. But only the people that were here live, that were hearing me talk about the 1 minute candles before they painted, why it should do this, where it should go, why should it draw to this level, why it shouldn't be doing this. If it does this, it's problematic, and then it's going to go here. All those facets, they string together to give you a reason to not fear missing a move, because new moves are going to. And I don't feel regret if I don't take something, because I knew I have other opportunities and other tools that allow me to participate and build a bridge. The bridge was this morning. Once we went through the 930 high, we traded down. We wanted to see it want to go towards sell side. It failed. It wasn't able to do that. Once we ran out the high again, to do that again indicated what? We would be pressing into that volume imbalance from the daily chart at 3902, 3905 areas. I was saying it was going to likely go up into that. We traded up into it and then came back down into a bullish order block, which I outlined. Go back and listen to the recording. And there's a small little fair value gap. It trades down into that. And the opportunity was to reach into the consequent encroachment of that volume imbalance. And what that means is consequent encroachment is the midpoint of any kind of gap. A candle, the midpoint of that is mean threshold. It's always basically 50%. Okay, it's a halfway point. But those levels, with the low of the gap and the high of the gap, it's 3 levels, very specific. I'm not trading in supply demand zones where it's ambiguous. Hope you find the right price. No, I teach my students and I showcase where these levels are specifically. And I walked you through it this morning, highly distracted with these people up in my first floor, stomping and banging, dropping, showing there. I'm flipping out right now. I'm kind of proud of myself that I didn't lose my shit earlier, but I'm focusing on these candles. So I'm trying to keep that focus there. But the run from the low of the volume imbalance in that fair value gap to the high of the daily volume imbalance. And I'll show you a chart and you can see my executions too. You'll see where I got in based on what I explained to you. And you'll see where I took partials, and it'll make sense to you. But if you watch this, or you not watch, isn't the best choice of words here. Listening to it isn't going to be the same as the experience for those of you that were here live. So you had the opportunity to listen to me squawk, talk about where there is likely this scenario that unfold, pan out. If it doesn't do this, this is where it's going to draw to next. There's no setup here. There's nothing here. We're looking for this. We're looking for that. It's just meandering around. It's an ugly day so far. And then finally, what does it do? It gives us the clue we were looking for. I wanted to see it trade up into that daily volume imbalance. If it wasn't going to give me the setup that I wanted to see for a short into that liquidity void, which will be used at a later time now. There was no short for me. But the fair value gap long going into that daily volume imbalance, that was the one that we had to basically submit to, because it was not willing to give us a selling opportunity. It didn't give us a breakdown. It didn't give us a fair value gap to sell short into. And I mentioned the fair value gap earlier after the 9:30 opening. While it was a draw on liquidity, I said that that's not something that I see as a shorting opportunity. Go back and listen. You can't edit it. I can't edit it. It's all live. Okay. I'm suggesting that that would be something that's not a short for me. If we didn't have the daily volume imbalance, I would have shorted it. That was my words. We're very close to it. But because we had that daily volume imbalance and it didn't trade to it at 9:30, that's where market profiling and narrative comes in. Market making. Okay. So because it didn't trade up into that daily volume imbalance, I can't feel confident to sell at that fair value gap. But I mentioned if it did, I wouldn't care about it. I can't take that trade though. Why? Because the narrative I outlined just now and then, that it didn't take out the 9:30 high into that daily volume imbalance at 39.01 and 3/4 to 39.20. Because that was unfinished business. That was the reason why I was unwilling to sell short at that fair value gap. How do you know when to sell short a fair value gap or buy a fair value gap and when to ignore them? I walked you through it live today. There's a lot to it, folks. That's why I'm saying, like, my private mentorship flipped out when I told them I was going to put the core content lessons on YouTube. They're like, you gave it away. No, I didn't. I gave away my language. But you have to study your ass off. And you got to be under my wing like this. This is what they had. They had this the first year, me sitting down explaining, but I had 865 people trying to text me and talk to me and ask me a question while I'm doing it. And you can hear how distracted I am because I have painters in the house. And believe me, my concentration has been broken multiple times. So it's hard to articulate this on live charts. I don't care how good you are. It's hard to keep your focus, but then have your focus be this precise too. See, that's the deciding factor. I want you to compare and contrast these folks you see out there that are trying to tell you they can trade like banks and they know my concepts, but they call it by different names. If they really know how to do it, they'll walk you through it. They'll gladly do it. They'll enjoy doing it, and they'll do it for free just to make sure you understand that you can trust them. That's all I'm doing here. I've shown you how not to hurt yourself today. I believe I have. If I've been successful, at least in that, give me a number one. Tweet to me a number one. That means that at least you understand how painful this can be for you if you don't listen. If you go in there and gamble on a CPI number, it'll beat the brakes off of you. But if you learned how I personally, and how you can eventually grow into this understanding too over time, how I pick and choose my patterns of what I want to take and what would keep me from taking an entry pattern. What process do I go through in my head says, okay, I see that there. And in other circumstances where if we didn't have that daily volume imbalance, I would have taken a short at the fair value gap that was formed right after 9:30 opening on the 1 minute chart. But because we had unfinished business, and just look at your 1 minute chart now. Isn't that beautiful? Isn't that beautiful? How it went right to the top of that volume imbalance from the daily chart. I outlined, gave it to you for free, real time before it even happened. And now here we are. We traded to the top of it, and we're now 94% of it to the low. That alone, folks, that by itself teaches that there's an algorithm, because that principle is not taught by anybody else. They are teaching it now, thanks to good old ICT. But the point is this: teaching it in a hindsight chart is not the same thing as watching the algorithm book price before it happens. Okay. If they know the algorithm, if they handled the algorithm, they would know this. But because I'm the only person out here doing it, and the only one that's going to do it, because I had to create a language that you're not supposed to know about. I know that gets under people's skin and you don't like it because you want to be able to turn it around and say it's something else you learned or that you found it out. And I see people say that I figured this out on my own. And this is just confirming what I thought I saw in the marketplace. No, you didn't. Stop lying. Okay. You didn't see this because you'd be doing it. You'd have example after example, or you can start doing it right now. So I mute people when I see that kind of stuff. I don't take that as complimentary. I take that as grade A bullshit. Period. Folks, I made this. Whether you like to believe it or not, it's mine. And if you don't like it, and if it gets under your skin, move along. You can conduct your business and sell all your horseshit, get all your subscribers buying in all your stuff, and you never have to cross paths with me. But if you cross paths with me, I'm going to call everything you're doing horseshit. And by compare and contrast, show you that it's Mickey Mouse. There's nothing like what you're seeing here. Nothing like this. You know when to do something, when not to do something. You know when to avoid it. You know why it should reverse. If it does this, it's going to go somewhere else. That's not plan A, plan B. That's depth of understanding. That's proof of concept, and it's authorship. Think about it. I've used this analogy before. Simple game like Pac-Man. Okay, I got a Pac-Man game in my house. As a matter of fact, I'm looking at it right now. My wife wanted to miss Pac-Man, but we couldn't get it because all the supply chain crap. I wanted Killer Combat. No, did I say that right? Killer Combat. I don't think I got the right name for it, right? Mortal Kombat. Killer Combat. What the hell am I talking about? I wanted Mortal Kombat. And I couldn't get my hands on that one either. But those games, when they make them and design them, the board that the Pac-Man little thing that goes around eating up the dots, how does it stay inside of its border? Why doesn't it just go off screen and do whatever it wants to do? Why can't it move diagonally? It can only go up, down, sideways. That's it. It can stand still. It can go left, it can go right, and go up and down, but it can't go diagonal. Why? Because it's never been coded to be allowed to do that. Your market price, the last price right now, wherever it's trading right now, okay, that's Pac-Man. It's going to go up. It's going to go down. It can consolidate and stay sideways and go nowhere. Okay. It can't go backwards. It can only go forward because that's all it's allowed to do. It's coded to do that. So when a designer makes a game like Pac-Man, okay, a coder that knows all the logic that goes into that machine, that program, they can sit down and play the Pac-Man game better than anybody else because they know what profile that the ghosts are chasing the Pac-Man are going to do. If they do this, then it's going to do that. And all I'm doing is illustrating proof of that here. And I know some of you get mad. Like you're punching the air right now because damn it, he just proved it again. And how am I gonna cancel this out now? Well, how about just stopping that and just warming up to the idea, I love doing this. And if you're already profitable, I can make you wildly more profitable if you just put down your bullshit. I'm not trying to war against anybody. I'm 50 years old. I'm set in my ways, and I like doing what I'm doing. Take advantage of that. I want you to. Just pull up a chair, show up every day, and take notes. I promise you'll leave better than you arrived. It's always going to be that way. But if you're lazy and you're just trying to get in here and give me an easy this and easy that, I've already done that for you. It's already on the YouTube channel. But if you want to know why these markets do what they do, why they book the way they book, you're not going to learn it from somebody else. You're not. And these 5-minute, condensing of, you want to learn ICT's bias in 5 minutes, made it easy this way. It doesn't work. Go watch them, and you'll see that you didn't learn anything more. You didn't learn it faster. You didn't learn it better because you have to go through what I just walked you through today every day for months. You will not get this type of understanding just reading a book or watching my videos. You have to sit with me. It has to be something like over the shoulder, and then you get it. But you don't need this level of understanding to be profitable. You can use everything I have on that YouTube channel, and it's just fine. There's nothing missing. There's nothing needed beyond that. It's perfect for someone that wants to hit the ground running, go. But for freaks of nature, people that just simply want to know that they know, or be inside the clique, the inner circle, if you will, I do things like this because I know the intrigue with it all. I know some of you don't really want to believe there's an algorithm that does all this stuff and it's all buying and selling pressure. And you just give me the latitude to talk the stuff I talk, and you cherry pick what you want to take from what I say. That's okay. I had a lot of them in my mentorship. There's still some of them that will still tell you, I don't really believe there's an algorithm, but ICT knows some stuff about pricing. Okay, cool, whatever. There's no argument. That's all I'm trying to do is I've canceled all the arguments. There's no reason to argue about it. If you're already profitable, who cares if there's an algorithm that you believe or don't believe? If I'm showing proof of it and there's nothing to lean on in terms of other retail logic, and it repeats every week, every day, and it's highly precise, and I'm pushing a button, you're seeing executions, you're hearing the thought process, the internal dialogue. Why is Pac-Man, why is price going where it's going? And why should it stop there? Why should it react and go the other way? Why is Pac-Man hitting the wall and have a choice? He can only go left, he can go up, or he can go down. Those are the choices because there's a ghost behind him chasing his ass. Okay, that's logic, and you don't get that in a book. And you don't get that experience just watching my videos or anybody's videos. Like, you have to have someone that literally knows how to see these things before they happen. Why should they even exist? Because Wyckoff doesn't make sense. Okay, that stuff is always explaining hindsight. That's the 6 o'clock news. Okay, that's what you're seeing. That's explaining something in very simple terms so the public can digest it and buy up that narrative. I'm giving you by the second of what price should be doing, where it should go, why it should happen. These same folks that in these investment banks, Goldman Sachs, JP Morgan, these people, they don't know what you're learning. I'm telling you, they don't. They've tapped me on the shoulder. There's your proof. You want to call bullshit, bullshit, we'll call it, okay? Those individuals don't know this stuff. But you're learning it. We would like to see you come. Nope, not interested. Go watch my YouTube channel. But shit, I don't need your money. I'm not interested in that kind of stuff. I don't want partnerships. I don't want to be obligated to nobody. I don't want none of that stuff. It makes it a job, which is what it's felt like the last 6 years. And it's draining, man. It's so draining. I love teaching, but I don't want to do it in a formal setting because it takes all the excitement. I mean, isn't something like today, hearing it talk about what price should do, and then you're watching on your chart. You're not distracted by going from screen to screen, looking at my chart and finding it on your chart. Whereas I'm just explaining it by the candle, not the time, the price. I'm telling you what time frame I'm on, and you're marking your own chart up. Now, if you felt that was a little confusing, that's okay. Don't worry. We'll have more examples of this. But for those that could navigate, you've been doing it for a little while. You can't deny it's been interesting, isn't it? Like, you can see it. Like, wow. Like, I'm calling your chart before it paints. I was explaining how your chart on your platform, through your brokerage firm, whatever the hell it is that you're looking at. I know some of you are looking at your live platform. You're not looking at TradingView. And you watched it unfold today. Isn't it fun? Like, that's fun. Not, here's what I, did with my mentorship money. I bought a Lamborghini and I got a lease payment on an Alfa Romeo, like whatever the Italian cars that people are going to chase. All that stuff's dumb. I like this. This is the fun stuff for me. It's entertainment, it's educational, and it's interactive. Like, it's really interactive. So if you like this kind of stuff, this is kind of like what I wanted to do going into 2023. It's not a signal service, okay? It helps you map out real-time price action. My students that are doing signal services, okay, you can't argue that this is not going to step on your toes. I did not take anybody into any specific setups. I said, this is what I think. This is where I think it's going to draw to. And there's a fair value gap here, and you want to see it do this. You see, you want to do that. That's not me say buy. That's not me. Here's your stop. And that's not me. Here, take your profits. I did mention, because I was in a trade. You'll see that whole process of stepping on your toes and canceling out the necessity for anyone to want to go to you as a signal provider. You can't be upset with me because I'm not doing what you're doing. And if anything, this is actually going to build your market up for you, because here's what's going to happen. So you can calm down if you're all worked up and worried about it. People are going to see what it's going to be requiring them to do this. Now, a lot of people know that what I'm doing, other people are doing, and they see me do it. So it works. They may not be able to do it. There's your market. And I have no problem with that. And you should have a means of having another income. If you're able to be honest and you're consistent, you're able to use the concepts well, there's a market out there. People will pay for you to sit down and tell them, buy here, sell here, all that. The risks are yours. But that market's going to grow when they see what's involved in this. A lot of people just see watching videos and think, okay, well, it's just simply a matter of looking for this little thing he talks about, it's fair value gap. And they think every time it does that, it's a buy or sell. You saw today that isn't like that at all. That's narrative. That's the stuff that mentoring gets. Okay. My private group, they were getting those experiences. You're not obligated. Well, I'm not obligated, rather, to give that to you. Okay. That was an experience for them. There's a couple chapters in my books that are coming on. I know you guys keep asking, when's it gonna drop? Every time I think I got what I want for the third one done, another topic comes up. So the third volume is really, really big. Like it's a longer one. And I'll talk a little bit more about narrative and the things I did today, because that stuff is what separates me from the rest of the smart money concept clones out there. Okay. There's things that offend me, and there's things that would probably flatter all of you. I'm not flattered by the things that I see when people take my stuff. Okay. And they don't even teach it right. And it gives it a bad name. And this year, I set out to do a lot of things to kind of like cancel the argument for most of these clowns. And I think for the majority of everything I attempted to do this year, I was successful. And I'll leave that up to public opinion, whether I was or wasn't. But in 2023, like, I want to leave all the bullshit, like all the sizing up and, you can't do this better than me, all that stuff. I want to pick a lane. And this is kind of like what I want to do. Like this is what I want to do in the morning sessions. This is a couple times a week. You'll know when I'm going to do it. If there's something that comes up, my wife says, I want to do this and it makes me unavailable for that time or that day, I'll just send you a tweet and say, hey, look, I can't make it today. We'll do this, or we won't have one, until this day. And I think that's fair. I'm not obligated to any of you. But I promise you'll see things that you would have never seen without me doing it for you. You'll see things in price that you never would have discovered just simply by watching my videos. And you'll see that there's absolutely 100% control over these marketplaces. And they're not random. They're not just doing whatever they want to do. There are times when you want to get out of the way because it will be manually intervened. And we saw that today. And I'm always going to be wrong in those instances. That's why I don't trade them. I know where they're going to say, well, let's do this and reprice it here. And anything that I have won't work because it's them pricing to a specific price level immediately. And there's nothing I can do to be nimble to fix it if I do something wrong. So it has to be a binary, black or white, right or wrong. Do I get in beforehand? No. Because if I'm wrong, it could crush me. And I'll regret it knowing that I shouldn't have done it. Versus waiting, letting them tip their hand, look and see which premium array or PD array it wants, or discount array rather. and wait for the clear, easy, low resistance liquidity run signature that I outlined this morning, and you'll see. The volume imbalance was the very thing that kind of like made the narrative easy for me today. It may not have been easy to follow, but I needed something. I was waiting for a breakdown and a shift in market structure, and I wanted that fair value gap to act as resistance. The first one, we couldn't get down to it. So what do I do? Nothing until something else presents itself. Well, something else presented itself. I said, okay, well, it's not likely to go down there. So what is it doing? It's not going to consolidate here. The public's going to want to buy it. So we'll watch and see if it wants to drop down. It drops down and then rallies back above, creates another higher high. So we broke outside of the 930 high and then created a fair value gap with a bullish order block. Go back and listen to the recording. And that fair value gap, that long to the top of the daily volume imbalance. And that's exactly where your price high is today at this time of the discussion at the moment right now. How do you know if the daily high or low is going to be this and that? It's a lot of what you just saw me do today. Understanding the narrative, the weekly profile, the daily profile, and time of day. All those things have to be blended. And yes, it's complicated. Yes, there's going to be always people out there trying to make simplifications of what I'm doing. You can't simplify any of this. It all has to be incorporated to get those types of results consistently. Once in a while, you might get near a high or a low. Okay, good. You might be able to call the high, but you're not trading it. You might be able to see the low likely, but you didn't get out there. Okay, and be content with that. That's enough. That's enough. That's a trophy. But you don't need to be buying the low and selling the high just to be profitable. You can get that meat in the middle of that bone and just take that easy stuff to grab and run with it. Once you get it, stop. Like I have no interest in trading the afternoon now. None. I have zero interest, absolutely none. Do you? If you feel that impulsiveness and you're wanting to get in there again, resist that. Find ways to say, okay, I don't need to do this. And then come back later on, regardless if it moves good or not. Get comfortable with saying, I don't need to do that. Because social media equity curves are plaguing everybody. This guy's better than this one. This method's better than that one. This one is copying this guy. Who gives a shit, man? Dude, who cares? There's a lot of other shit going on in the world right now. That's Mickey Mouse topics. That's not even that big of a deal. Pick the person you want to follow. Demand that they can prove they can do it. If they can do it, hey, that's all you need. And if you like their personality, and mine's not that great because I have a personality disorder. I don't hide it from you. I've never tried to hide it. I'm not the best teacher, but what I teach is the market. And the real market makers, they employ these ideas against everybody else. And you're not supposed to know them. So, a little bit more proof at the end of the day. All real time. Look at that 1 minute chart right now. Look where it's hanging inside of. Those boundaries of that daily volume imbalance that does not exist anywhere else. But it's always been in your charts. It's always been there. Nobody's ever talked about it. Nobody's ever mentioned it. But this whippersnapper back in the 90s thought his shit didn't stink. Discovered things like this. And felt like he had to prove himself all the time, to validate himself. I don't need to validate anything anymore. That's why I don't live a fast life in front of everybody. That's why I don't do all those things. And I make it all about the boring stuff like this. And if you're not entertained by this and reading price, you're in the wrong industry. Like if you don't have a passion about knowing what these simple little candles are going to do next, I guarantee you, you will not be a trader. It's got to be in you, or you're not going to be a part of it. Like, you have to absolutely love it. If you don't love it, you're not loving money. You love the process. You love the engagement of it, the whole art of it. It's a lifestyle. It's not a hobby. It's not a choice. It's a lifestyle. Business owners, entrepreneurs, they're not doing a hobby. They're passionate. They're passionate about what they're doing. And you have to be absolutely passionate about your development as a trader. You have to be passionate about why even do this. You can make lots of money with it. Nobody's arguing that. But are you doing this to compensate for something else? Because if that's the case, you're not going to do well either. You're going to be impulsively doing things that you shouldn't be doing, hoping that you're going to get a lottery win. Man, I'm fighting the urge to talk about Powerball. I gotta get off here. My wife's already gave me the equal. I'm like, you said 15. Yes, I'm closing it. I'm closing it. I promise I'm closing it. Okay, give me 3 minutes and I'm closing it. I got a boss, folks. Anyway, my intentions are, once we come back from our holiday break, you might not be breaking, but I'm breaking. The first Tuesday of February, I would very, very much like to do live streams like this. And yes, my chart will be available. Yes, you'll see it. Okay. But I want you to know that there's going to be time charts that I'm going to refer to, because I'm only going to have one time frame on my live stream. Whatever chart that is, that's the one I'm going to stay with the entire time. I'm not going to transition and go through, but I'll refer to, like you heard me talk about in today's Twitter space, I'll refer or cite a specific price or series of candles that my attention is on. And you might say, well, you're holding back, ICT. I want to do what I want to do. Okay. Can I do that? I think I earned that, right? I mean, it's my prerogative. I don't want anybody trying to tell me how to do it, because that pisses me off. I'm a control freak. I don't like someone trying to tell me what to do. You can't do it better than me, so don't suggest how I'm going to do it. You have no idea what I'm going to talk about. You have no idea what price is going to do. So please don't suggest to me how you want to be handheld. I want to do this and entertain myself, and hopefully along the pathway, bring your understanding about price action up to speed. And if you don't like it, if you don't like that way of doing it, you don't have to watch the live stream. You don't have to do that. You don't need that. It's already on my YouTube channel, how to trade and profitably, and do it with precision and know what you're looking for. I'm not trying to have the biggest live streams. I don't care if only 200 people show up. I don't care. Okay. I just know that there's an audience in my group, both private mentorship and collectively. You all want to see this type of stuff. And I have no problem doing it. But I just wanted to make sure that you all understand that it has nothing to do with ego. It has nothing to do with proving that I'm this or I'm that. I just want to engage you all as an audience, and I want to have fun together. And I can create a carnival-like atmosphere, make it fun when there's a better market. Today was kind of like lackluster and just, but even there, I can find something. But why would you want to waste all your day in your morning when you could have been out to breakfast with your wife that I'm encroaching on? I know. I'm sorry. I promise I'm closing it now. I'm going to close this now, folks. The boss has given me the final evil eye, and I will catch up with you when I catch up with you. I'm not going to share the charts right away, simply because I'm getting ran off here now. But obviously, you've been here. You know what's going on. If you enjoyed today, give me a thumbs up emoji and a tweet. If you didn't learn anything, keep your opinion to yourself, because I really don't care. So I'll talk to you next time. Be safe. Well, good afternoon. Welcome back to another Saturday Shotgun with ICT. This one probably won't be that long. I'm a little uncomfortable today, but you'll probably hear all kinds of banging about above. But it is what it is. Things can't get done without breaking some eggs, I guess, huh? So, yesterday morning, I told myself all week, don't lift anything, don't do anything, let them do everything. Nope, I had to be helpful. And I helped him throwing my back out. So I'm in a little bit of discomfort today. So trying not to do too many things. Even sitting in one place is painful. Standing is hurting. It's a mess. But anyway, I want to talk to you about this past week and what might be on the horizon and how that might affect the markets going into the close of the year. So we've seen the dollar index. It's dropped off a lot. And I mentioned, I'm not sure if it was the last Twitter space or the one before. It was within the last two that I did. I mentioned how Saudi Arabia was lining up with the BRICS nation coalition, if you want to call it that, where they're basically telling the U.S. pound sand. Everybody's going to get a good price, but ICT, I mean not ICT, but America, they're not getting a good deal on fuel or oil. When we don't really need their oil anyway. We have plenty of oil here, and we could tell everyone, see you later. And we can actually go into the export business and do very well as well. But it just goes to show how corrupt everything is. But because our dollar is a petrodollar, it is backed by nothing. And years ago, our nation went to Saudi Arabia and said, "Hey, look, we're going to protect you." Nobody was threatening them at the time, but we're going to protect you from threats. All you got to do is sell your oil in dollars. So anybody wants to buy your oil, they must convert it to the U.S. dollar. So when we were taking off the gold standard, our currency was worthless. Like it was literally nothing. And then now it was backed by the oil market through Saudi Arabia. A lot of people don't realize that or understand that, but now we are in a position where the perfect storm is brewing. And my private mentorship has known about this for a while. I've talked about it publicly as well in the last year. They have obviously weaponized food and the production of food. And if you don't know what I'm talking about, just do a little research and homework. And a lot of people denied me, the stage talking about it early on when nobody else was talking about it. They thought it was lunacy. Just because you see it on your grocery store shelf doesn't mean that it's not occurring. There's a lag. Okay. Everything you buy in the store, canned goods, vegetables, and things like that, that was last year's crop. And the production for all of 2023, that's going to be significantly less. So that's going to create a shortage, basically. And the cost of those types of foods are going to go up, which is kind of like what I want to talk about today. And you may be thinking, well, what's this got to do with anything? How's this affect the S&P? How's this affect crypto? How's this affect, my day-to-day life? Well, it means things are going to get really expensive, probably hard to get. And if they are not producing much of it, that means the commodity market is going to be extremely bullish in the grains. Corn, soybean, wheat, those types of commodities. We'll probably see historical rallies in 2023 because of engineered famine. The folks that were in my private group, were fearful. They missed it. I said, this is not it. That the initial run up, that was just based on this year. The dollar has rallied, and commodity mega trade type scenarios for commodities to go up vertically, like in the 70s in the grain markets and stuff like that. Go back and look at old historical moves, and you'll see that it had really amazing run ups. And then we had some more in the 90s, which was fun. But we're going to see something we've never seen before, like parabolic. Like it'll make Bitcoin's rally look like a Judas swing. Yeah, because it's the whole world. The whole world is going to feel that pain of not being able to have enough food. And all these rich cats out there buying up all this farmland makes you wonder, why would they want to do that? Remember I was telling, if you're in my private group, when we saw them talking about the creation of water futures. In other words, there's a commodity contract that trades water. So I told them, I said, we're going to have a problem with that because if they're trying to make water tradable, well, what that means? They're going to start manipulating it like they do everything else. So water's an issue that's become an issue for farmers. And all of these things go under the radar of the average person. You go up to your bed at night and you fall asleep thinking about how you don't want to go to work tomorrow or next week, because Friday night when you go to bed, you're thinking, I only got 2 days. I got to start all over again. How's this ever going to make its way to your attention? It won't, because the news isn't going to tell you prepare for that kind of stuff. So as a trader, as a speculator, some of the sharpest people in the world are commodity traders. The folks that are long-term horizon type individuals where they see like crop reports. And I'm not claiming I understand all that, because I don't. But I see all these little things that are coming together perfectly. Okay. And I've been bullish on dollar for a while, and I try not to pick tops in any market, really. And I've went out and said that we could probably see dollar at 120. Now, in recent market action this week, and with the recent discussions because of Saudi Arabia saying, we're going to go in the direction with Russia and China and Brazil and India, and they're all forming this anti-dollar movement. And that's one way of taking the dollar down. Because if they get Saudi Arabia to sign on, what does Saudi Arabia need our protection for? They feel like they got the bear and the dragon behind them. And that type of thing makes me think about the book of Daniel, that fourth and dreadful, terrible beast. It's starting to look like that. BRICS nation, is it. But that's another discussion for another day. Thought I was going to start preaching, didn't you? The dollar may be showing initial signs of, well, if Saudi Arabia is doing what it appears to be doing, our dollar really has no value, has none. So that sets the stage for, we need a replacement. We need to have something to replace it. Okay. The central bank digital currencies, they're going to become a thing, and every nation is going to have their little thing, and that will also fail. And the one fix, the solution will be the one currency. Whatever currency that will be in the future, I don't know. But I am telling you, and Raja, listen, you can crack jokes all you want, but Forex is going away. Might as well get used to trading other markets, because Forex, foreign exchange, is going to die. Just like open outcry pit trading in commodities, it doesn't exist anymore. Forex is going to go away. It's not going to be accessible to you. You're not going to be able to do it. So if you'd like to sit around and pretend that that can't happen, it's going to be an abrupt shock to you when it's done. Now, will it be done in the scope of banning it? I don't know. But we will not be able to do it. Okay, so you need to be thinking about alternative ways of speculating and trading. So there'll always be companies out there. These companies that make money selling goods to people, because there's going to be people that are going to be consumers. They're going to need services, those types of things. My attention shifted back to my roots. I'm in futures trading again. I don't want to touch Forex. I don't ever want to be back in Forex ever again. Index futures, easy. When there's a mega trade, something significant, then I'll trade those markets like the grains I'm talking about in the beginning of this conversation. So if we can look at the whole macro perspective for a moment, okay? And this might be a little bit boring for some of you, but just understand where, man, that did not sound good upstairs. I'm trying to think about where I'm at and what that sound could have been. Give me a second here. That would be a table sliding on a floor that better not be leaving a mark. All right, that's going to be in my head now the whole time we're talking. So the dollar, if this is correcting, okay, let's go as far as to say, let's say the dollar has topped. I'll play devil's advocate for a moment. I don't know for certain that it has, because I try to avoid picking tops and bottoms and long-term moves. But let's just say that the dollar has seen its high for the next 12 months, okay? I'm not stating that I believe that, but let's just say that it is. That would set the groundwork for lower dollar. Commodity prices are allowed to go higher then, because when dollar goes down, grains, meats, oils, all those types of things, it's real easy for it to rally because there's an inverse relationship. So if dollar's been going up, it's real hard to have mega trades where these currencies, or not currency rather, these grains like corn, soybeans, wheat, the things that people use to make the food, anything you eat, you go to your pantry, you go to your cabinet, you go to your refrigerator, open it up. Those things that are in there, unless they're main staple items like eggs, milk, sugar, salt, flour, if you're buying something that's processed, all of those foods have multiple things inside of them. And it's been gathered from the world's grocery store, mainly like United States, we're a big bread basket. Russia, they have a grain export as well. And you see these big countries are saying, no, we're not doing it. We're not exporting. We're keeping ours. And I've been telling my private group this for almost 2 years. And they think it's going to happen right away. Like it's something that's okay. You're not going to have food in the grocery stores this weekend. No, you need to prepare, get ready for it. Get a 2-year, at least a 6-month stock of non-perishable foods and go through them, use them, and replace what you use. Because in 2023, we are going to see crazy famine level nuttery. It's going to be nuts because grains will not be coming to yield like they normally would, because fertilizer costs quadrupled almost. Okay. If you tell a farmer you can't use this much water now, and this is how much fertilizer costs, and now you got too much carbon, so you can't plant that much. You see where all this is going? This is the next big thing. So you're all waiting for crypto to come back alive. That's dying. Okay. Forex is dying. Food. That's going to be the market that people will absolutely be buying up because you need it. You don't need a crypto. You don't need a Forex. You don't need it. You don't need it. But everybody needs to eat. Everybody has to feed themselves or their young ones. Now, what are you willing to do to keep from starving? Now, contrast that with what you're willing to do if you miss a crypto trade or a Forex trade. It's annoying. But what happens if your children are hungry and you don't have anything in the pantry to feed them? You're going to start thinking about things that you necessarily wouldn't be thinking about right now and what you do want to do. And I'm going to be honest with you. I'm a God-fearing man, but I know I would be doing things that would probably be very unsavory to make sure my family eats. If you have extra, I'm going to ask politely the first time. And that's just being real. Imagine the whole world like that. That's going to make food prices go through the roof. And it's all being engineered, not in one country, everywhere. So we're seeing that potential turning of the tide where dollar has been rallying aggressively. Really, really hard, aggressive. Why? It's been flexing on all the other currencies. But Saudi Arabia is that little cornerstone I've mentioned. Watch that one. I told my students, keep your eye on the Middle East. When the shoe drops, you'll know. And it seems like that formation of the BRICS nation, that whole anti-dollar movement, and their currency is going to be backed by gold. Hello, that's real money. That's not crypto, and that's not dollars. That's real money. That's a real currency. That's a real currency that has a backing of what is considered biblical money, gold. You go into any country, gold's recognized. You start flashing, Confederate dollars, they're like, what is that? That's monopoly money. Nobody's going to care about that. But reach inside of a case and pull out a bar of gold, and you'll be lucky if you live. So they're hoarding up all the gold. If you've been watching the last 12 months or so, there's been huge withdrawals from physical gold depositories where they're holding on to gold. There's been huge withdrawals of gold. Why? What is going on that everybody wants to get their hands on their gold? Because something really big's coming. And they already told you what it is. It's the Great Reset. It's the Great Shafting is what it is. And a lot of people are going to be caught off guard. They're going to be starving. They're going to be doing without because they think it's too science fiction to prepare for it. But all you have to do is look at the markets, and they're telling you. Remember how crypto was supposed to be? This is the Robin Hood, the savior of all fiat currency victims. Go out into the world and transfer your currencies into Bitcoin. It seems to be there's a lot of celebrities and such, even YouTubers, that got themselves tangled up in a web of supporting these ideas and these schemes and scams and frauds, and now people are left without their money. Even my own son. I told Cody, I said, do not invest that money in that crap. Don't do it. Oh, Dad, you don't know. You're so old and fuddy-duddy. You're set in your ways. And just watch this young generation. I'm going to watch this young generation do exactly what the fuck the dot-com bubble did. I said, don't do it. Okay. See, you only get to be a old dinosaur in this business if you do the right things. And there's always these young guys that come out and they think they know something better than the old heads. And I'm sorry. Wisdom comes with age. And I might be all racked up here with a back that's thrown out. But I'm going to tell you something. My net worth is bigger than yours, and my understanding about the markets is bigger than yours. If I'm telling you this stuff, I'm helping you. Don't arm wrestle me. It's not a competition. I'm trying to help you. You can, number one, prevent yourself from potentially going hungry, or maybe even profit from it. How? Well, if the dollar is, in fact, topped out, and I'm not saying that specifically here, I'm looking for further evidence of that, because it's about this time where it should be doing it anyway, because that sets up the moves that go into next year for grains. So I'm looking at the correlation between lower prices on dollar, and if everybody around the world saying we're not going to be able to produce as much wheat, corn, soybeans, oats, rice. And if you don't have rice in your house, bags of it, you should start getting it. because it's probably going to be 10 times more expensive next year. Oh, I don't eat rice. You'll eat rice if you're hungry. You can do a lot of things with rice. But all those grains, if everything is what all these signs and indications are pointing to, less water being allowed to be used by farmers, they can't get as much fertilizer because it's too expensive. And their countries are saying, you can't produce this much because of the carbon footprint. You have too much nitrogen. Come on, man. Like, all you have to do is take a step back and look at it. Do you not see that that's being engineered? It's in your face right now. And I'm talking to the 3 guys that were in my private group that literally cussed me out in the email. I'm pissed off at you because you didn't listen to me. And now it's obvious. It's in your face. And when we get into 2023, if you didn't listen, you're going to so regret it. You can't make money if you're starving. You're not going to think clearly. And it's easy right now to go to the grocery store. Oh, it's there. ICT's full of shit. You have a 3-day stock. That's what you have at your grocery store. If shit breaks out, say a BOMB falls somewhere in the United States. We don't need to say who it was that did it, but every grocery store out there will empty immediately. Who's going to come and fill it back up? Nobody. You got what you got. Good luck. Everybody is 3 meals away from starvation. You don't realize it, but that's really what it is. So you have to prepare. It's all part of being prepared as a investor. Having a clear mind to be able to decide what it is that you're going to be doing, because you cannot trade scared money. Scared money will not make you any money. And if you don't have these things sorted out beforehand, I have food stocks, I have water filters, I have water, I have means to medicate myself, over-the-counter medications that would normally be a hindrance on being sick or whatever. You're not worried about COVID. You're not worried about RSV. They're trying to scare the hell out of you again. People get sick, folks. It's part of life. If you're going to die, you're going to die. Ain't nothing to worry about. You can't stop it. But you have to make preparations for these things to get even harder. And a lot of you young folks out there just think you're invincible. And I'm so thankful that this wasn't happening when I was 20, because I would have dismissed all of it. I would not be listening to me right now. I would have already turned this off, and that would have been it. But I'm thankful I've been able to be in this world long enough to know and how it operates, and where we're heading is not pleasant. And all of you people out there that are running around thinking that you're going to have Forex forever, man, you just simply don't know. You don't know. So if the dollar's coming down, that gives you a gateway to have mega trades. That means these big, extrapolated, violent, one-way direction moves. That's a real bull market. That's a real commodity that has real supply and demand factors to it, because people need to eat. You don't need your British pounds. You don't need to buy British pounds in the US. You don't need to do that. You don't need to do it. You don't need to buy IBM shares or Amazon shares or Tesla shares. You don't need to do that. But you do need to fill your pantry up. You do need to put eggs, bread, milk, and those main staples in your house. Those things are real. That stuff is going to be hard to get your hands on going into 2023. If you can, it's going to be so expensive. It's going to be stressful. So you need to be able to mitigate that as early as you possibly can. Start, making preparations for that. And also preparing yourself for opportunities in the marketplace, because crypto ain't it. folks. It's not it. The commodity markets, the old wheat, corn, soybean, those types of moves that we saw years ago in the 90s, they're going to be trumped by enormous rallies. Coffee. I don't like coffee. I love the way it smells. I love the way it smells, except for the ones that my wife likes. It stink. I don't know why she even drinks that garbage, but hey, she says she loves the way it tastes. I think it smells like shit, but it is what it is. But Starbucks, or you go into the coffee aisle in the grocery store, I love that. I love that smell. I have a collection of cologne that have 2 fragrances that smell like a coffee house. And probably like, what? It smells gorgeous. It's a gourmand fragrance. It's beautiful. It smells amazing. I get so many compliments, but coffee itself, I can't drink it. And you're probably saying, what the hell is he going on about coffee for? Coffee is a commodity. Coffee, you can make a lot of money in coffee trading it. And when it moves fast. Over $300 a cent, and you're looking at a move that could potentially go violently straight up. If people can't get what? If they can't get their caffeine through coffee, what happens to them? They're nuts, right? I can't function without my coffee. I'm glad I've never been a victim to that, but I can see. I've been married to a woman that needs that stuff. She's addicted to it. But that's going to be a commodity that is affected by what's coming too. Sugar. Sugar right now. Unless you're a diabetic or something like that, you should be getting it. Cocoa, real quiet market right now. But all those things are going to be expensive going into the next year because you're not going to be able to get your hands on them. But the main ones are grains to me. That's the one I'm watching. And we saw this big run up and we corrected. And everybody's forgot about it right now. Nobody's talking about corn and soybeans and wheat and oats. They're not talking about it. And the dollar's slipping. And the fundamentals are Saudi Arabia saying, it's been nice, but see you, Biden. They found new friends. New mafia protectors. They ain't worried about getting shaken down anymore. So what's the dollar backed by? Mm-hmm. What's the British pound backed by? Mm-hmm. The euro. Yeah. It's an illusion. Then you have these nations coming together saying, we are going to put an end to Western rule. Just replace that with dollar-based. That's really what they're saying. And it was going to happen. I mean, we played bully for years and decades. We tried to be the cops, but we were also the people that are doing the biggest crimes against humanity and other nations. We don't like your president. We're going to do you a favor, and we're going to put one in that we like. What? How long can you do that before other countries say, hey, this ain't the right guy to be backing? And we're seeing that formation, this collaboration between other nations that are literally turning their back on the dollar. And the average person doesn't see it. My kids aren't in public schools, but I guarantee they're not teaching it in schools either. It's going to be one of those things where something happened. Who could have seen that coming? All of you now. All of you. And you have 2 choices, obviously. You can listen to this and dismiss it. This guy's tinfoil hat shit. Okay. Or you can listen to it and say, okay, this is opportunity. Opportunity is now here. Whereas the first group would be looking at it and listening and thinking there's no opportunity here. Opportunity is nowhere. And for those that are still listening, you see it as opportunity is now here. Put all those letters together, they look the same, but the perception is different. See, as a speculator, as a commodity trader, I look at war, I look at pestilence and famine, disease, and terrible incidents in the world and say, that's horrible. I couldn't do anything personally to stop that. My heart goes out to those people. But there's opportunity. There's opportunity in that. And it sounds horrible to someone that hasn't been a speculator or a trader. But why wouldn't you take that event that you didn't cause? You didn't create it. You can't stop it. You can't remedy it. Is it a moral dilemma for you to profit off of it? I don't believe it is. Now, I'll leave it for you, the audience members, to wrestle with that. Oh, I couldn't do that. Well, you're doing it every time you take a trade, folks. Because on the other side of that trade, there's someone that's taking the same risk, just viewing it oppositely. Is that a word, oppositely? If it isn't, I just coined it. You're victimizing someone on the other side of your trade. If you're right and you made money, they were a victim of that speculation. So don't preach to me. I'm not going to look at the Twitter yet, but I'm sure somebody like, oh, it's a terrible outlook. It's the reality of it all. When I go in and I put a trade on, I'm hoping the person on the other end of that trade is dead wrong. I'm not lying to you. I'm not trying to sugarcoat it. I want these motherfuckers to be wrong. I want their money. That's why I'm doing this. I'm not trading to be Mr. Rogers friendly. Hey, I'm on this business to go in here and lose to everybody else because I feel like giving my money away. And, what else is there better to do? Let me just go in here and pick losing trades. That way the other guys out there can start making money. That means I'm a good person. Fuck that. I'm in this business to make money. And that's the only reason why you should be here. So you shouldn't be wrestling with any kind of moral dilemma about finding opportunity in terrible events that you didn't cause. Those victims were already victims. Okay. You're not taking anything from them. You're not preventing them from getting aid. You're just looking at the cause and effect, how that's going to be viewed in the marketplace. And that sentiment shift, you're participating in that speculation. And if you're wrestling with that, because I had students come to me, Christian, do you think that trading is gambling? And does God look at what we do as gambling? Well, the lot is in the hand of the Lord. So if you believe that and you ask of him to grace you with a blessing and he allows you to have it, does that sound like God saying, no, this is something you shouldn't be doing? I don't think, and I'm going to say this statement, I'm going to get off this topic because I could go on this for a long time. I know there's people in here who don't want to hear this, but I wanted to touch on this because it can't not be discussed and that not be an issue, because I know some of you are listening and thinking, okay, but this is something bad. My church members would frown on this. Maybe we're trying to get a club together and, I'm learning from this guy. Now he's here or they're listening to this podcast or whatever it is I'm doing here. And I'm cussing and I'm saying you should be profiting off of people dying in a war. And it doesn't sound like something they would want to participate in. I'm not saying that's what we do. I'm saying that that's where sometimes, unfortunately, great opportunity is there. And here's what you can do with that. You can take that windfall victory and turn around and bless other people with it. That's all you got to do. If I profit and I see someone in need, I don't broadcast it and say, I go out here and I did this today. Give me my attaboy publicly. I don't virtue signal for that crap. Okay. I have shared in years gone by that when I'm in a grocery store, I like to pick somebody out that wouldn't necessarily expect it. And I go behind them with my cart. And then I tell the person, go ahead, I got you. Now, I'm not saying that to lose my reward for doing it. And I'm not trying to sound better than the average person, but that's how I live my life. So I don't just go out here and try to make money off of incidents that people were victim of, earthquakes and wars and, terrible things that took place, a currency collapse, something that, to that effect. That's going to cause reverberations in the marketplace. That's opportunity. And if I can profit from that, how I feel good about doing it is I go out and I'll find someone that's in need of something and I'll do something, provide something for them, render a service to them. And that's it. No reward beyond that, just feeling good doing it. That's how I coped with it, because early on I had that wrestling match. Am I really doing the right thing? Like, am I doing the right thing? And I look at it this way. There's a parable of the talents. Okay. And the one that was given the opportunity to multiply the talent, he went and buried it. He said, well, look at this guy. He's shrewd. If I lose this, he's going to be really upset with me. So I'm just going to go bury it. When he comes back, I'll get right back to him. And he was chastised because he did not at least put it in the bank so he can do what? Get interest on it. That's investing, folks. That's speculating. So I don't think that God has an issue with trading or speculating. He has an issue with money changers, clearly, fashioned the whip right out of a rope and drove them out, turned over the tables, released all the doves. So if you're expecting that blue-eyed, loving hippie Jesus to come back, I don't think that's what you're going to be getting. But again, I'm not going to preach. But there's so many things in that book that you could literally draw so many parallels into how you should live your life as a trader. And you don't have to be a Bible thumper. Okay. I don't go to a church. I don't go to a religious building full of people. And I don't have any issue with people that do that, but I don't do that. I don't participate in organized religion. I'm going to support those churches that act and operate like businesses. I don't think that's the model that was given to us in Acts. So when I talk to you folks, I know sometimes the topics, they don't feel like they're germane to you at the moment, but given enough time, you'll start thinking, he talked about that. And the 20-year-olds that are in my audience, maybe even the early 30-year-olds, you're trying to find some way to connect with what I'm telling you today, because it sounds like gloom and doom. Well, if you want to look at it from a perspective of not being prepared, not seeing opportunity in it, not being able to speculate on it, then yeah, I could see how easily that would be very depressing, scary. But I don't fear those things. Okay. I don't worry about those things, because if there is a system still in operation, okay, this is why I always tell everyone, the algorithm is not going to stop working. They're going to implement it continuously. The markets themselves will be removed. Then it won't work because there is no market. But as long as there's a market, that's what they're employing, period. So don't worry about that. You have other things to worry about besides whether or not the algorithm is going to get changed or replaced with something else. It's efficient, folks. It's efficient. It's perfect. And when they need it to be something outside of itself, they will manually intervene. There it is. So there's no reason to be worrying about all those things. But in all this mess, this is what is astonishing to me. You see all these folks out there, and I'm not, listen, folks, I'm not trying to stir you up, because I know these crypto people are like fanatics. Like what did you say about my mother? That's what it feels like sometimes. And I'm just giving you my opinion. And my opinion should be welcomed. You don't have to agree with it. But in speculation, there has to be somebody that has the other opinion that's different from yours. And that should be welcomed. I look most of my time in the morning before the markets really present the kill zone times that I'm trading. I'm in forums. I'm on websites. I'm in people's Twitters. I'm in people's YouTube comment sections and trying to feel what the sentiment is. I'm interested in the other opinion. I'm not taking their trades. I'm going to trade against that sentiment. Now, I'm not saying you should fade what I'm saying here today. You're welcome to try that. But just know that if you do that, this could be very, very expensive and a different kind of expense where you may be ill prepared for your household to sustain itself. Nobody sees how crypto was not the savior in all this pandemic. That was the time for it to shine. And I sat back and waited to be wrong. Well, this will tell me if this is really what it's pretending to be, then it should be shooting straight on up. And nope. XRP future. Yeah. Future zero. All of these things are there to get you thinking outside of the normal money. And it's been effective. But I couldn't trust having my money parked in any of those things right now. Look at how much fraud has been going on. Think about it. My son's got 20,000 plus locked up. He can't do anything with it. He can't pull it out. He can't do nothing with it. That's frustrating for me because he didn't listen. My own flesh and blood, my firstborn, did not listen to me. And it fucking pisses me off. I want to throttle him, but he won't learn. The only thing he'll remember is Dad basically blasted me and he didn't care that I went through it. When I do care that he went through it. Every single time I see someone ask me about Bitcoin or I see a Bitcoin thing that's trending or any kind of crypto thing, it boils me up, man. I'm pissed off because he bought into that horse shit. Oh, it's just a new way of doing things. This is the new breed of trading. This is going to be able to smoke everything out there. Wrong. That's hype. And when social media, first of all, Bitcoin would have never been able to do what it's done if social media was not even available. It would have never happened. Social media is the instrument that is weaving all of your thoughts and dreams together, and you don't even see it. It's engineering the direction in your life, how you should think about things. And they will not be letting us have social media much longer. Not in the capacity you're used to using it. $44 billion. And he brought the kitchen sink in because it's going down the fucking drain. That was money laundering, folks. You just don't see it. Oh, let's get all tied up in bankruptcy is not outside of the discussion next year for Twitter. I might be wrong here, folks, but just think about this for a second. What happens if Twitter just folds and it's not there and it's not sold or bought by someone else to keep it going? That's just one big venue where people can't communicate and share real time what's going on where they're at. See, you can text your friends and family a bunch of things that's going on. If shit starts going down where you're at, in your country, in your neck of the woods, it's real easy for us to get on Twitter. There it is. This is what's going on. Share a video clip. And it's out there. People have it viral. What I see is the beginnings of them having the perfect excuse why you can't do it. It doesn't feel like Big Brother taking it from you. It just feels like some rich guy did something stupid and now Twitter doesn't exist because of that. I don't see that at all. I see $44 billion transferring hands in a money laundering scheme. And they're going to take one more way of taking information exchange from us, all of us collectively. It just goes away. Just like I think PayPal, they think, oh, PayPal is just trying to be this and that. You're going to charge somebody $2,500 and you're going to police whether something they say is truthful or not. I've already closed my PayPal account. I'm done. Gone. When they put that shit right back in there again, that was it. That morning, I called. I said, you're not letting me close the PayPal account. I have no interest in doing business with PayPal anymore. I'm done. Close the account right now. Are you sure, sir? Because I said, I am absolutely sure. Close my fucking account right now. Okay, it's done. All right. Piss off.